Democratic leader Chuck Schumer has opted not to block a Republican spending bill. The decision was made despite a growing number of Democrats wanting to use their limited leverage to restrain Elon Musk's cost-cutting efforts. Addressing the Senate, Schumer explained why he decided to walk back the threat of a shutdown.
A shutdown would give Donald Trump and Elon Musk carte blanche to destroy vital government services at a significantly faster rate than they can right now.
Republicans likely need 7 other Democrats to join Schumer, who wouldn't say if there were now enough votes within his party to overcome a filibuster.
Well, Stephen, the lift in the markets this morning comes after the S&P 500 slipped into correction territory. The index is down 10% from its all-time high. The tech-heavy NASDAQ 100 index also in a correction. And the Dow Jones Industrial Average is 9.3% below its last record in December. Lauren Goodwin, the chief market strategist at New York Life, says tariff worries are rattling Wall Street.
There is no doubt that the volatility that we've seen in the market over the last couple of weeks is about policy.
Hello everyone, good afternoon, good morning, good evening, good morning, whatever time zone you are right now. Welcome once again to this live analysis. Happy Holi to all of you as well. कुछ लोग शायद कल भी बनाएंगे तो उनको एडवांस में बिकॉज कल मार्केट बंद रहेगा. सो लेट्स स्टार्ट द सेशन. फटाफट से देख लेते हैं. मॉर्निंग सेशन क्लोज था, इवनिंग सेशन ओपन हुआ है. क्रूड ऑयल कल याद होगा सपोर्ट पे क्लोज हुआ था, गैप अप ओपन हुआ है. ऊपर रेजिस्टेंस देख लेते हैं एक बार, रेजिस्टेंस है क्या. एक सेकेंड दो. डेटा की बात करें 7:30 पे अभी कंज्यूमर सेंटीमेंट और इन्फ्लेशन एक्सपेक्टेशन का डेटा है, गोल्ड और सिल्वर को इम्पैक्ट करेगा. और 5:30 जस्ट अभी न्यूयॉर्क सेशन भी ओपन हो गया है, तो वॉल्यूम थोड़ा बहुत आ जाना चाहिए अब मार्केट में. एंड निफ्टी बैंक निफ्टी तो क्लोज था ऑलरेडी, तो वहाँ पर तो कोई ट्रेड बनता भी नहीं है. तो देखें कल मार्केट ने अच्छा होगा सेल ऑफ दिया था, नीचे से थोड़ी बहुत रिबाउंडिंग हुई जरूर है. नीचे अभी सपोर्ट वो 5007 5060 वाला अभी भी स्ट्रॉन्ग ही है, वहां पर कल नहीं आ पाया था एग्जैक्टली. बट ये भी एक रेजिस्टेंस जोन ही माना जाएगा करंट एरिया. करंट एरिया भी रेजिस्टेंस का ही है एटलीस्ट. क्योंकि कल सपोर्ट था, ब्रेकडाउन हो गया है, तो ऊपर 5850 तक पूरा रेजिस्टेंस माना जाएगा. देखते हैं यहाँ से थोड़ा बहुत सेलिंग अगर आती है. फिर नीचे से हमारे पास सपोर्ट मैंने बनाई रखा है कल वाला, वो अभी भी इंटैक्ट ही है, कोई चेंज नहीं हुआ इसमें. बाकी कल का एक बीच में सपोर्ट एरिया था, वो थोड़ा वीक हो गया है मेरे अकॉर्डिंग. ये बीच वाले को अब कंसिडर नहीं करेंगे, 5780 वाले को. बाकी लाइक भी करते रहो. डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल. ये क्रूड ऑयल अपने रेजिस्टेंस जोन पर ही माना जाएगा। कल का जो सपोर्ट था ब्रेकडाउन हुआ है तो एक्ट लाइक एज अ रेजिस्टेंस। को भी नेचुरल गैस को भी देख लेते हैं, एक सेकंड दो। कि नेचुरल गैस को अगर देखो फिलहाल के लिए 15 मिनट टाइम फ्रेम पर, प्राइस 5827, 5827, 5827 के नीचे आएगा तो इसमें एक सेलिंग का प्लान करेंगे 5827 के नीचे। बाकी अगर ये 5852 के ऊपर क्लोज हो गया तो फिर सेलिंग नहीं आएगी। नीचे ब्रेक होना है तो एटलीस्ट एक बार 5827 के नीचे 15 मिनट में जाना चाहिए प्राइस को। नेचुरल गैस में भी कल का जो लो था वो सपोर्ट एरिया था, याद होगा मार्केट के पास, वहां फिर से आता है, फिर से बाइंग कर सकते हैं। ये कल वाला ही सपोर्ट है, इसमें कुछ चेंज नहीं हुआ है फिलहाल के लिए। कल भी बाइंग आई थी, फिर से आएगा थोड़ा डीप से, फिर से बाइंग करेंगे। अपर लेवल पे देखोगे क्योंकि सीधा थोड़ा सा गैप डाउन दिया है। कल मोमेंटम करते हुए इन्वेंट्री के बाद चला गया था, इन्वेंट्री पॉजिटिव जरूर आई थी, बाद में फॉरेक्स में सेल ऑफ आ गया था। और ऊपर आया वापस तो डे हाई जो कल का बना हुआ है वहां से फिर वापस सेलिंग का प्लान रखेंगे। ठीक है, तो नीचे ही सपोर्ट रहेगा आपका नेचुरल गैस का। कुछ खास इसमें रेजिस्टेंस ऊपर दिख नहीं रहा है, वैसे मेजर रेजिस्टेंस तो काफ़ी दूर है, वहां तक तो शायद ही जाए 380 के अराउंड वापस। बट बीच में और कोई रेजिस्टेंस नहीं है, प्रीवियसली देखना पड़ेगा क्योंकि गैप अप गैप डाउन हुआ है। फॉरेक्स थोड़ा सा बेटर दिखा रहा है। तो अब एग्जैक्टली इतना ऊपर तो आएगा नहीं, बीच में कुछ ना कुछ लेवल जरूर बनेंगे फ्रेश। 27 पीपल आप वाचिंग, लाइक करते रहो गाइस। जिन्होंने नहीं किया लाइक अभी तक, भूलना नहीं है, लाइक भी करना होता है। बीच के लेवल के लिए नेचुरल गैस में फॉरेक्स का चार्ट ही बेटर है। फॉरेक्स में देखोगे जहाँ एक कल कल का जो हाई बनाया था इसने, फॉरेक्स में हमारे मार्केट के अराउंड ही मान के चल सकते हो, या फिर 315 के आसपास आज। वो एक्चुअली ये जो लेवल है वो रिटेस्ट का लेवल है, एमसीएक्स में नहीं दिख रहा है वो, फॉरेक्स में दिख रहा है डेफिनेटली। सपोर्ट था, ब्रेकडाउन किया, रिटेस्ट बना दिया। तो नीचे वाला लेवल ठीक है, अगर ये वापस रिटेस्ट करने अगर आता है ऊपर, बिकॉज एमसीएक्स में फिर यहाँ पर कुछ लेवल ऐसा कुछ खास दिख नहीं रहा है। फॉरेक्स को ही कंसिडर कर सकते हैं, अदरवाइज क्लैरिटी नहीं मिल पाएगी लेवल पे। ठीक है, तो नीचे का ही सपोर्ट है, उसी को ले रहे हैं। इस 100 नैस्डैक को भी देख लेते हैं एक बार। बैंक निफ्टी के लेवल देख रहा हूँ फॉरेक्स में ना, तो टाइम लगेगा। फिफ्टीन मिनट टाइम फ्रेम पे नैस्डैक डबल टॉप कहाँ बन रहा है नैस्डैक में? आई कांट सी एनी डबल टॉप इन यूएस 100। डबल टॉप तो बिल्कुल भी नहीं है। पुराना डबल टॉप था, उसमें तो ऑलरेडी कल सेलिंग आ गई थी, अभी कोई नया डबल टॉप तो नहीं बन रहा। वो जो प्रीवियस डबल टॉप बना था वहां पर, वो कल बना था ना 13 को, वहां से तो ऑलरेडी सेलिंग कल ही आ गई थी। उसी लेवल पे फिर से सेल करना चाह रहे हो? देख लेते हैं लिक्विडिटी है तो। अगर यहाँ पे कल काफ़ी देर की लिक्विडिटी लेके ऐसे जा चुका है इस पर्टिकुलर जोन से। कल ऑलरेडी यहाँ पर लिक्विडिटी लेके जा चुका है मार्केट। 5:30 हो चुका है, 7 PM पे वैसे मार्केट ओपन होगा यूएस का। 7:30 पे डेटा भी है, ट्राई कर सकते हो क्वांटिटी कम रखना। ये कोई नया रेजिस्टेंस नहीं बना हुआ है, लास्ट टाइम का वाला ही रेजिस्टेंस है, जो कि पहले टेस्ट हो चुका है 3 बार कल ही। 15 मिनट, 15 मिनट, हाँ 15 मिनट टाइम फ्रेम पे ऑलरेडी। कल देखोगे ना वहाँ पे 15 मिनट में, वही आईजी ब्रोकर की मैं बात कर रहा हूँ, 15 मिनट में ऑलरेडी टेस्ट है वो लेवल। नेचुरल गैस भी लग रहा है बिल्कुल, इन्वेंट्री का कुछ खास इम्पैक्ट हुआ नहीं इसमें। बाकी देखो फॉरेक्स में तो वॉल्यूम रहेगा, एमसीएक्स में देखते हैं वॉल्यूम उतना रहता ही नहीं रहता जितना फॉरेक्स में है, बोथ क्रूड ऑयल एंड नेचुरल गैस। कल देखना पड़ेगा ऑटो सेक्टर कैसे काम करता है, बिकॉज कल आपका थोड़ी देर पहले स्टेटमेंट आया है यूएस के कॉमर्स सेक्रेटरी का कि ऑल ओवर द वर्ल्ड सभी कंट्रीज पे वो और टैरिफ लगा सकते हैं, यूनिवर्सल टैरिफ ऑन ऑटो सेक्टर। नॉट गुड न्यूज़। इंडियन मार्केट भी और ना गिर जाए, जो हैवी वेट्स है मारुति या फिर और बाकी जो स्टॉक्स हैं उनके अगर गिरते हैं तो। यूनिवर्सल टैरिफ इज़ नॉट गुड फॉर इंडिया स्पेशली। होली खेलने नहीं गए? होली खेल तो आ गए, कितना खेलोगे? दिन में खेलोगे, शाम को खेलोगे? यूएस ऑयल का चार्ट एनालिसिस कर दीजिए, एक बार कर देता हूँ फिर से। क्रूड ऑयल हल्का सा गैप अप ओपन हुआ है, नीचे कल वाली लेवल है, वैसे कुछ चेंज नहीं हुआ है। 5756 755 के आसपास सपोर्ट है, ये भी एक सपोर्ट है, थोड़ा वीक था ये, अभी भी होल्ड करके बैठा हुआ है। तो अब नीचे आया है तो इस एरिया पे ट्राई करेंगे, इसको अवॉइड करेंगे। ऊपर देखोगे, ऊपर रेजिस्टेंस कल वाले ही है 15 मिनट टाइम फ्रेम पर। ये एक ऊपर एक रेजिस्टेंस ये बना हुआ है। बाकी एक लेवल मैंने बताया था अभी थोड़ी देर पहले सेलिंग के लिए। प्राइस अगर क्रूड ऑयल का 5827 के नीचे कहीं अगर गिरेगा तो इसमें एक सेलिंग का वापस प्लान रखा जाएगा। इसको चाहो तो अगर कंफ्यूजन हो रहा है तो रिमूव भी कर सकते हो और फ्रेश लेवल पुराने वाले लगा सकते हो, कोई इशू नहीं है। ठीक है, यहाँ नीचे आना चाहिए 5827 के नीचे, तभी सेल करना, अदरवाइज मत करना। बाकी अगर इस लेवल के ऊपर क्लोज कर गया तो फिर ये लेवल सेलिंग का बचेगा ही नहीं, कोई नया लेवल बनेगा तो फिर तब हम ट्राई कर सकते हैं। बाकी एक कल का हाई वाला लेवल भी है रेजिस्टेंस, वैसे वो तो काफ़ी बार टेस्ट हो गया, देखते हैं। ब्रेक नहीं हुआ है तो अभी इंटैक्ट ही रहेगा मार्केट में। सेलिंग के लिए 5827 के नीचे ही सेल होगा, बाकी ऐसा नहीं हुआ तो ब्रेकआउट रीटेस्ट पे बाई कर बैठेंगे। बाकी अभी थोड़ा सा मार्केट ओपन तो हुआ है, न्यूयॉर्क सेशन 5:30 पर ही ओपन होता है, तो स्टिल मार्केट ठीक ही चल रहा है, वॉल्यूम तो ठीक ही है, ऐसा कुछ खास वॉल्यूम चेंज नहीं हुआ है अभी तक।
Well, Stephen, the lift in the markets this morning comes after the S&P 500 slipped into correction territory. The index is down 10% from its all-time high. The tech-heavy NASDAQ 100 index also in a correction. And the Dow Jones Industrial Average is 9.3% below its last record in December. Lauren Goodwin, the chief market strategist at New York Life, says tariff worries are rattling Wall Street.
But there is no doubt that the volatility that we've seen in the market over the last couple of weeks is about policy uncertainty. It's not about economic fundamentals. And what's so interesting about that is typically when we see drawdowns of this size, it's the other way around. There's a concern implicit in the economy about growth or employment, et cetera. This time it's uncertainty causing the concerns about growth and employment.
New York Life's Lauren Goodwin believes markets will remain volatile until some of the policy uncertainty clears.
Investors are the most bullish on treasuries relative to stocks for at least 3 years. That's the findings of the latest Bloomberg Markets Live Pulse survey. US bonds are expected to deliver better volatility-adjusted return over the next month than equities, according to a survey of more than 500 market participants conducted this week. And it's not even close, with 77% backing treasuries. That's the highest level ever in the survey data, going back to 2022.
Well, Stephen, former Treasury Secretary Steven Mnuchin advised investors not to overreact to the current sell-off in equities and discounts risks of a U.S. recession. In an interview with Bloomberg, Mnuchin attributes the market correction to a natural correction in the market fueled by massive tech spending.
We came in with the market being fully priced. So I think a 5 to 10% correction on the S&P or the NASDAQ actually makes sense. The market's been really fueled by massive amounts of tech spending, particularly around AI. So some of this is a natural correction in the market, and some of this is the market worrying about tariffs and the impact on tariffs.
Former Treasury Secretary Steven Mnuchin also discounted risks of a U.S. recession. To hear the full conversation, get the Bloomberg Talks podcast or watch it live on the Bloomberg podcast page.
नैस्डैक का बता दिया मैंने, नैस्डैक में अभी मार्केट के पास रेजिस्टेंस जोन है यहाँ पर जरूर, बट यहाँ पर ऑलरेडी कल 2-3 बार मार्केट रेजिस्टेंस ले चुका है, तो थोड़ा संभल के करो, नहीं तो अगर थोड़ा सा और ऊपर आ जाए 15 मिनट टाइम फ्रेम पे अराउंड 19,580 590 के अराउंड, वहाँ सेल करोगे तो बेटर है, वो लेवल अभी भी टेस्ट नहीं हुआ है। बाकी करंट लेवल भी रेजिस्टेंस बना हुआ है 15 मिनट में, बट दैट इज ऑलरेडी टेस्टेड 3 टाइम, दिस इज द 4th टाइम प्राइस उस लेवल पे आने की कोशिश कर रहा है, तो थोड़ा सा ध्यान रखना। लाइक भी करते रहो guys, don't forget to like the stream.
Each on YouTube.
Well, Karen, as for the global trade war, President Trump is threatening a 200% tariff on European wine, champagne and other alcoholic beverages. Trump says he'll impose the tariffs if the European Union does not immediately remove its countermeasures against his 25% tariffs on steel and aluminium. In an interview heard right here on Bloomberg Radio, Commerce Secretary Howard Lutnick says the EU duties are disrespectful.
The president has made it crystal clear that he finds this tit for tat really abusive and aggravating, right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America because that's important.
Commerce Secretary Howard Lutnick added he's thankful the UK and Mexico refrained from engaging in tit-for-tat tariff hikes and warned trading partners that upsetting President Trump opens themselves to severe reactions.
Well, Stephen, the president of the European Central Bank is warning of severe global fallout from a trade war with the U.S. And here's what Christine Lagarde told the BBC.
If we were to go to a real trade war, where trade would be dampened significantly, that would have severe consequences. It would not be cause for concern. It would be severe consequences for growth around the world and for prices around the world, but particularly in the United States.
But also in Europe. It would push Europe into recession, wouldn't it?
You know what it's doing at the moment? Stirring European energy. It's a big wake-up call for Europe. Maybe this is a European moment yet again.
And Lagarde also told the BBC that Brussels had no choice but to retaliate against the U.S. following its decision to implement 25% tariffs on global steel and aluminum imports.
Well, Karen, if investors think the Fed will step in if tariffs damage the economy, they may be wrong. That's according to the former New York Fed President, William Dudley.
I think the problem is that the tariffs are bad for growth and bad for inflation, which puts the Fed in a bind. Basically, they're missing by more on both sides of their mandate. So I think in the near term, the Fed's going to basically be on hold, waiting for more information.
Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. A lot of college basketball being played, and the big story was at the ACC tournament where Duke is the number one ranked team in the country, and Cooper Flagg is the best player. The star freshman sprained his ankle in Duke's win over Georgia Tech. Duke coach John
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from, U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests. But like I say, in the end, eventually the consumers get to pay higher prices, and that is not in the interest of anybody. So we really try to avoid these things, but of course we see this news coming all the time. I think right now it's important to keep cool heads because we see the statements, and then what it really matters is the actual steps, the legal acts that are done, and then we are also ready to react.
A stupid question or a basic one, but are you confident you know what the U.S. wants when it comes to this trade war? As you watch all of these salvos and escalations, do you know what you could do or might do to appease the President of the United States and end the war that started a few weeks ago?
Well, of course, you have to ask the President of the United States what is their goal regarding this. But what they have been or what they have been saying out is that there is a trade deficit between our countries. It is of course not that big, and we can address this in a different way. But it is how it is. Like I say, we keep a cool head, and of course we are ready to act and defend our interests when we need to.
independent news,
technology news, geopolitical news,
economic news,
financial news,
bringing you the latest news in private markets
whenever,
and wherever it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France, and this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. Today's CFOs focus on much more than revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has.
We're in an evolving business.
Our first job is to intimately understand and anticipate the consumer's needs.
We've been on a journey to be higher growth, more nimble, and more capital efficient.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this spring, only on Bloomberg.
Equity futures on the S&P about 60 minutes out from the opening bell. Session highs now up by 1 full percentage point as we get set to avoid a government shutdown this weekend and open the door for a real conversation about the policy that is friendly for this financial market, and that is tax cuts. Maybe that conversation ramps up in the nation's capital over the next several weeks and months. Equities up on the Nasdaq by 1.4% with some movers going into the opening bell. Here's Yahira Hecker. Say, Yahira.
Hi, John. We start with Peloton shares. Those are up nearly 8% here after the team over at Canaccord upgraded the stock from hold to a buy. They're saying Peloton is the clear leader in the connected fitness industry because of its early investments, as well as a member base that's both established and loyal. Next up, we have shares of DocuSign. Those are up 11% now. The e-signature company delivered strong results. Bloomberg Intelligence saying the growth in billings, including 11% in the fourth quarter, stands out given the economy, because as we know, we have seen signs of business optimism falling, specifically among small businesses. And last up, we have another riser for you, and that is Ulta Beauty. It's up 8.4%. And while it was a mixed picture when it came to results and the outlook, investors seem to be increasingly confident in the new CEO's ability to navigate the competitive beauty market, as well as what they're calling consumer uncertainty. We've heard that one before, of course, but the retailer's saying 2025 is a transition year for them, and investors look to be along for the ride. John?
Stock is up by about 8%. Yahara, thank you. Thanks for this morning. That's the update on the US side of things. Better news. Let's talk about the better news taking place over in Europe as well. Euro-dollar session highs back through 109. We've reported earlier on this morning that the German government getting set to push forward some of the Chancellor-in-Waiting's plans to spend money on defence and on infrastructure as well, coming to an agreement, reportedly, with the Greens. So that's important. Let's hope that happens for the benefit of those of you that have been long European equities and short German debt for the last few weeks. We've also got this news as well from the G7 foreign ministers meeting over in Quebec, coming from the Canadian foreign minister, that ministers are finding common ground on Ukraine. This really echoes what we heard from the NATO Secretary General Mark Rutte about an hour ago, sitting down with Anne-Marie in Washington, D.C., cautiously optimistic on finding an agreement around Ukraine over the next several months.
Yeah, the discussion now heads over to Russia, and a question of how much Vladimir Putin wants to agree with things or not. The initial reporting is that there is a huge asterisk around some of his asks, and there's a question of how far the U.S. will be willing to push the Kremlin to try to come to the table. If this does come through, what does it look like, and how much of a boost does it give to the euro region? And that, I think, is what a lot of people are looking at.
It's given a boost to German yields again, up 8 basis points now on a 10-year maturity, 2.93. Another line from the Canadian foreign minister. We'll keep the pressure on the United States. We're seeking off-ramps on tariffs. So let's talk about trade. Investors assessing the market impacts. Consumers and businesses already readjusting. Torsten Slock of Apollo writing, this is a wait-and-see economy. Consumers are more reluctant. The bottom line is that this eventually leads to a slowdown in the hard data, and markets should prepare for that scenario. Torsten joins us now for more. Torsten, good morning.
Good morning.
We've seen the shift in the soft data. The last time we spoke, you raised the issue, I believe, at least Lisa asked you the question, would that soft data bleed into the hard data? Do you sense a inevitability now towards that?
We are beginning to see that if you look at the high-frequency data. So over the last several weeks, we have seen, and I know some of these indicators are a little bit special, but we've seen the number of people who are going to movie theaters, number of people going to Broadway shows. If you look at the TSA data for how many people fly in airplanes, even if you look at how many people are visiting the Statue of Liberty here in New York City, all that has actually started to weaken. And now we get another soft data print here at 10 with the Michigan sentiment for consumers. So overall, it is still a little bit too early, but given that we have this wait-and-see situation, both for consumers and for corporates, it does make sense that the soft data should eventually begin to spill over to at least some weakening in the hard data.
One feature of this cycle that I think a lot of people underestimated, you not included, is the resilience of this economy. What is our capacity to absorb shocks now? Has that been reduced?
Well, that's a very important question because that depends on the nature of the shocks. And we're facing two shocks at the moment, namely DOGE, which is laying off government workers. Estimates suggest that there will be around 300,000 workers that might be losing their jobs. Remember that for every federal worker, there are 2 contractors, according to Brookings. So Brookings studies show that in total, true employment in the federal government is roughly around 9-10 million people. So if you now think about total number of households is 130 million, and someone in a federal worker or contractor lives together with someone in the private sector, you get that as much as 10-15% of all households in some way or another is being impacted from a sentiment perspective by DOGE alone. And tariffs, of course, also in particular impacts anyone who is associated with trade with Canada and Mexico. And you have that is also a particular, of course, across the border to the north and to the south, playing a significant role in a number of states. So the bottom line is not only tariffs and trade war, it's also the combination of the risk that government workers and contractors potentially losing their jobs that are the main reasons why the soft data is weakening the way it is. And it's not only consumer soft data, it's also corporate. If you look at the CapEx planning from the regional Feds, Dallas Fed, Philadelphia Fed, New York Fed, that's showing that businesses in those districts are saying we're beginning to cut back CapEx plans. Likewise, NFIB, also roundtable surveys, CapEx planning is also moving lower. So both consumer confidence moving lower, corporate confidence moving lower. It is a precursor for a slowdown coming in the hard data.
There's an argument being made that if what was propping up the United States economy was government spending, it wasn't that strong to begin with. And this is actually somewhat of a withdrawal from a sugar high from an incredible amount of fiscal spend in the direct aftermath of the pandemic. Do you buy that?
There is some truth to the detox argument in the sense that if you look at hiring in non-farm payrolls over the last 2 years, 25% of jobs created in 2023 and 24 were government jobs. The previous years, it was like 5-10%, much, much less. So a very significant part of jobs in the last 2 years have been coming from the government sector. So it is true that job growth has been slowing in the private sector, even going into these shocks that we're looking at the moment.
Heading into 2025, you were pretty clear that you think that the inflationary shock was going to be maintained and that it was going to create a real problem for the Fed to actually offer a response to that kind of weakness in the economy. Do you continue to see that, even though the shocks that we're seeing right now to policy might have a bigger ramification on growth than you had previously expected?
Well, the real challenge is that going into tariffs, we had that inflation, unfortunately, was still too high at around 3%. And most calculations suggest that you will add roughly half a percentage point to core PCE as a result of tariffs. So it makes a huge difference where you start. If you start with inflation at 3 and you add 0.5%, of course, the risk is that you will have too much upside and we're way above the Fed's target. Whereas if inflation had started at 1.5, which is where we were in 2016, and you add 0.5%, then inflation would move up towards the Fed's target. So the problem was really that the starting point for inflation when these policies came along was that it was unfortunately well above the Fed's target. So the risk is in this situation that you have inflation moving higher and growth slowing down, which of course is the definition of a stagflationary shock.
We were talking to Mohamed El-Erian earlier this week, and he made the point that given these dual shocks, the Fed should probably allow inflation to run a little bit hotter for a longer period of time and address the growth issues and cut rates at least once this year. Do you agree that that's more prudent at a time where there are these stagflationary forces starting to loom?
Absolutely, because the Fed has the dual mandate. On the one side, if growth is slowing, is saying the Fed should be cutting. If inflation is going up, is saying the Fed should be hiking. I think the Fed will look at if growth starts to slow and if we over the next several weeks begin to see that unemployment begins to go up. Let's not forget that non-farm payroll is always done in the week of the 12th, means this week. So this is the week when they do the survey for the employment report. And if we do believe that this week was somewhat intense on the policy front, then there is, of course, a chance that non-farm payrolls for March could be on the weaker side. And if that's the case, then in the next several weeks, and particularly going into April, and with the April 2nd deadline also from Trump with the reciprocal tariffs, we come to the conclusion that the risk is that we might begin to see growth slow down. And the Fed will say, well, as long as inflation expectations are anchored, yes, actual inflation may be higher, but if inflation expectations are anchored, they will be focusing on growth slowing down. And therefore, the risks are that markets will be pricing in more cuts at the time. And by the way, it looks like from stock markets that they are almost saying, well, the Fed should be cutting many more times, whereas rates markets are saying, no, we only need 2 more cuts. So there's almost an inconsistency between the messaging from stocks that are now in correction territory and rates markets saying, no, we only need 2 more cuts.
In the news conference on March 19th, next Wednesday, how does Chairman Powell address those issues? What are you looking for? So
I'm looking very much for how much he's focusing on the soft data slowing down. He did do that at the US NPF last Friday here in New York City, where he was in his prepared remarks saying, everything is generally okay. But when he was sitting down with Anil Kashyap and asked questions, he was more saying, hey, something is going on that has some downside risks that we maybe should be putting more weight on. So I do think that he will begin to talk about, well, there's softness in the soft data, but maybe we're also worried about softness in the hard data.
We have seen this incremental shift from the November meeting into December. We don't assume, we don't guess, we don't speculate. Then in December, there was some assumptions, some guessing, some speculation. And then I agree with you. The recent address we had from Chairman Powell, there was another subtle shift. Just started to tackle policy issues head on in a way he hadn't done in the previous few months.
And on some level, he kind of has to, because there is a sort of scenario analysis that has to come from the Fed for them to even be relevant about how they're measuring some of these aspects. And that's probably why the Statement of Economic Projections, which could be a dartboard, but is sort of a messaging tool about how they're going to potentially respond to what is transpiring in policy and how it's transpiring in data, even if it doesn't necessarily come to full pass.
The difference now, I guess, is we're actually getting the policy. They don't have to speculate about it anymore. But that policy comes with a lot of volatility. And Torsten, they've got to manage interest rates through the cycle. Maybe Chairman Powell steps down in the next couple of years. I imagine he will. I don't know for sure, but I think we all think he will. I want to understand from that perspective, you sit there and you acknowledge the risks right now, but also you've got to think about tax cuts, the potential for looser regulation further down the road. How do you manage through the cycle with that in mind?
Well, that's why this debate about is it policy dependent, is it data dependent, becomes really, really important, because of course the policy that's in place suggests that, well, so far the 2 things that we have seen from the beginning is DOGE, which is putting the unemployment rate up, and also tariffs, which is putting inflation up. So if that's the case, they need to deal with that shock as the first thing, even, as you say, if there are other policies coming on deregulation, on lower taxes, and potentially also more energy production.
Torsten, Clinic, as always, good to see you, sir. Looking ahead to next week, March 19th for the Federal Reserve, next Wednesday for that meeting, including a news conference and forecasts from the chairman, Jay Powell. Torsten Slok of Apollo. Another read on the US economy coming up a little bit later. UMich consumer sentiment crossing at 10 a.m. Eastern time. Got some data through next week as well. Bloomberg's Mike McKee joins us now to break it down. Morning, Mike.
Good morning, John. Well, Torsten was talking about consumer confidence as a sign that maybe we'll see some reaction in the hard data going forward. And we do have an expectation for a decline again in the Michigan consumer sentiment numbers and a rise in the inflation forecasts from Americans. But is that really going to translate? We'll find out Monday, because we get retail sales. Although these are February numbers, and so the question is, are they reflecting what's been going on in Washington and the new policies of the administration? That's the Fed's dilemma, and we'll be talking with Jay Powell about that, obviously, on Wednesday. Do they have enough information at this point to give you a valid summary of economic projections and a valid dot plot? The Fed officials I've talked to say not really. It is more like Lisa said, a dartboard at this point, because they're still waiting to see how big the tariffs will be, who they'll be on, and how that feeds back into the U.S. economy. So we're still kind of up in the air. And while we will get some hard data next week, it doesn't necessarily reflect what's been going on so far.
Mike McKee on the latest. Thank you, sir. Looking ahead to the data later this morning and the Federal Reserve next week. Need to talk about this right now. Developments over in Germany. So the so-called Chancellor in waiting, Friedrich Merz, holding a news conference right now and indicating the CDU, the SPD, the Greens have reached a deal on a fiscal package and giving some details on what that deal actually includes. A special fund for infrastructure of $500 billion. The infrastructure fund is only for additional measures, getting some details from them in that news conference taking place right now.
Which is the reason why a lot of people are hoping this actually does boost growth, and the reason why you're seeing that type of move in equity markets, but also in bond markets. This is clearly a new German regime where they appear willing and able to get some sort of spending package through. We are seeing German 10-year yields at the highest levels going back to 2023 and rising further.
Yields are up by 7 basis points. It's quite a move we've seen. Ed Al-Husseini of Columbia Threadneedle writing on the global fiscal outlook shifting. Tariffs and Doge shock have had no meaningful impact on the real data so far, but policy uncertainty is likely to continue as long as administration struggles to define wins. Ed joins us now for more. Ed, good morning. Good to see you.
Good morning.
All these details coming out from the US side of things, the European side of things, and stuck in between is the Treasury market. What drives what? What doesn't drive what?
Look, I think we can only focus on one thing at a time in the Treasury market. And the focus so far this year has been a reassessment of growth. And it's been a clear reassessment to the downside. We started the year with growth expectations really nailed to the ceiling. And now I think there's just a broader range of outcomes that's in front of us, and that's what's in the price in Treasuries.
We were just talking to Torsten Slok, who said that right now Treasuries are pricing in maybe 2 rate cuts, saying that's all that's necessary, while stock markets are suggesting a lot more is needed. Who's right?
I think the answer is always they're both pricing the same thing. It's very rare that markets diverge in such a way. We just started from different points. We started from a point where Treasuries were relatively cheap. Stocks were quite expensive, and we've re-rated down, right, about 10% down in terms of stocks, 70 basis points in Treasuries. We're roughly in the right zip code at the moment. And I think, to Thorsten's point, right now the market is waiting to validate some of these expectations, and the expectations are, frankly, a little bit on the negative side.
In terms of growth, in terms of just what we could see going forward. I guess what struck me, and I've been thinking about this the whole week, that it's
a little bit more problematic for the core. Europe has been in this unusual environment where peripheral growth has exceeded growth in the core significantly in the course of the last couple of years. Spain, Italy, Greece, they've seen fantastic levels of growth driven by services. In the core, we've struggled particularly with manufacturing, which is highly interest rate sensitive. So we are not yet at a stage, but we need to have this discussion around.
Okay guys, crude oil में ध्यान रखना है, यहाँ से एक सेलिंग का प्लान है. 7 बजे यूएस मार्केट भी ओपन हो जाएगा, थोड़ी बहुत वॉलेटिलिटी वहाँ पर एक्सपेक्टेड है. बाकी 7:30 पे फिर आपका डेटा ही आ जाएगा. सैमसंग एनवीडिया पार्टनर टू एडवांस एआई इन मोबाइल नेटवर्क.
And the global bond market today, German bonds lower, yields are higher. German politicians coming to an agreement. They'll have to vote on this on Tuesday, I believe. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hecker. So, Yahara.
Hi, John. The Trump administration is tightening sanctions on Russia by restricting payments for energy, even as it pursues a peace agreement between Russia and Ukraine. The White House did not publicly announce or acknowledge the change, which was put in place by the outgoing Biden administration. And we mentioned this story earlier, but worth repeating, an American Airlines plane caught fire at the Denver International Airport. The Boeing 737 made an emergency landing due to engine vibrations, then caught fire while taxiing to the gate. 172 passengers and 6 crew members were safely evacuated. 10 people suffered minor injuries. And Comcast is expanding its partnership with the Olympics. The two have agreed on a deal that extends NBC's media rights for the games through 2036. The $3 billion agreement also elevates Comcast from a media rights holder to a strategic partner. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the week ahead. We'll give you a sneak peek of next week. The headline, though, Chairman Powell, Fed decision March 19th on the Wednesday. And we'll speak to Anne-Marie in just a moment. From New York City, this is Bloomberg.
think a lot of people who come into private credit for the first time, do you think that they maybe misunderstand a few things about the industry, given that it is private and they don't see the marks every day? Do they think that that means that things don't move around much in price, that they are inherently safer?
Don't get me down the marking rabbit hole. I actually think just because an asset class doesn't trade doesn't mean the value of that asset class doesn't actually move. With private credit, the biggest challenge is your ability to create liquidity when you make a mistake is more narrow because you're the owner of that asset, and likely maybe the sole owner of the asset or one of a few people of the owner of the asset. So there's not a lot of people following that asset that can provide you liquidity. So you own all your mistakes. Ultimately, when you generate that return, it's going to be whatever your return is, less losses.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Weekdays at 9 a.m. Eastern, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The open about 37 minutes away. Equity futures positive by 1 full percentage point on the S&P. On the Nasdaq, bouncing back by 1.3. Here's the trading diary through today, through the weekend, and into next week. 10 a.m. UMich consumer sentiment numbers. 12 p.m. President Trump signing another round of executive orders. Later on today, the Senate voting on the spending package. Sneak peek of next week. Retail sales on Monday, Wednesday. The main event, a Fed rate decision and Chairman Powell news conference. Let's touch base down in Washington, D.C. with Bloomberg's Anne-Marie. Anne-Marie, can we go quietly into the weekend?
I think we can now that at least the government's not going to be shut down. But I wouldn't say anything is quiet, especially with Donald Trump back in the Oval Office. Maybe you can expect a few trade headlines. Remember, Jonathan, it was just yesterday that he talked about 200% tariffs on European wine, cheese, and champagne. And I spoke to Mark Rutte, the NATO Secretary General, about this. All this angst in Europe because of the trade story. But there's also debate on whether or not Trump is actually doing more for Europe when it comes to defense. And we're seeing that play out today, with Germany seemingly having an agreement when it comes to spending. And Mark Rutte made it clear to me that his conversation with Trump yesterday, Trump is committed to the alliance and that he's actually helpful and an asset to pushing the Europeans to be able to defend themselves and spend more.
Anne-Marie, appreciate the update. Anne-Marie, thank you. We've said this a few times on this program, Bramo.
Happy Holi to all of you once again. Market is going to open. याद रखना, US market open होने वाला है. होली की सबको शुभकामनाएं. आज जिन लोगों ने बनाए उनको भी, जो लोग कल बनाएंगे उनको भी, जो परसों बनाने वाले उनको भी, जो बना चुके हैं उनको भी. Like भी करते रहो. Don't forget to like the stream.
Attributed green funds and other things as well.
Natural gas support, how strong? ठीक है, मतलब like 60-70% good, 100% is nothing, there. इन्वेंट्री कल आ गई है ऑलरेडी. नो इन्वेंट्री टुडे. 7:30 इज डेटा गोल्ड और सिल्वर के लिए इंपॉर्टेंट है.
People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport. And flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate.
Youth unemployment is an issue in all labor markets.
Canada striking back against President Donald Trump's metals tariffs, slapping 25% levies on over $20 billion of American goods. Canadian officials coming to the bargaining table today. You'll hear from the Finance Minister, Dominic LeBlanc, and the Ontario Premier, Doug Ford, set to meet with the Commerce Secretary, Howard Lutnick. And I'm pleased to say that Commerce Secretary Howard Lutnick joins us now from Washington, D.C. Mr. Secretary, welcome back to the programme, sir. Always appreciate your time. If we could just take a step back and set the table, what are the stakes for today's meeting between you and Canadian officials?
Well, I think the stakes today, if you take a look at it from the big picture, is the United States said we need to have steel and aluminum domestically in America. In national security, you need metals to make bullets, you need metals to make munitions, you need metals to make everything. And Donald Trump is very focused on, let's make sure the key ingredients that are necessary to defend America are made here in America. And these other countries, they just don't pay attention. I mean, how many times do I have to say national security is important? And if you do like the EU and you respond by putting a tariff on Kentucky bourbon, which used to piss off Mitch McConnell, which doesn't really matter anymore, you got to wonder, really, do I have to deal with this stuff? But alas, we do.
Mr. Secretary, let's get to Europe in a moment. Let's just stay on Canada, and then we'll work our way to the EU if we can. For the Canadians, as you know, they've put tariffs on around $21 billion of US goods. Will that change your approach to today's meeting?
Well, I mean, take a look at that again. Let's take a step back. National security, we put a tariff on steel and aluminum to make sure the dumping countries of the world stop and we can build up our steel and aluminum in America. And what does Canada do? They put a tariff on sports equipment. I mean, really, this is just, it's tone deaf. Listen to the president. National security matters when he calls out things like semiconductors. He calls out pharmaceuticals. He calls out autos. These are things that matter to us as a country. And if you're going to respond to us with sports equipment, you're just not listening to President Trump.
Secretary Lutnick, how much are the conversations today actually about bringing up the negotiations when it comes to USMCA? Well,
USMCA, we set aside USMCA. So The United States made a deal with both Mexico and Canada that said if you have enough U.S. content in certain products, or it's actually made domestically, they can trade between our countries tax-free. That remains intact. What is outside of that is both things that don't have that American content that are imported from other countries. So that has a tariff on it. And now the president has said, look, there are certain topics I need to have us make in America. And steel and aluminum is key. I mean, we all understand that. So why not allow the greatest country in the world, who completely feeds Canada? Canada exists, completely feeds off of the amazing economy of the United States of America. Let us build up our steel and aluminum so that we can protect ourselves. And by the way, we protect Canada. I think Canada's got 60 planes. Oh yeah, they're really going to protect themselves. They're the lowest investor in NATO. They totally rely on us, and yet they think they need to respond to steel and aluminum tariffs. I mean, everybody is so used to picking off America, so used to it that they can't even stop. Donald Trump is here to say we need to be treated fairly, and we need to be treated fairly now.
Do you think this approach, if you articulate this to the Canadians today, will help bring down the temperature?
I do. I think once you actually breathe and think steel and aluminum, America needs steel and aluminum. I mean, if you respond like the British didn't respond, the Mexicans didn't respond, you have some countries that actually thoughtfully examine how they do business with us. And then you have people like the Canadians who are in elections, so you have no idea. You think it's about a trade war. This is their way of getting election votes. And the EU, you know, the EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here, and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect, and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it together. We're going to describe our trading policy. We're going to describe our balance. But remember, semiconductors, we need to have them in America. Pharmaceuticals, we need to have in America. Cars, we need to have in America. And steel and aluminum, come on. America, oh, and lumber as well.
And
These
wine
are
and champagne.
important things for our national security.
And the wine and champagne, sir. Don't forget the wine and champagne.
Come on, that's just that. You know, if you make him unhappy, he responds unhappy. But come on, let's get back to the core basics here, which is a trading policy that says America has allowed the world to lean on us, to take from us, to grow off of us, and now it's time for a little balance. We've got a $2 trillion budget deficit. We want to bring certain jobs home. Let the president do the right thing for America. He will respond after we're done organizing things to make sure the world grows. But today, just remember, he's the president of the United States of America. He's not the president of the world. He's going to take care of American workers, and it is time.
Mr. Secretary, I just want to make sure that the audience is in on our little joke there, because they might have missed the post by the president a couple of minutes ago. So I'm going to share it with them and then come back to you in just a second. So the president of the United States put this out on Truth Social moments ago, said the European Union, one of the most hostile and abusive taxing and tariffing authorities in the world, which was formed for the sole purpose of taking advantage of the United States, has just put a nasty 50% tariff on whiskey. If this tariff is not removed immediately, the United States will shortly place a 200% tariff on all wines, champagnes and alcoholic products coming out of France and other EU-represented countries. So, Mr. Secretary, just to bring you in, I imagine you are aware of what the president said based on our conversation just now. Have you given the Europeans a warning on this? Have you given them a time limit to back away? Are you taking the same approach you did with the Canadians just a few days ago?
Well, I think the president has made it crystal clear that he finds this tit-for-tat really abusive and aggravating, right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America, because that's important. And then, you know, they say, okay, we're going to tax whiskey. And look,
क्रूड व्यू ऐसा कुछ नहीं है फिलहाल के लिए, ऊपर रेजिस्टेंस बने हुए हैं, सेल कर सकते हो, नीचे सपोर्ट पे आएगा तो बाइंग कर सकते हैं.
Balancing American trade. We're going to spend lots of time together, but the president was totally annoyed that the Europeans did this. And so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley-Davidson motorcycles?
So you saying this is an emotional response?
It's disrespectful.
Are you saying this is an emotional response, or will we see 200% tariffs on wine, champagne, and alcoholic products before April 2nd, when the president says is the big one, and we're going to get the reciprocal rollout?
Well, the joy of my job is that Donald Trump makes the decisions, right? And the people around him, we talk to him and we advise him. April 2nd is when we do reciprocal tariffs. And he's called out these products. He wants these countries to respect him. And all this showed you is that Europe and Canada do not respect Donald Trump and do not respect America's ability to build its steel and aluminum industry, which is vital for national security, whereas you watched Mexico and you watched the UK be pragmatic and thoughtful, and the way we're going to deal with them is going to be better. So these are just black and white things. Why would you put against steel and aluminum, would you say Harley-Davidson motorcycles and Kentucky bourbon? It's just illogical. I think the president is saying, look, I am going to respond always bigger and always stronger. We will talk together. He wrote that tweet this morning. We will talk together. If that's what he wants to do, we will do that. But the answer is April 2nd, a thoughtful approach to reciprocity and national security of those products he's called out. We're going to increase our domestic production of those and have a reciprocal model. And hopefully when I talk to the Europeans, they'll realize that they should take these things down, cool these things out, and let's properly negotiate.
Do you have plans to speak to your European counterparts today?
Of course.
Like who? Are you speaking to, say, Ursula von der Leyen, or potentially some heads of companies like Bernard Arnault, who was also at the president's inauguration?
Generally, as the Commerce Secretary, I speak to the trade ministers. That's generally how it goes.
But a lot of companies also, and I know executives, have been calling you, sir. Is that not correct? They're looking for exemptions. Exemptions, carve-outs, fall squarely in the Commerce Department.
So let's talk about exemptions for a moment. Steel and aluminum tariffs went in 2018. And when we came back into power, the Biden administration had granted 490,000 exemptions. Imagine 490,000 exemptions to steel and aluminum tariffs. I mean, I don't know that our department could actually collate 490,000 Christmas cards, let alone 490,000 steel and aluminum tariffs. I mean, come on, it's ridiculous. So yesterday, what we did is we just got rid of all the exemptions. That's all we did. The steel and aluminum tariffs were already on. We just said, look, let's just build back our steel and aluminum industry in America to protect America. It's so logical. It's so important. Yeah. And then all we get, you get some countries who understand and some countries who just go right back to old school. And, the president's going to deal with them with strength and with power. And he's remembered that they like to respond with just go after their wine and maybe they'll pay attention and listen. But the fact is, April 2nd, we're going to go with reciprocity, thoughtful, global process.
Secretary Lutnick, it's going to take a while to actually get those tariffs in place after all of the appeals process, et cetera, after April 2nd. And in the meantime, as all of these discussions around tariffs continue, a lot of businesses are just halting investments. You're seeing consumer sentiment decline. You're seeing their spending activity decrease. Can you give them a sense of when they'll have certainty?
The opposite actually is coming true. You saw Apple, $500 billion. You saw SoftBank, $200 billion. Eli Lilly, $40 billion. I'm meeting a company today who sent me a note saying they want to invest $65 billion in America. The scale by which American companies are committed to invest in America, and global companies
Secretary Lutnick,
coming and
excuse
investing
me,
in
what
America
I'm talking
is
about,
huge.
let me explain to you what I'm talking about.
Investments, and those are coming. Well, let me finish. These are huge investments coming to America. Over 1.7 trillion committed in Donald Trump's first 50 days. Anyone who thinks people are uncertain doesn't understand what Donald Trump is saying. He's saying, bring your production to America and you will avoid all the tariffs. Come build in the greatest economy in the world and you will avoid tariffs.
That's maybe long term, but what we're seeing in the short term is that small business confidence has fallen to a 4-month low. They say a high degree of uncertainty about what the regime is going to look like. They talk about increasing likelihood of having to increase prices in response to the tariffs. You're seeing this with respect to airplane tickets that are falling off a cliff as of February. I'm just wondering, when you take a look at these types of indicators, at what point does it become concerning to you?
The greatest deal maker who's ever lived is sitting behind the desk in the Oval Office. He understands that the best way to get our farmers, our ranchers, and our fishermen's produce and products in the rest of the world, which they block it. I mean, India blocks our farmers. All these countries block our farmers. The way to grow it is to make deals with them where they have to understand the power of the U.S. economy is that you need to take our products. We want to unleash American ingenuity and the capacity to export. And when other countries put giant tariffs on our products, let's be clear. You can't go to Europe and see an American car. You can't go to Korea and see an American car. You can't go to Japan and see an American car, but you sure see their cars here. So the concept of Donald Trump saying, hang on a minute, you have got to be kidding. We need to unleash the American economy, and if we've got to teach the rest of the world to treat us with respect, that they've beaten on us and they have abused us, and their tariffs are so high that they've got to actually treat us with respect, bring down their tariffs so that it's reciprocal. Remember, they will never live with us having the tariffs as high as they have them. So what they're going to do is they're going to bring them down. Let Donald Trump run this economy. He knows what he's doing better than any president who's ever sat at that desk. Let him do his job. There's going to be a lot of talking, but in the end, there's going to be the greatest growth economy America's ever seen. We are going to export, and people are going to build in America. Those two things are going to happen, and they're going to happen because Donald Trump's going to create fair trade. Start saying the word fair trade, because right now, trade in America, go look at the numbers, unfair. Europe, huge. India, huge. Right? China, the highest. There's no inflation in these countries. What there is blocking Americans from doing business there, and Donald Trump is going to break down those walls.
Let's talk about China. So we heard from a foreign ministry official in China who said this, that Beijing has done the United States a favor and Washington should have said a big thank you for all they've done to control drugs. And I imagine they're alluding to fentanyl directly. Mr. Secretary, I just wonder if the president has seen those comments in the last 24 hours and what his response is to them.
The president, as we have said, on April 2nd is going to take a holistic approach to everything. March has been the month to reduce the border and fentanyl deaths in America. And I hope to God China's reducing the production of the fentanyl ingredients that kill 75,000 autopsied Americans. And as the president rightly knows, that number is way more. We need China to stop making the ingredients, and we need Mexico and Canada to stop shipping them into our country. That is March. March is very focused on that. Hopefully they'll get down and we'll have a good reduced border. Obviously that's so far so good, but we need to reduce those fentanyl deaths. And then come April, you're going to see us start to focus on lowering tariff away and increasing tariffs at home, so at least we get a little balance. If they want to lower them, reciprocal tariffs mean take them down and we'll keep ours down.
Have they given any indication they're willing to do that? Because you've been ramping up tariffs over the last month on China. Have they given any indication they're prepared to do that? Just to stress test this theory, because tariffs have been ramping up on China over the last 10 years now. Any indication they're willing to actually step back and do what you're asking them to do?
You know, China is always a separate thinking. You know, the Chinese Communist Party thinks about things in a much, much different way than everybody else. And I don't know how they're going to deal with bringing these things down. I would like them to bring it down. They have a huge market. But remember, we consume more than 2 times what they consume. They have a big economy, but they're a production economy. They sell to us. They need to sell to us. We are the greatest consuming economy in the world. We are the customer that everybody in the world needs. Now, they've put huge tariffs in China because they're trying to build up their consumer production domestically. And that's where they stand. So you don't hear all of you talking about how horrible China is and all the inflation in China and all this sort of stuff. It's just not true. The fact is, America is going to build up its industries here, drive down tariffs there. I don't know what China will do, but my expectation is the whole world who trades with us will bring down their tariffs and allow our farmers, ranchers, and seamen, allow our production, allow our car manufacturers to export more and grow. We are looking for fair trade.
Secretary
Fair
Lutnick?
trade. Let's say it over and over again.
We got it. And I think it could maybe be a bumper sticker for you. There are reports this week that potentially underway are plans for Xi Jinping to meet with Donald Trump. Are we expecting a meeting between these two leaders either in the spring or early summer?
I mean, look, the president runs his agenda, but from my perspective, when strong leaders meet each other, that is useful and effective for the world. But Donald Trump will make those decisions himself. I am focused on reciprocal tariffs. On April 2nd, I am not in the agenda of who President Trump decides he wants to meet.
Secretary Lutnick, we're just 2 minutes away from the latest indicator from the United States, which is PPI data and inflation rate and initial jobless claims. You've talked about how the data that we are getting right now is Biden data. At what point does it become Trump data?
I'd say we fully wear the fourth quarter, and we may well wear much of the third quarter. But for fourth quarter, for sure. You know, the American economy, right, a $29 trillion economy. You can't take office on Monday and have the news media say, oh, look what you did on Tuesday. I mean, come on, that's so silly. So the real way the world works is, for sure, the fourth quarter is Donald Trump's quarter, and the third quarter, his policies start to really embed in America. So that's the right way to look at it. First and second quarter are Biden's sort of left behind difficulty, and then you see Donald Trump dig us out, build us up, and by the fourth quarter, you're going to see growth rates because you got all these companies committing to build in America, get their shovels in the ground because we get regulations out of the way, start to produce those jobs, start to bring back trade craft. You know, electricians who build giant factories, HVAC specialists who cool those, and then mechanics who fix robots. You've got tradecraft coming back to America. It's going to be amazing. We're going to have the greatest training program ever because we need to train our great workers for the AI revolution and the tech revolution that is coming, that Donald Trump is bringing to construction and development in America. And we need to train our people, and they're going to have great jobs.
So going forward, do you just look through all of this weakness? You've talked about how, and we've heard a sort of detox period, et cetera. Do you look past all of the data in the first and the second quarters as simply backward looking and look forward to what deals are getting done?
My job is to look forward to what deals are getting done. I'm going to bring in, because Donald Trump has created the policies for me, to bring in enormous investment to the country, $1.7 trillion so far committed. And we're going to put out a website and literally show these companies construction and manufacturing in America quarter by quarter to show this kind of growth. Remember, each trillion of this kind of committed construction is worth 1 point of GDP. So at 2 trillion, which we definitely will have for sure, that's a half a point of GDP for all 4 of his years. So as that grows, you're going to see that growth come into our GDP numbers. Obviously not today. Someone says, I'm going to build 65 billion in America. When can they get in the past, it would take 1.5 years to get the permits to build. Under Donald Trump, it's going to take less than 6 months. They're going to be in the ground this year, and the fourth quarter, you're going to see this power. So, yes, do I have to say the first quarter is surely Biden, the second quarter is Biden, but starting the third quarter, you start to feel some Donald Trump, and the fourth quarter, you will feel the power of Donald Trump's economy.
Secretary Lutnick, I'm sure you've seen this report in Politico. It says that White House officials, Trump outside allies are, quote, growing increasingly frustrated with you, sir, privately complaining about the close proximity.
You got to stop the fake news. Please,
hold on.
God,
no, I want to give you the chance, sir, to respond to this.
Stop the fake news. I don't want to respond. When you read fake news, okay, I spoke to the president last night. He said, why do these people write this fake news? It's just nonsense. Imagine Jameson Greer, who's our USTR, who
Canada striking back against President Donald Trump's metals tariffs, slapping 25% levies on over $20 billion of American goods. Canadian officials coming to the bargaining table today. You'll hear from the Finance Minister, Dominic LeBlanc, and the Ontario Premier, Doug Ford, set to meet with the Commerce Secretary, Howard Lutnick. And I'm pleased to say that Commerce Secretary Howard Lutnick joins us now from Washington, D.C. Mr. Secretary, welcome back to the programme, sir. Always appreciate your time. If we could just take a step back and set the table, what are the stakes for today's meeting between you and Canadian officials?
Well, I think the stakes today, if you take a look at it from the big picture, is the United States said we need to have steel and aluminum domestically in America. In national security, you need metals to make bullets, you need metals to make munitions, you need metals to make everything. And Donald Trump is very focused on, let's make sure the key ingredients that are necessary to defend America are made here in America. And these other countries, they just don't pay attention. I mean, how many times do I have to say national security is important? And if you do like the EU and you respond by putting a tariff on Kentucky bourbon, which used to piss off Mitch McConnell, which doesn't really matter anymore, you got to wonder, really, do I have to deal with this stuff? But alas, we do.
Mr. Secretary, let's get to Europe in a moment. Let's just stay on Canada, and then we'll work our way to the EU if we can. For the Canadians, as you know, they've put tariffs on around $21 billion of US goods. Will that change your approach to today's meeting?
Well, I mean, take a look at that again. Let's take a step back. National security, we put a tariff on steel and aluminum to make sure the dumping countries of the world stop and we can build up our steel and aluminum in America. And what does Canada do? They put a tariff on sports equipment. I mean, really, this is just, it's tone deaf. Listen to the president. National security matters when he calls out things like semiconductors. He calls out pharmaceuticals. He calls out autos. These are things that matter to us as a country. And if you're going to respond to us with sports equipment, you're just not listening to President Trump.
Secretary Lutnick, how much are the conversations today actually about bringing up the negotiations when it comes to USMCA?
Well, USMCA, we set aside USMCA. So the United States made a deal with both Mexico and Canada that said if you have enough U.S. content in certain products or it's actually made domestically, they can trade between our countries tax-free. That remains intact. What is outside of that is both things that don't have that American content that are imported from other countries. So that has a tariff on it. And now the president has said, look, there are certain topics I need to have us make in America. And steel and aluminum is key. I mean, we all understand that. So why not allow the greatest country in the world, who completely feeds Canada? Canada exists, completely feeds off of the amazing economy of the United States of America. Let us build up our steel and aluminum so that we can protect ourselves. And by the way, we protect Canada. I think Canada's got 60 planes. Oh yeah, they're really going to protect themselves. They're the lowest investor in NATO. They totally rely on us, and yet they think they need to respond to steel and aluminum tariffs. I mean, everybody is so used to picking off America, so used to it that they can't even stop. Donald Trump is here to say we need to be treated fairly, and we need to be treated fairly now.
Do you think this approach, if you articulate this to the Canadians today, will help bring down the temperature?
I do. I think once you actually breathe and think steel and aluminum, America needs steel and aluminum. I mean, if you respond like the British didn't respond, the Mexicans didn't respond, you have some countries that actually thoughtfully examine how they do business with us. And then you have people like the Canadians who are in elections, so you have no idea. You think it's about a trade war. This is their way of getting election votes. And the EU, you know, the EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect, and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it together. We're going to describe our trading policy. We're going to describe our balance. But remember, semiconductors, we need to have them in America. Pharmaceuticals, we need to have in America. Cars, we need to have in America. And steel and aluminum, come on. America, oh, and lumber as well.
And wine and champagne.
Important things for our national security.
And the wine and champagne, sir. Don't forget the wine and champagne.
This, come on, that's just that. You know, if you make him unhappy, he responds unhappy. But come on, let's get back to the core basics here, which is a trading policy that says America has allowed the world to lean on us, to take from us, to grow off of us, and now it's time for a little balance. We've got a $2 trillion budget deficit. We want to bring certain jobs home. Let the president do the right thing for America. He will respond after we're done organizing things to make sure the world grows. But today, just remember, he's the president of the United States of America. He's not the president of the world. He's going to take care of American workers, and it is time.
Mr. Secretary, I just want to make sure that the audience is in on our little joke there, because they might have missed the post for the president a couple of minutes ago. So I'm going to share it with them and then come back to you in just a second. So the president of the United States put this out on Truth Social moments ago, said the European Union, one of the most hostile and abusive taxing and tariffing authorities in the world, which has formed for the sole purpose of taking advantage of the United States, has just put a nasty 50% tariff on whiskey. If this tariff is not removed immediately, the United States will shortly place a 200% tariff on all wines, champagnes and alcoholic products coming out of France and other EU-represented countries. So, Mr. Secretary, just to bring you in, I imagine you are aware of what the president said based on our conversation just now. Have you given the Europeans a warning on this? Have you given them a time limit to back away? Are you taking the same approach you did with the Canadians just a few days ago?
Well, I think the president has made it crystal clear that he finds this tit-for-tat really abusive and aggravating, right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America, because that's important. And then, you know, they say, okay, we're going to tax whiskey. And look, I find all this back and forth really off the topic. The key topic is rebalancing American trade. We're going to spend lots of time together, you know, but the president was totally annoyed that the Europeans did this. And so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley-Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Are you saying this is an emotional response, or will we see 200% tariffs on wine, champagne, and alcoholic products before April 2nd, when the president says is the big one and we're going to get the reciprocal rollout?
Well, the joy of my job is that Donald Trump makes the decisions, right? And the people around him, we talk to him and we advise him. April 2nd is when we do reciprocal tariffs. And he's called out these products. He wants these countries to respect him. And all this showed you is that Europe and Canada do not respect Donald Trump and do not respect America's ability to build its steel and aluminum industry, which is vital for national security, whereas you watched Mexico and you watched the UK be pragmatic and thoughtful, and the way we're going to deal with them is going to be better. So these are just black and white things. Why would you put against steel and aluminum, would you say Harley-Davidson motorcycles and Kentucky bourbon? It's just illogical. I think the president is saying, look, I am going to respond always bigger and always stronger. We will talk together. You know, he wrote that tweet this morning. We will talk together. If that's what he wants to do, we will do that. But the answer is April 2nd, a thoughtful approach to reciprocity and national security of those products he's called out. We're going to increase our domestic production of those and have a reciprocal model. And hopefully when I talk to the Europeans, they'll realize that they should take these things down, cool these things out, and let's properly negotiate.
Do you have plans to speak to your European counterparts today?
Of course.
Like who? Are you speaking to, say, Ursula von der Leyen or potentially some heads of companies like Bernard Arnault, who was also at the president's inauguration?
Generally, as the Commerce Secretary, I speak to the trade ministers. That's generally how it goes.
But a lot of companies also, and I know executives, have been calling you, sir. Is that not correct? They're looking for exemptions. Exemptions, carve-outs, fall squarely in the Commerce Department.
So let's talk about exemptions for a moment. Steel and aluminum tariffs went in 2018. And when we came back into power, the Biden administration had granted 490,000 exemptions. Imagine 490,000 exemptions to steel and aluminum tariffs. I mean, I don't know that our department could actually collate 490,000 Christmas cards, let alone 490,000 steel and aluminum tariffs. I mean, come on, it's ridiculous. So yesterday, what we did is we just got rid of all the exemptions. That's all we did. The steel and aluminum tariffs were already on. We just said, look, let's just build back our steel and aluminum industry in America to protect America. It's so logical. It's so important. Yeah. And then all we get, you get some countries who understand and some countries who just go right back to old school. And, you know, the president's going to deal with them with strength and with power. And he's remembered that they like to respond with just go after their wine and maybe they'll pay attention and listen. But the fact is, April 2nd, we're going to go, April 2nd, we're going to go with reciprocity, thoughtful, global process.
Secretary Lutnick, it's going to take a while to actually get those tariffs in place after all of the appeals process, et cetera, after April 2nd. And in the meantime, as all of these discussions around tariffs continue, a lot of businesses are just halting investments. You're seeing consumer sentiment decline. You're seeing their spending activity decrease. Can you give them a sense of when they'll have certainty?
The opposite actually is coming true. You saw Apple, $500 billion. You saw SoftBank, $200 billion. Eli Lilly, $40 billion. I'm meeting a company today who sent me a note saying they want to invest $65 billion in America. The scale by which American companies are committed to invest in America and global companies.
Secretary Lutnick, excuse me, what I'm talking about,
huge,
let me explain to you what I'm talking about.
Investments, and those are coming. Well, let me finish. These are huge investments coming to America. Over 1.7 trillion committed in Donald Trump's first 50 days. Anyone who thinks people are uncertain doesn't understand what Donald Trump is saying. He's saying, bring your production to America and you will avoid all the tariffs. Come build in the greatest economy in the world, and you will avoid tariffs.
That's maybe long term, but what we're seeing in the short term is that small business confidence has fallen to a 4-month low. They say a high degree of uncertainty about what the regime is going to look like. They talk about increasing likelihood of having to increase prices in response to the tariffs. You're seeing this with respect to airplane tickets that are falling off a cliff as of February. I'm just wondering, when you take a look at these types of indicators, at what point does it become concerning to you?
The greatest deal maker who's ever lived is sitting behind the desk in the Oval Office. He understands that the best way to get our farmers, our ranchers, and our fishermen's produce and products in the rest of the world, which they block it. I mean, India blocks our farmers. All these countries block our farmers. The way to grow it is to make deals with them where they have to understand the power of the U.S. economy is that you need to take our products. We want to unleash American ingenuity and the capacity to export. And when other countries put giant tariffs on our products, let's be clear. You can't go to Europe and see an American car. You can't go to Korea and see an American car. You can't go to Japan and see an American car, but you sure see their cars here. So the concept of Donald Trump saying, hang on a minute, you have got to be kidding. We need to unleash the American economy, and if we've got to teach the rest of the world to treat us with respect, that they have beaten on us and they have abused us, and their tariffs are so high that they've got to actually treat us with respect, bring down their tariffs so that it's reciprocal. Remember, they will never live with us having the tariffs as high as they have them. So what they're going to do is they're going to bring them down. Let Donald Trump run this economy. He knows what he's doing better than any president who's ever sat at that desk. Let him do his job. There's going to be a lot of talking, but in the end, there's going to be the greatest growth economy America's ever seen.
Is becoming more important, so the world has to be prepared for it. So there.
We've got a deteriorating fiscal situation here, and slow economic growth and tariffs will only make it worse.
We don't know what the pass-through of expected and actual tariffs.
What the market is playing now, in particularly the last week and a half, is increasingly recession fears.
The uncertainty is the more immediate threat, and I think it's more likely that we'll come out of this with just a slowdown.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, looking for some relative calm after snapping a 2-day losing streak in yesterday's session. Equity futures struggling to build on those gains as Washington heads towards a government shutdown.
Funding the government should be a bipartisan effort, but Republicans chose a partisan path, drafting their continuing resolution without any input from congressional Democrats. Because of that, Republicans do not have the votes in the Senate to invoke cloture on the House CR.
Senate Democratic leader Chuck Schumer pledging to block the Republican spending bill heading into a weekend deadline, teeing up a busy 24 hours in the nation's capital. Commerce Secretary Howard Lutnick set to meet with the Ontario Premier Doug Ford later on today, attempting to bring down the temperature with Canada.
When the biggest client, the biggest trading partner, the most important counterparty you have, who really matters to you, the first thing you do is show immeasurable respect. Say thank you.
You say thank you. Secretary Lutnick joining us a little bit later on this morning, 8 o'clock Eastern Time, 2 hours from now. That meeting, front and center.
The question of can they bring down the temperature, and is this still a drug war? Are we moving into the April 2nd question of actually the new tariff regime at a time when a lot of people are saying, just tell us what the ultimate goal is. Maybe this is a feature, not a bug, but a real question of when it starts to matter that confidence is getting affected.
Who should be saying thank you to who? Because the Chinese foreign ministry officials official came out in the last 24 hours saying exactly the same thing about the United States, that somehow the US should be saying thank you to China.
That's definitely not going to happen anytime soon. And what China was talking about said they've been cracking down on the product, the particles that go into fentanyl. But I don't see that happening anytime soon, even though there are reports, Jonathan, that maybe there is planning for a meeting between Trump and Xi in the spring and in the summer. When it comes to this meeting with Canada, what I will say is that what you heard from Canada yesterday is that Doug Ford met with Mark Carney. They said they're not backing down, and they will go dollar to dollar, tariff for tariff with the United States.
So they've put new tariffs on $21 billion of US goods. And my question for Commerce Secretary Howard Lutnick later on this morning will be, does that change your approach to this meeting? Does this meeting even happen? What happens when this conversation starts? Is that the first thing you bring up?
What's the goal of this meeting? Is it to have them take off any potential tariffs? Is it sort of one ultimate goal when it comes to drug war? Look, I think it's important for the market and for consumers to understand exactly what the off-ramps are at a time when we seem to have a never-ending ratcheting up of tensions. And you have to wonder if the response to even good news is tempered that much more in markets as a result of this ongoing turn that we just keep expecting.
So a great example of that, and I'm sure you're alluding to it, is CPI yesterday. CPI comes out, downside surprise. What do bonds do? Yields rise. They fell initially, and then they started to climb. The attention of this market is firmly elsewhere.
So there are a couple of different interpretations of this. On one level, you could just say the bond and stock markets are singing from two different hymnals. On one hand, the stocks are optimistic that the best case scenario will come out, and the bonds are the worriers that are sitting around saying, this is all looking a little scary to me. If you look at the actual components of CPI, the components that go into the core PCE, which is what the Fed looks at, weren't that much softer. So some people looking at the actual details, but on a larger sense, worries very much shifted to tariffs, very much worried to growth, and very much worried to the deficit, which alludes to the potential government shutdown.
The next data point we're looking for, 8:30 Eastern time. We're looking for PPI and jobless claims. This deadline for a government shutdown. I ignore it, and all of a sudden, you've got to start paying attention. Are we paying attention now?
We're definitely paying attention, but you might be able to ignore it. There's really two paths here. One, it could be political posturing. They want to invoke cloture. Maybe they can do that. If the Republicans say, we're going to give you a vote on an amendment, that would be political theater, according to Jake Sherman. The other scenario is the Democrats hold firm, and we are in a shutdown after midnight on Friday.
Big 24 hours coming up in the nation's capital. Big 60 minutes coming up on this programme. We'll catch up with John Stolfus of Oppenheimer, staying bullish on equities. Ed Mills of Raymond James as Canada strikes back against Trump's tariffs. And Greg Deco of EY on upside risk to inflation. We begin this hour with stocks struggling to build on yesterday's gains as growth worries linger on Wall Street. John Stolfus of Oppenheimer staying bullish, writing, we remain positive on equities. The broad rotation which began in the rally from the S&P 500 low on October 27, 2023 has repeatedly deflated volatility. John joins us now for more. John, good morning.
Good morning.
Good to see you, sir. Does the policy changes, does the policy uncertainty change your view at all?
No, it doesn't. In fact, we would say, if anything, the policy uncertainty takes us to say, well, this is just about what you would expect. This is something, it's Monty Python used to say, and now for something completely different, if you consider the difference between the prior administration and this administration. We can't help but think, it's very natural. The prospect of tariff wars that could last is very concerning, to business, to the consumer, and to governments alike on all borders. But we can't help but think that this is a process. This is the first president. And by the way, I'm not an apologist for the Trump administration, nor was I for the Biden administration. This is politically agnostic. It's a business person talking. When we look at it, for 80 years now, the U.S. has, in effect, had a very lax policy towards dealing with tariffs against our products. For decades, we have now exported our production, and the result of that is the rest of the world are the producers and we're the consumers, and without us, those other countries would suffer significantly. They have overcapacity in Asia, in Europe, they have overcapacity in Latin America. This is, for years, we have been building up, the world has been building up capacity to export to the U.S.
We can park the politics. I think you just have to focus on the policy and the objectives. And the objective is pretty clear, given everything you've said. Rebalance the U.S. economy, rebalance the global economy for that matter, and accept, in their own words, some disruption, a detox. What does that mean for markets?
Well, I think what it means is we're going to be affected very much by an increase in volatility. That's quite natural. We think the way to weather it is with prudent diversification that meets the needs, objectives, and the tolerance to volatility for an investor or an institution's mandate. But it's not something that is indigestible. If anything, it's something that has to be digested at this point, because it's the first time we've ever seen an administration not kick the can down the road in terms of the cost of government versus services actually rendered, the tariff regimes around the world, and could actually, once people can meet at a table and cooler heads prevail, I think work out pretty well. The initial part, there's a lot of political jostling. You know, everybody is working to get their constituency to say, stand up for us, and whichever side it is. But once you get over that human lack of ability to get to down to brass tacks quickly, once you get to it, I think we get to a much better situation in a re-globalization, which should be good for both developed and emerging markets.
To be clear, I think a lot of people would agree with you, and a lot of people in the business community would agree with you as well, particularly in the United States, who have alluded to exactly what you're talking about. The issue is the near-term volatility of headlines and the path to get there, some of the negotiation tactics that are making people concerned about how long it might take to actually get to that place. You say that you need to right-size expectations for how certain assets will respond to volatility. Does that basically mean that you think that they should lower their expectations for a whole host of different assets?
We would say it being realistic, it's like near-term lower expectations, and understand, for example, the sell-off that we'd seen in the financial stocks, for example, let alone what we saw in technology. Well, they had a phenomenal run last year, so a good place for a haircut or a trim or even a correction would be amongst those two sectors and others. So just live with it rather than dump and run. You stay with it, you're diversified, know what you own, know why you own it, and have right-sized expectations. And like us, you might be pleasantly surprised over the course of a 40-year career.
Well, when you talk about diversification, it's taken on a different meaning over time.
Yes.
There was a question around bonds diversified. There was a question around whether gold was the ultimate diversifier. There was a question with geographies versus sectors. How has your understanding of what it means to be diversified changed in an era where there are some pretty seismic changes going on from the policy perspective?
I would say diversification today, the approach should be very much like one that is parallel to the one in fixed income, which is considered duration. Here it would be the duration of the need. In other words, are your objectives long-term for retirement? Are you a retiree who is a relatively young retiree? How long are you going to need to be exposed to equities to have, based on history, have a greater ability to keep your standard of living? And so we are really at a point now where, the old days when the private investor would appear, they were usually the retail investor. It was cocktail party stocks that they would talk. Now today, people invest for need because they recognize the fact that things like Social Security will likely not be anywhere near the benefit percentage-wise what it once was for their parents or their grandparents.
When we have this policy uncertainty, though, and we see that bleed into the markets, we see pullbacks, are you advocating people buy more?
Yeah, we actually are advocating dollar cost averaging. We don't say buy the dips, but we say buy the babies that get tossed out with the bathwater. The type of volatility that we are seeing now, we have seen parallels to it in the great financial crisis, in COVID. Remember when COVID struck? I'll never forget in April of what was it? April of 2020, wasn't it? Yeah, April of 2020, you had some of the smartest people in the world on shows saying it could be decades before they find a cure for this deadly virus.
Is that how they all sounded?
Well, it did to me, and then we had, at that time, Trump was in the White House, and he said something to the effect of, well, we could have, in his own inimitable voice, I'm not going to get to imitate the president, but he said we could get drugs in warp speed, and within a short period, relatively speaking, we had it. We don't wear masks today.
We had a lot of fear, though, cross-asset, and you saw that in credit, too.
Yes.
You could make the argument this morning you don't see that in credit at the moment. I think it was Jonathan Krinsky yesterday of BTIG who said that market bottoms need doubt. Do you think there is sufficient doubt that you can buy this morning?
You know, I wouldn't back up the truck, but I don't have any problem with layering in at this point.
Where would you layer in? Because there are a lot of babies, to use your words, that have been tossed out. Tesla, Palantir, Nvidia, the list goes on and on. Even Apple was struggling yesterday. Where are those babies?
Well, okay, as you know, because I manage money at Oppenheimer, they don't let me pitch
just
stocks,
describe
but
the
I give you the
opportunity.
sectors.
Sure, please.
Information technology, communication services, which has the search engines, the streamers, and the social media. I would also be looking at a consumer discretionary. The American shopper persists at shopping, even though now at discount, private label perhaps, but still shopping. Businesses are still doing what they're doing. And so we would look at financials and the industrials. You know, the industrials are so well positioned to take us into the next chapter of AI, industrial equipment that needs to be advanced to create all kinds of developments in terms, whether it's the electric grid, whether it's medicine, whether it's just in finance, what it can do to help us get through all the data that gets produced.
What about the travel names, John? Given the downgrades we've seen from the airlines earlier this week, what about the travel names?
You know, I would have to say that's not surprising. Airlines have been remarkably strong for a fairly long period of time. You know, we've never been big fans of airlines, whether we're at the airport or whether we're considering what to buy, only because of the nature of that business and the ability of the traveler to suddenly stop traveling abruptly or keep traveling much longer, the ability to charge ridiculously high fares. You know, still, I haven't been to Europe in years now.
Why do you point to me?
COVID.
It's getting expensive. It's Lisa's fault.
But my point is what happens is we need to see more competition come in, and that's going to hurt earnings.
What's the old joke? The fastest way to become a millionaire? Start with $1 billion, buy an airline? Something like that.
There you go. And I think Buffett learned that years ago at one point. I can't think of it. Was it U.S. Air, or there was some airline that Buffett took a position and he limped away from it, which he rarely limps away from.
A lot of people have been burnt over the decades, that's for sure. John, it's good to see you. As always, appreciate it. John Stolfus there of Oppenheimer. This just drops from Torsten Slok over at Apollo. He calls it a wait-and-see economy. And he says that in a wait-and-see economy, eventually it leads to a slowdown in the hard data. Markets should prepare for that scenario. So just an alternative view compared to what we just heard from John, just drop in from the team over at Apollo.
Yeah, and we'd heard about small business confidence dropping to a 4-month low and some of the internals of that. Torsten points out that those small businesses account for about 80% of total U.S. employment. So you will see it if that lack of confidence and lack of action does continue.
Look out for jobless claims later this morning as well at 8:30 Eastern Time, a few hours from now. Equity futures just about unchanged on the S&P 500 with an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. U.S. Senate Democratic leader Chuck Schumer says his party will block a Republican spending bill to avert a government shutdown on Saturday. Schumer urged the GOP to accept a Democratic plan to provide a month of interim funding instead. Let's get a check on the shares of Intel, up 11.5% in the pre-market. The company named Lip-Bu Tan as its new CEO. The former board member and semiconductor veteran has a large task ahead of him: restore the fortunes of a pioneer chip maker that's become an industry laggard, struggling with market share losses and manufacturing setbacks. 2 NASA astronauts stuck in space will have to wait a little bit longer to get home. A launch pad problem prompted SpaceX to delay a flight to the International Space Station. The new crew needs to get to the International Space Station before Butch Wilmore and Suni Williams can head home after 9 months in orbit. And that's your brief, John.
Danny, thank you. You know my position on this story. It should be the biggest story in the nation.
We still have 2 people stuck in space.
How many people actually know their name, though? Butch and Suni.
Yeah.
How many people actually know that?
I know, but can you say their last names?
No, I can't.
Yeah, I can't.
No, they should be household names.
I know, it's true. And what are they doing in there? I want to know. How are they spending their time for 9 months up in space?
With great difficulty, I imagine, given they were meant to go up there for a few weeks. Got to figure this out. Up next on the programme, Canada fights back.
The government of Canada, following a dollar-for-dollar approach, will be imposing 25% reciprocal tariffs on an additional $29.8 billion of imports from the United States.
To my European colleagues, we will work together to put pressure to end these tariffs against you too.
So it's a team effort now. Ed Mills of Raymond James joins us next to break it down from New York City this morning. Good morning.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Snapping a two-day losing streak in yesterday's session. This morning, just about unchanged on the S&P 500. Over in the bond market, yields up a single basis point. The 10-year, 432.39. Later this morning, PPI data and jobless claims as well. Two data points to look for at 8:30 Eastern Time. Under surveillance this morning, Canada fights back.
The government of Canada, following a dollar-for-dollar approach, will be imposing 25% reciprocal tariffs on an additional $29.8 billion of imports from the United States.
This is going to be a day-to-day fight. To my European colleagues, we will work together to put pressure to end these tariffs against you too.
A united front. Here's the latest. Canada striking back against the United States with new levies taking effect today. Canadian officials set to meet with Commerce Secretary Howard Lutnick as they seek an off-ramp to the trade war. Let's get to the team coverage with Bloomberg's Tyler Kendall in Washington. Divya Balji in Toronto. Divya, I want to come to you first and just try and understand the position of the Canadians as they get set to sit down with the Commerce Secretary. What's their approach to this meeting?
Yeah, I mean, I think it is quite clear that they would love to bring down the temperature. I mean, even Lutnick has said that. I think if it's possible to completely not have these tariffs in place, I think they would really love to do that. But I think there is also a response or an approach here where if the U.S. is going to do this, then we are going to fight back. And I think that's how they're looking at it. When you look at the way they've done things so far, the initial tariffs that took place at the start of March, then they came back and retaliated. Then again, now with steel and aluminum, there is still a whole bunch of goods that they have said they plan on putting tariffs on in a few weeks, lead down this path if we have to go through it. So if they can bring down the temperature, they will. But if they can't, they're going to go ahead and continue along this ride, essentially.
Tyler, when it comes to the U.S. response, yesterday the president says there's no inconsistency when it comes to his tariff regime. He says he has the right to adjust, and he says he's calling it flexibility. Will the Americans be flexible today?
Right. And Anne-Marie, also important to note that Prime Minister-elect Mark Carney said yesterday that he's ready to have a call with President Trump, but only if the White House respects Canada's sovereignty. As we start to hear senior administration officials this week again repeat the claim that they'd like to see Canada the 51st state, something Canadian officials have said is very disrespectful. But we haven't gotten really any indications from the White House that a call is being scheduled or put on the books, which leads us to believe that this really is just the first step here to try to get these members of Canada's ministry, including the finance and the industry minister here in Washington today. And President Trump, you said it there. He said that there will be flexibility. That's why he's moving with these different targets. But he also said that there will be very little flexibility once those April 2nd reciprocal tariffs come around.
Tyler Kendall alongside Divya Balji. To the two of you, thank you. Big meeting coming up later on in the nation's capital. Joining us now to discuss is Ed Mills of Raymond James. Ed, welcome to the programme. I think we've all been slightly confused around the objectives. Let's talk about what the ultimate objective actually is. It started out by being about the northern border, fentanyl, immigration, and then it became about dairy access all over again, and then also in between something about becoming a 51st state. What is the overall objective here?
So I think what we're seeing here.
I think we've lost that connection with Ed Mills of Raymond James just as it started. But I think that's the conversation we've got to have with the Commerce Secretary later on this morning, who, by the way, if you are just tuning in, joined us in about 1 hour and 40 minutes' time. That's going to be one of the early questions. What is the objective? What does the President want? What are the demands for the Canadians that you're set to articulate later on today?
How much really is this still about drugs and not necessarily about a whole host of other issues that are supposed to be unveiled on April 2nd? And right now, people are trying to understand the tea leaves so that they can get in and make plans at a time where they've got ships on the sea coming in and they don't know how many tariffs they're going to ultimately be paying on that.
I look at what the president said yesterday when he said, I'm not not going to be inflexible. I can change my position. I have a right to adjust, except Tyler put a great point at the end. Until April 2nd, when you get this reciprocal tariffs. So the conversations today, are they about potentially what's to come on April 2nd? Also, are they about just front-loading, bringing forward the USMCA renegotiation talks? Are they trying to get ahead of that now so the administration can focus on other things next year?
This was not on my bingo card coming into 2025. I didn't think we'd be spending this much time trying to work out the trade situation with the Canadians. I think we all had a good feeling that it was probably going to be Mexico because of what was happening at the southern border, but also how the Chinese had been using Mexico as a back channel to get around some of the tariffs that they'd been put on the country over the last several years. But Canada really wasn't top of the list for anybody.
And it wasn't top of the list that suddenly Donald Trump would be responding to sort of a tit for tat with respect to the Ontario mayor. The idea that Howard Lutnick on a recent interview came out and said that the 50% was trying to get a guy's attention in Ontario. So there's this difficulty in understanding strategy versus goal at a time when you're seeing that start to bleed into confidence. That said, a lot of people agree that there is still time to give confidence to businesses that haven't materially laid people off or made big decisions. But that clock is ticking.
When it comes to strategy, it's interesting. Howard Lutnick in this previous interview was talking about the fact that they like the way Mexico has gone about it. They said the Mexican president has been very classy, getting on the phones, doing the right things. They haven't seen that from Canada. How much is this about what he calls just Canada saying thank you? Maybe Mexico behind the scenes said, thank you.
Well, they've been going through a leadership contest, so they've got their own problems domestically in Canada right now. I think another curiosity for us all, perhaps not for Commerce Secretary Howard Lutnick later, is where this leaves the Conservative leader in Canada, Pierre Poilievre, who had a lead of something like 20 points over the Liberal Party going into this trade mess of the last 4, 5, 6 weeks. They have really turned things around in Canada off the back of this trade story, and they being the Liberal Party.
Which suddenly now Mark Carney is in the lead and is likely to take over. A question more globally about how much this is the case. We're seeing this in Germany. We're seeing this more broadly in Europe. Some of the sort of old school establishment coming to the fore as the main voices to try to get unity for the regions.
Up next on the programme, we'll talk about the economic data later on this morning. PPI data after getting a softer read on CPI, and then later as well, jobless claims in America. Will we see any weakness start to creep into the labour market? We'll get the view of Greg Deco of EY from New York City. This is Bloomberg TV. Equity futures on the S&P 500 just about turning positive this morning by not even 0.1%. Yesterday snapping a two-day slide on the S&P 500. There's nothing too convincing about any of this, though, at the moment. On the Nasdaq 100, just about unchanged. In the bond market, so yesterday, CPI comes out. Downside surprise. Initially, yields fall back, and then they start to climb again. They're up again this morning on a 10-year by 2 basis points, 432.96. There is a takeout there. I think a lot of economists concluding that when we go into the Federal Reserve meeting next week, yes, on the margin, a softer CPI brings some comfort, but the attention, the forward-looking attention is firmly elsewhere.
Especially because some of the components that led to CPI softening are what we already know. American Airlines, Delta, United, airplane tickets have been coming down, travel costs have been coming down. At the same time, other parts of that report really were sticky. And so it leaves today's PPI as very much front and center about whether the Fed actually is looking at a better than expected inflation print on their core PCE or not. And that actually is going to be important.
I wonder if we could perhaps go one step further and suggest just this question, whether events elsewhere, Germany specifically, limit the ability of yields to drop too much in the United States. I just wonder if that puts a floor under the Treasury market at the moment, because what you're seeing in Germany is so profound. The regime shift is so large that it's dragging yields higher worldwide.
We've asked people this question, and everyone has a different answer. Some people say, yeah, absolutely. You have more debt sloshing around in the world and more demand to use your dollars. Well, guess what? You're going to see higher yields. And other people say it might just suck assets from everywhere else. And remember those money market accounts, they've got to go somewhere. So, there are a lot of counter discussions around this. Either way, the bond market is picking up something that maybe the stock market just isn't.
It sounded like a bullish Southside strategist for about 2 seconds.
I can pretend.
Yeah, that money's got to go somewhere with that money on the sidelines.
How much we hear that all the time?
All the time,
check out the money market accounts. There are $50 trillion out there on the sidelines.
It's amazing. It'll buy all the stocks.
Yeah.
Equities right now, just about positive. on the S&P. I want to finish on foreign exchange. The euro looks like this. The dollar, DXY, over the last few days, new lows for 2025. In and around those levels at the moment. Euro dollar 108.71, just in and around 109. On our radar this morning, President Donald Trump vowing to respond to the EU's countermeasures against his steel and aluminum tariffs. Canada also striking back, announcing 25% tariffs on $20 billion of U.S.-made products.
What I think is so interesting about this, and something we really should ask Secretary Lutnick, is Donald Trump yesterday said he will respond. Is the response going to come before April 2nd when they say is going to be this, quote, big day with the reciprocal tariffs being announced? Or are we going to sit there and have 3 weeks of maybe some stability and calm and not this frenetic every single day policy change? The Canadian foreign minister said this is going to be a day in and day out fight, which is why this meeting today in Washington, D.C. between Lutnick and the Premier of Ontario and the Finance Minister of Canada is so important.
How much is this a style thing? Come in, say thank you. It would be our honor to be our first 51st state, but frankly, we just can't do it right now. But we really just love having you on our border. Thank you. And then the tariffs go away. I mean, really.
I'm not sure that's going to fly at home. Can you imagine if that actually happened today?
Well, I'm just saying, I mean, how much is this stylistic versus actually substantive? And that is something concretely that we don't have a sense of.
I do think some of it is style. You can even see that yesterday. Donald Trump was sitting down with the head of Ireland. Ireland has literally the biggest trade deficit out of all the European states. And yet Trump did needle him on it. But he wasn't very rude or bombastic to the individual. And they said, look, we still have a great relationship. So maybe part of it is a little bit of style.
You'll hear from the Commerce Secretary later on this morning on this programme. That interview is about 90 minutes away. I want to get to the latest in Congress. The Senate Democratic leader, Chuck Schumer, saying his party will block a Republican spending bill to avert a government shutdown this weekend. Schumer urging the GOP to accept the Democrats' plan to provide funding through April 11th instead.
So he basically got up on the floor yesterday and said Republicans don't have the votes. Well, of course they don't have the votes because you need 60. They have 53. That's just the math. Two things can play out. One, they hold firm and we see a government shutdown and they try to pin this on the Republicans. Two, they say, we're going to give you the votes for a procedural moment to invoke cloture, but you have to give us in return a vote on an amendment, just so they have it on the books that they pushed for a different outcome, a.k.a. political theater.
Democrats don't want to block this. I mean, ultimately, there are a lot of Democrats that don't want to end up with this on their head, that they cause the government amid all the potential concerns around tariffs and some of the volatility. All of a sudden, if the Republicans can say to the Democrats, you're responsible for the government shutdown that now raises the question of downgrades to the U.S. credit rating, not a good look. So it's very difficult. And I have to wonder what exactly the discussions are like on Washington, D.C.
We've dealt with this stuff, unfortunately, a million times. I think market participants can deal with it. What they can't deal with, the fact we're talking about this means we're not talking about taxes. And that's the issue for a lot of investors right now. It just pushes that back and pushes it back. And we need to be talking about that up front right now. And we are talking about that down in Washington, D.C. The Commerce Secretary, Howard Lutnick, saying President Trump wants taxes for Americans making less than $150,000 a year to be zero tax. He also wants to have no taxes on tips either. So this is the big push coming from the president.
I feel like we're back to the campaign trail of Oprah Winfrey taxes. Everyone gets a tax cut. There's no tax on tips, no tax on Social Security, no tax on Medicaid. It's very difficult to see this when you have the budget deficit rising. But this is something Donald Trump did talk about. He said remove tax on citizens, replace it with tariffs. He talked about this on the campaign trail. This is something Peter Navarro would like to see. But it just does not seem feasible, especially when you look at the makeup of Congress and the fact that they want to bring the deficit down. It just doesn't make sense.
Representative Mike Crapo, Republican of Idaho, came out and said yesterday the price of this bill grows and is a bigger deal than everybody is focused on. Meanwhile, estimates are that it will add $5 trillion to the deficit over the next decade. So a question of how they can feasibly get this done and whether some of the cuts elsewhere really can offset this and then some to really quell some of the deficit concerns.
Margins are small. This is not going to be easy. That's for sure. Of course, we'll catch up with the Commerce Secretary on some of those comments a little bit later this morning, again, at 8 a.m. Eastern Time. Let's turn to the economy. Traders counting down to PPI due out in less than 2 hours' time. Greg Dacko of EY writing the following. The risks to inflation are tilted to the upside. The combination of still elevated inflation and resilient labour market conditions will keep the Fed on hold at the March FOMC meeting. Greg joins us now for more. Greg, good morning.
Good morning.
What's the source of that inflation, that upside risk to inflation? Where does that concern come from?
Well, I think the first thing to note is that up until today, we still had disinflationary forces. So we're still on this momentum where inflation was moving lower. but we're starting to see some elements that could portend to a higher inflation environment over the coming months. One of the key factors, of course, is going to be this rise in tariffs that leads to higher import costs, higher producer prices, filtering out into consumers. One of the key elements that I'm going to be paying very close attention to in the PPI report this morning is final demand for trade services. That's a proxy for margins, and that's usually a good gauge as to how businesses are passing on the higher costs. Because I'm worried about one thing. Last time we were here, I was talking about PIA, preemptive inflation anxiety. That concept is essentially this notion that there's going to be a much faster pass-through in terms of inflationary dynamics from producers onto consumers in this round of tariffs.
There are two sides, though, of preemptive inflation anxiety. And one side is companies passing along those costs, and the other side is consumers pulling back in preparation for higher costs and just all around a more expensive lifestyle. We're seeing that in the travel sector. At what point will slower demand offset some of the increases that we're seeing in price pressure?
I think that's a second element, a second shock in terms of economic activity onto inflation. The first round effect is really to see higher inflationary pressures. And we're seeing that in terms of uncertainty, because what consumers are doing is essentially hoarding ahead of any potential price increases. What that does is put in and of itself upward pressure on the very goods that are short in supply. We're seeing that also from the business side that are preemptively ordering goods that are likely to be tariffs. We saw in the latest data that trade imports were very strong. That's likely an indication that businesses are front-running any potential tariffs. That strains supply chains, puts upward pressure on supply, and leads to higher inflation preemptively. So those pressures are materializing now and will likely do so over the coming months. Once we start to see demand destruction, we may start to see some offsetting effects, to your point, on inflation, but that's a second round effect.
You know, it's just so interesting to me that we hear this being discussed by central bankers around the world. Yesterday, we heard that from the Bank of Canada, or Tiff Macklem came out and said that this is a new crisis and there's pervasive uncertainty, and discussed the difficulty in being able to cut rates again more significantly because of some of these inflation pressures. Where do you expect central banks to place the emphasis as they face off with the worst kind of dual risk, which is both slowing growth and inflation?
It's a great question, because when the two dual mandates are in conflict, the employment mandate and the inflation mandate, it's very difficult for policymakers to react. And the Bank of Canada said it well yesterday. Central banks are not equipped to deal with trade shocks. That's the simple nature of monetary policy. We have an environment where there might be this increasing risks on both sides. Inflation may go higher and growth may be lower as a result of these trade tariffs. That's the stagflationary shock that is very difficult to deal with from a central banking perspective. I think the key area to focus on right now is inflation expectations. Because so long as inflation expectations are anchored, central banks can look through any inflationary pressure that may be considered as transitory. I know that's a bad word in this environment, but they may be able to do so. If inflation expectations become unanchored, then central bankers will have a difficult time not reacting to higher inflation.
Let's sit on that central banker's dilemma just for a moment, and the approach to it and how you communicate around it. So, to Lisa's point, the Bank of Canada has been blunt about it. I would suggest that the ECB President Christine Lagarde has been equally blunt about it. Do you expect Chairman Powell to be as blunt next week in that news conference?
No, I think Fed Chair Powell will have to tap dance around policy uncertainty and its cousin, market volatility, because what we're seeing is essentially policy uncertainty weighing on business activity. The cost of waiting in this extremely volatile environment from a business perspective is very low. Businesses have no real reason to start acting, start investing in today's environment, nor have they reasons to start hiring. They're going to wait and see how policy develops. We're also seeing an environment where the first quarter GDP growth is likely to be lower, both on consumer spending that is softer and on imports front-running these tariffs. And then we have an environment where stock prices are under a tremendous degree of pressure. How will Powell react to all of those factors that are growth negative and stock market negative?
But what's different now than December was? Well, December was really wait and see. Now it's showing up in data and in surveys.
Yes.
He can respond, or should be able to respond to hard, cold data, no?
Yes, but the recent view from policymakers at the Fed, including Powell, is that the economy is just fine today the way it is. That may be a misread on the state of the economy. I would argue that the economy is softening, that the labor market is softening, that consumer spending is softening. in this environment of high interest rates and high prices, and therefore there should be some accommodation. The risk, as you well know, is that in 3 months' time, in 6 months' time, we'll likely start to see much more of these inflationary pressures, and that will force policymakers to pivot. A very reactionary Fed is subject to rapid pivots, and that is unfortunately going to be the case, I think, in the coming months.
Front page of the Wall Street Journal this morning has data from convenience stores saying Americans are still coming up for gas, but they're not buying Newports, they're not buying Doritos, they're not buying Twinkies. Is that the first to crack when it comes to consumers, these extras you maybe get?
I think so. I think we're seeing consumers being very cautious with regards to service sector activity. You were talking about vacation plans. The latest conference board reading on vacation plans over the next 6 months fell to a 3-year low. We also saw, and perhaps this was a bit of an artificial effect, but some weakness in airfare in the latest month of CPI data. That may also be an indication of softening travel demand. We are seeing essentially this bifurcation in consumer spending. Lower income individuals are much more judicious with their outlays. Higher income individuals are still spending a little bit more freely. But let's not forget that a big driver of consumer spending at the higher end of the income spectrum is wealth and stock prices. So if we start to see that policy uncertainty filter into market volatility and put downward pressure on stock prices, that could be a risk for these higher income individuals, both on the confidence front and from a wealth effect front.
We don't have to speculate too much about this. The airlines have told us it's happening. Delta came out first. American followed up. No one denied it. They said starting in mid-February, it started.
And it started as a result of uncertainty at businesses. They're seeing it among businesses that do business with the government, from the government, but it went beyond that. And they're saying they got the what? Parade of horribles. I love that from Delta CEO Ed Bastian.
Greg Dacker of EY. Greg, it's good to see you. Thank you, sir. Equities just turning positive on the S&P 500 with an update on stories elsewhere. Let's get to your Bloomberg brief with a parade of horribles with Danny Berger. Hey, Danny.
Thanks for that, John. President Trump's Middle East envoy, Steve Witkoff, is headed to Russia this week to present a 30-day ceasefire proposal to President Vladimir Putin. The U.S. reached the deal with Ukraine in talks in Saudi Arabia. Bloomberg reports that Putin will probably agree to the truce eventually, but will want his own concessions made first. The Federal Trade Commission is moving ahead with an antitrust probe of Microsoft that was opened in the final days of the Biden administration. Bloomberg has learned that the FTC is scrutinizing Microsoft's decision to slash funding on its own AI projects after striking a deal with OpenAI, which could be perceived as hurting competition. Here's one away from the parade of horribles. Some good news from Deutsche Bank, increasing its bonus pool to the largest amount in a decade. The boost comes after a surge in deals and trading last year. Deutsche Bank awarded $2.7 billion in variable compensation to staff for their work last year. That's a 26% increase compared to the prior year. And that's your brief, John.
Hey, Danny, thank you. That stock having a wonderful run so far in 2025, that's for sure. More from Danny in about 30 minutes' time. Up next on the program, tit for tat, tariffs.
As you know, we're going to be doing reciprocal tariffs. There are some cases where they're a little beyond reciprocal because, we've been abused for a long time. April 2nd is going to be a very big day for the United States of America.
We're anticipating that very big day. We'll catch up with Julian Mitchell of Barclays next. Had a few downgrades in the last few days. Over the past week, HSBC downgrading US equities to neutral. Citi doing the same thing. Goldman Sachs came out and cut their forecast on the S&P 500. We spoke to the biggest bull on the street early this hour, John Stolfus of Oppenheimer, with a price target north of 7K. He is still bullish. He says you want to layer in here. That's the bullish view. At the moment, equities, dare I say, and everything's relative, on the edge of snoozy. over the last 24 hours. That could change.
Oh, you're going to jinx it.
That could change. Of course it could change.
Honestly, the fact that it's snoozy, though, can I just say, is actually news in and of itself. Because yesterday everyone was getting really excited. The bounce is coming. We didn't see a decline. So there's a question of can it continue? And if it doesn't, I think that's actually going to be really interesting.
I'm not trying to sell it. Just trying to say as it is. Equity futures right now in the S&P positive by close to 0.1%. Under surveillance this morning, tit for tat tariffs.
As you know, we're going to be doing reciprocal tariffs. So whatever they charge us, we're charging them. Nobody can complain about that. I don't know why people get upset about that because there's nothing more fair than that. There are some cases where they're a little beyond reciprocal because, we've been abused for a long time as a country. I'll always have flexibility, but there will be very little flexibility once we start. April 2nd is going to be a very big day for the United States of America.
So here's the latest this morning. President Trump promising reciprocal tariffs against the European Union after it issued countermeasures against his 25% steel and aluminum levies. The measure weighing on the outlook for industrials. Julian Mitchell of Barclays writing, much of multi-industrials could see some negative impact on margins and perhaps profit for at least a quarter or two before offsets ramp up. Julian joins us now for more. Julian, welcome to the programme. Let's get straight into it. That last line, when you think about offsets, what kind of offsets are available to them?
Hi, good morning. Yes, so I think there's a couple of main tools that CEOs will try and use in order to offset the effect of higher costs, whether it's direct raw materials or broader imported components. I think the first one, and they've all highlighted this as being a very well-developed muscle, if you like, now, is push-up price. This sector, US multi-industry companies, had about double-digit, low-teens price increases in 2022. That's the last time we had a spike in inflation of raw materials and components. Ending 2024, that price inflation for this sector had eased to around a low single-digit rate. I think all these companies are primed with their finger over the button to push up prices again very, very quickly in early April as needed. And they will expect that all their distributor and channel partners will follow suit as well. So that's the first very rapid response. I think beyond that, you may see some movement in sourcing of components and raw materials as well. But I would not expect probably wholesale changes to the manufacturing footprint of these companies. I think they like to use shorter-term measures, delay their own investments because of all the uncertainty, and then perhaps evaluate broader manufacturing footprint changes later on, perhaps next year.
Julian, I'd love to just develop this idea of how long before people start moving production back to the United States, which is the outset of, which is the goal, the stated goal of a lot of these tariffs. Are you saying that won't happen in the vast majority of cases because they'll take a short-term view, expecting some of these tariffs to either change or be lifted at some point in the near future?
Yes, that's exactly right. Yes. I know for decades, and we saw a resumption of this in Mr. Trump's first term, and of course around the COVID supply chain issues, there's always this talk about US onshoring, reshoring, that type of thing. I think it's extremely unlikely that most large manufacturing companies will do more manufacturing in the US. It's very expensive to do it. Labor's tight. Skilled labor for certain manufacturing jobs is even tighter. And so it's very difficult then for business owners to pursue that path if it's more difficult and more expensive. And I think one effect that you'll see from higher tariffs on imported goods will also be, of course, that domestically produced goods, the price of those will go up. So I would imagine you'll quickly see the cost delta between imported goods and domestically produced goods. That delta might be very wide on April 2nd, and then I would assume that within a month, it's probably very narrow again.
Julian, how much is this giving a carte blanche to a lot of these companies to raise prices significantly, even beyond what some of the tariffs are, and raise revenue that way?
Yeah, so I think that they absolutely will look at a minimum to cover their dollar profits in terms of offsetting the higher costs. Many of them, I think, will also look to preserve percentage operating margins. And some of them, like we saw in 2022, when they were getting double-digit price increases, they could even see a big margin uplift. So I think it really depends on the company, their industry, the competitive landscape, how that feeds into pricing power. But absolutely, I think many companies will see this as some opportunity, perhaps, to even push operating margins up. And that's what happened 3 years ago.
Julian, what you're saying is completely different than what the administration is saying, which is that the stick approach of tariffs will bring manufacturing back to the United States. If you're saying that's not enough for companies, would a carrot like a 15% corporate tax rate do the trick?
It's possible, but look, we have a lot of experience of these types of carrot and stick moves from, the period of 2016 to 2020. You saw then a mix of corporate tax cuts, higher tariffs put on imported goods from China. So we've seen many similar measures before 7 or 8 years ago, and we did not see a pickup in U.S. onshoring or a pickup in U.S. manufacturing. If you look at recent years, things like purchasing managers' indices have been under pressure. Manufacturing employment in terms of jobs added in the U.S. has been under pressure. When you look at basic import-export data, an economy that's onshoring manufacturing should see a narrowing, one would think, of the trade deficit because your imports start to move up. Your imports start to move down, your exports start to move up, the trade deficit would narrow. That's the opposite of what we've seen. And most recently, obviously, with the January trade data, you saw that opposite still playing out, very high imports and muted exports.
Hey, Julian, we've got to leave it there. Appreciate the update from you. Julian Mitchell there of Barclays on some of the industrials and how they handle these tariffs. The offsets, that's the word we're all interested in, how the costs will be distributed. Who's going to absorb these costs? Are they going to have to take it on margin? Can they pass it on? All those things we need to figure out over the next few months.
And ultimately, it just depends how much people want their products, right? If you are an iPhone, I was going to say an iPhone producer, but at the same time, Apple's kind of gotten hit on the head. I'm just thinking about what addictive devices in my home might end up being able to have some pricing power.
It also depends where you're producing them. Walmart goes to the Chinese and said, you're going to have to eat some of this. And they're saying, actually, we're not. It's on you.
This is not predictable at all. Coming up in the next hour of Bloomberg Surveillance, we'll catch up with Megan Horniman of Verdant's Capital Advisors, the former Trump White House trade official Katie Kalukowicz, the former New York Fed President Bill Dudley, and Dirk Willer of Citi. Look out for Dirk at the end of the next hour. Downgrading US equities recently and going into China. We'll get his thoughts in the next hour. From New York City, this is Bloomberg.
We're still tactically quite cautious on equities overall, particularly, of course, in the US. This is the kind of time where you need to update your framework, your indicators, pretty much on an hourly basis.
We're not seeing any signs of significant nervousness. There is a lot of demand for alternative assets.
The conditions are ripe for at least a relief rally.
If there's no recession, a market down 10% tends to have pretty positive returns in the 12-month forward.
Investors need to understand how much tolerance do they have for short-term mistakes?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with stocks just about steady on the S&P 500. Anywhere between unchanged to negative 0.1%. We'll see if that changes. On the Nasdaq 100, we're down about 0.2%. The main event later on this morning is the economic data at 8:30 Eastern Time. Both PPI, another read on inflation following a softer CPI yesterday, and jobless claims. Will the uncertainty around policy begin to bleed into the hard data and speak to some weakness in the labour market data? That data point coming up a little bit later. Coming up later too, this conversation with the Commerce Secretary, Howard Lutnick, at 8 a.m. Eastern Time, 60 minutes from now on Trade.
There's going to be a real question here of what kind of check the White House is looking at to understand just whether they still have some leeway to continue with this negotiating process. In other words, how much are they watching? If they're not watching Wall Street, if they're watching maybe Main Street, at what point do they take some of these indicators, these economic indicators, as a warning signal that they got to speed up this process?
Well, that's why PPI is going to be interesting. Paul Donovan of UBS talking about the fact that pricing power is important to determining how much of what he calls a trade tax
impacts passed along to the supply chain. So we'll get a little bit of that after we hear from Secretary Lutnick. And for him, most important today is going to be that meeting he's going to have in Washington, D.C. with the Premier of Ontario, the Canadian Finance Minister. One, the current tit for tat when it comes to the tariffs. 2, April 2nd reciprocal. 3, renegotiating USMCA.
There's a phrase we've heard repeatedly from a lot of companies, a lot of policymakers, a lot of business leaders: wait and see, wait and see. Torsten Slock of Apollo calling it the wait-and-see economy, and writing this morning. In a wait-and-see economy, it eventually leads to a slowdown in the hard data. Markets should prepare for that scenario. Are we prepared for that scenario?
The markets are starting to sniff that out. How much they can actually price that in is a matter of debate between the bond market and the stock market. And frankly, what the response mechanism from the Federal Reserve is another aspect of that. In that Torsten Slock note, he talked about the fact that small businesses account for 80% of the employment in the United States. They are signaling in the NFIB survey that their confidence is dropping, and they expect to have to raise prices at the same time that they're maybe remaining on hold and have a high level of uncertainty. This is a theme. At what point is it becoming sticky? And that, I think, is why the economic data becomes more important.
Small business confidence at a 4-month low early this week. Equity futures just about negative. We're down by not even 0.1%. Coming up this hour, we'll catch up with Megan Horniman at Verdant Capital Advisors. As U.S. growth concerns grip Wall Street, the former Trump White House trade official Katie Kalukowicz on trade tensions, and Dirk Willer of Citi on why he's downgrading U.S. equities. We begin this hour with stocks just about steady. Megan Horniman at Verdant Capital Advisors looking for more weakness, writing, we remain concerned about economic growth in the first half of 25. The consumer is the biggest threat as debt and higher prices are straining balance sheets. We expect this valuation correction in equities to continue. Megan joins us now for more. Megan, welcome to the program. As you know, a feature of this economy post-pandemic has been the resilient consumer backed up by a strong and powerful balance sheet. What's changed?
I think this started to change last year. We saw that the COVID-related stimulus has really been wound down from the consumer's perspective, and they were borrowing using credit cards. We also saw some statistics recently where the largest amount of Americans are pulling from their 401k just to fund spending. And now we're seeing that hit a wall. The uncertainty has just risen too much from an economic perspective, and they're just stretched. The delinquencies are rising as well. So we think this pullback in the consumer is healthy and warranted. And it's not too surprising to us, given how much they've run really since the pandemic.
Jamie Dimon of JP Morgan said this recently. I don't think the average American consumer who wakes up in the morning and goes to work changes what they're doing because they're reading about tariffs. You've pointed out that this started in the last 12 months. How important has the policy shift, the policy uncertainty been to the changes you're seeing?
I think it's sped up that kind of consumer pullback. And I do think that the tariffs have impacted consumer confidence to a degree, but primarily because it's really created a lot of uncertainty around inflation expectations. And we've seen that in consumer data. You can look at the University of Michigan expectations for inflation. These have shot up significantly. So while consumers may not be following this tariff data, point to point every single day, just that threat of higher prices after they've already had to absorb higher prices for several years, that's combining with colliding with this really low consumer confidence.
When you look at all the data, what to you speaks the most in terms of volumes of what you really are looking for to see a slowdown in the consumer?
There's several things. Obviously, retail sales is a big thing, but we look also at some of these consumer confidence indicators. Historically, it may not have really happened so much in the past couple of years since the pandemic, but if you go back beyond the pandemic and just look at history, there's a tight correlation between weakness in consumer confidence and then how that correlates into future spending. And we've just seen confidence continue to deteriorate. We're looking at levels, if you go back to either the lead up to recessions or slowdowns in the economy, we're there from a confidence level. So we think this is going to correspond to some slowdown in spending the first half of this year.
Could this uncertainty push the U.S. into a recession?
We're walking a very fine line because we have seen that, you can see consumers kind of live in this feedback loop. So where it continues to be negative headline after negative headline, and then they just pull back spending similar to how businesses do. Let's just wait and see. And the problem with that is the consumers make up 70% of U.S. GDP. So if the consumer pulls back, that does impact GDP.
So what's the defense trade here, Megan? Is it to buy bonds?
Well, not a couple weeks ago, no. And I think the defense right now, I mean, we did see yields come back down. They are now widening out a bit, but not really in the longer term part of the curve that warrants you that risk or rewards you for that risk you're taking from an inflation perspective and then from an issuance perspective, specifically here in the U.S. Instead, what we're looking at in our portfolios, and we came into this year, is make sure you have dry powder to put to work. Also, don't be afraid to invest in things that look like those valuations are rewarding you for that risk. It's okay to be a little ahead on this, but when you're looking at some of the areas of the equity market that are down close to bear market territory, like small and mid-cap stocks, if you can withstand short-term volatility and have a long-term time frame, then these areas you should start piecing away at.
There's a question about what we should be pricing in. And Julian Emanuel of Evercore ISI put out a report that I thought was really interesting, talking about how the market right now seems to be pricing in more of a stagflationary-like scenario, which could mean a 10% downside to equities. If there were truly to sniff out recession, it would be some 40% drawdown or something of that nature. Do you have a sense of what that looks like? Do you agree with that assessment?
I think that's a little bearish, in our opinion. I think this is a short-term recalibration or reassessment of what we're looking at from an inflation standpoint, from an interest rate standpoint. Don't forget that investors have been looking for continuous Fed rate cuts, and I think what you're realizing now is the Fed can't come in and save the day like they have in the past. That Fed put is something we won't see. They don't have that flexibility. So I think you're seeing this kind of, from a valuation perspective, reassessing what we can expect from interest rate cuts, what we can expect from the earnings environment. And obviously the earnings environment right now is at risk because of the tariff, back and forth. But I think this is, anybody who came into this year not expecting volatility to pick up, I think came into this year very complacent. We did not. We knew that we've had the Trump administration before. We know the playbook. He's campaigned on this. We know he's a disruptor. He was coming in to disrupt markets. He's just doing this, I think, much quicker than people expected. So he's pulling a lot of this uncertainty into the first quarter of this year. I think as you get into the summer, a lot of this will clear up. And then when we get into the second half of this year, the main focus is going to be on the Tax Cuts and Jobs Act, which is a benefit for the market. So again, first quarter of this year, even first half of this year, expect a lot of volatility, but don't be afraid to look at your portfolios for the long run and invest in those areas that can reward you for the risk that's there.
Coming into this year, Megan, people said that there was going to be at least a Trump put on the stock market, if not maybe a Fed put in the same kind of way, due to the stickiness of inflation. You're saying that not only is there not a Fed put, but the Trump put isn't there for now. How much of your bet is hinging on the idea that the Trump put essentially comes on later in the year with policies that are a little bit more friendly to Wall Street?
Well, when it comes to politics and when it comes to, any president that sits in the office, we're not looking at portfolios for the long run over what might happen over the next 6 months. We're looking at opportunities for the long run that are giving you, looking at the fundamentals of the U.S. economy. And even though the U.S. economy right now is weak, the long-term fundamentals of this economy are still very strong, regardless of who sits in the White House, regardless of what policies are there right now. We know that a lot of these are negotiating tactics. So it's going to seem loud. It's going to be a lot in the headline news. This is going to spook investors. But for the long run, we will get through this. We think that the Trump put that you called it, I don't think that Trump's really looking specifically at what's happening on a daily basis in the equity markets for now. But don't think that's not going to bother him forever. If this continues into the second half of this year, we may see some softening in rhetoric, and I don't know exactly what that may be right now, but he is looking forward to getting that Tax Cuts and Jobs Act extended, as well as, don't forget, we'll be coming into midterm elections before we know it.
Megan, just before you go, I just wanted to address what I think is quickly becoming a dilemma for capital allocators, and that's how the bond market might behave. What I take away from you is nothing too dramatic here, potentially a story of two halves for 2025. But the ability to absorb shocks, the capacity to absorb shocks in this economy has been reduced over the last 12 months. And with that in mind, I want to think about the events elsewhere. Do you think the events elsewhere, particularly in Germany, maybe reduce the risk mitigation characteristic of bonds here in the United States? Yesterday was curious to me. I've seen other days like this over the last week where bonds haven't offered me that ballast when equities have started to move down, when we've seen that risk-off story. At other times it's worked, other times it hasn't. It hasn't been reliable. Megan, what's going on there, and how do you think about that going through the first half?
So we have to look at bonds as a whole and take out the tariffs. And right now, bonds are reacting on the threat of inflation. So you're seeing some of the long end of the curve globally start to rise. And there can be correlations when you see moves in global interest rates. So we saw that, for example, yesterday here in the U.S. When it comes to using bonds as a safe haven, you have to be very careful that this is the first time in a very long time that we've had to be looking as an asset allocator, that we've had to consider the fact that long-term bonds may not be the hedge because of the inflation risk. These are things we've typically used when you're heading for an economic slowdown as a way to hedge against your equity exposure. But that long end of the curve, not only here in the U.S., but globally, is being impacted by the inflation expectations. So you can still use bonds as a hedge. Just stay defensive. Right now, cash and short-term bonds are earning you a nice yields we haven't seen in a while. So there's no reason that you need to extend duration out significantly to really hedge your portfolios. You can balance that out in a short, intermediate term part of the curve.
Megan, appreciate the clarity. As always, it's good to catch up. Megan Horniman there of Verdant's Capital Advisors. Just finishing on the bond market there. We've seen this a few days now, haven't we? The bond market behaving in an unpredictable way.
The more jumpy the market becomes on the stock side, bonds are also selling off, and you're seeing that with yields continuing to climb for yet another day in the United States. Raises a question about why would you invest in long-term bonds if you can get a nearly similar yield, at least in the short term of the curve, and that's what you hear.
Equity futures this morning down about 1/10% now. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Alibaba has released a new AI model, which it claims can read emotions. The R1 Omni is said to be capable of inferring a person's emotional state from a video and also describe their clothes and environment. It's free for download on the AI development platform Hugging Face. Dollar General shares in the pre-market trade up 5%. It forecast sales with a top end that was higher than estimates. It also announced plans to close 96 of its namesake stores and 45 pop shelf stores. Dollar General said that consumables like groceries are now accounting for a higher proportion of sales. The Thai hospitality group that owns hotels featured in HBO's The White Lotus is eyeing expansion into the U.S. Since the third season's premiere, direct online bookings for the resort have increased by 41% versus the same period last year. Minor International plans to expand to 1,000 hotels by 2030. And that's your brief. John.
Danny, thank you. Lisa, no spoilers. Just had to get that in really quickly.
Thank you so much, because I haven't seen it yet.
I know.
Okay, I haven't seen it yet either. There's only one person here who's seen it. So who's the story catering to?
I'm not going to spoil it. I'm not going to spoil
it. Yeah, but
he
doesn't spoil. Okay. You come out and always tell us the end.
I gang up always. It was once. Sorry.
Don't do it again. All right? Season 1 was better than 2. 2's better than 3. Just going to throw that out there, all right? Up next on the programme, countering countermeasures.
European Union's been very tough. And it's our turn, too. We get a turn at that also.
Season 2 ruined Sicily. That's the problem.
But that was a better season.
Taormina was like this nice sleepy town 20 years ago. Now it's too busy. Anyway, let's talk about trade. Up next on the programme, the former Trump White House trade official Katie Kalukowicz joins us next from New York. This is Bloomberg. So later this morning, another read on inflation. We get PPI at 8:30 Eastern Time. You get jobless claims too, so look out for that. Going into it, your scores look like this. Equity futures on the S&P 500 negative by 0.2%, rolling over just a touch in the past 30 minutes or so. On the Nasdaq 100, we're down by 0.3. Under surveillance this morning, we're countering countermeasures.
When you put more tariffs on the EU, will you respond to their retaliation?
Oh, of course I'm going to respond.
You will retaliate.
The problem is our country didn't respond. Look, the EU was set up in order to take advantage of the United States. European Union's been very tough. And it's our turn, too. We get a turn at that also.
So here's the latest this morning. President Donald Trump saying the United States will respond to EU countermeasures against his 25% tariff on steel and aluminum, but not specifying what measures he would take. This as Canada strikes back with its own 25% tariffs on over $20 billion of American goods. Joining us now from the nation's capital, Tyler Kendall. Tyler, I'm losing track of who's putting countermeasures on who and who started what. Tyler, are you keeping track of this?
Yes, John, good morning. It is a lot to keep track of, but one thing that we do know from the White House when they say they are going to respond, one through line that we've been noticing is that when they say there will be retaliatory measures against the retaliatory measures, that has to do with rolling those calculations in to those reciprocal tariffs that we are expecting on April 2nd. That is where senior administration officials keep pointing us to. And another headline out of the Oval Office yesterday, President Trump saying that once that date rolls around, there is going to be very little flexibility. And we have to remember what these countries are negotiating against. Perhaps on Canada, it started to be about border policies yesterday. It officially became about national security concerns when President Trump invoked Section 232 for the steel and aluminum tariffs. But broadly speaking, this administration is pushing that this is about rebalancing trade and lowering those tariff barriers. And President Trump seems to have a special ire for each of these countries, whether that is Canadian lumber or dairy or EU autos and pharmaceuticals. But importantly, John, we have to keep in mind in the background of all of this, the White House is pushing that this is about longer term growth, which goes hand in hand with their fiscal agenda. That is why they say that they need to have these tariffs in here to get that revenue raising a revenue in order to balance that trade, those tax cuts that this White House would really like to see pushed through.
The main event about 2 weeks away, reciprocal tariffs just around the corner. Tyler Kendall there in Washington, D.C. Tyler, thank you. That's the issue we've all got. Is it about revenue raising? Is it about market access? Is it about the border, fentanyl, immigration? Is it about a personal dispute between two leaders? What is it about?
The problem is if you try to find consistency, if it's revenue raising, then there should be a bit of a concern with any kind of economic downshift, right? If you have a slower growth environment, you're going to be bringing in fewer revenues from taxes. So it's hard to wrap your head around in any given day, but I love the idea of can you keep track? And when you say the big event, I'm not sure what you're talking about. Is it the government shutdown?
April 2nd.
Is it April 2nd? Could it be reciprocal tariffs? Is it going to be, I mean, really, there are a lot of main events.
Their words, not mine. They say it's going to be the big one.
I know.
The big one's still to come next month.
Spoiler.
Joining us now, their spoiler, the former Trump White House trade official, Katie Kalukowicz. Katie, welcome to the programme. Katie, really hard question. In 3 weeks from now, where do you think we'll be?
That is a really hard question. Thank you for asking it, and thank you for having me. I think we're going to have some more tariffs, though I think in reality, as you've probably heard from previous guests, the implementation of a reciprocal tariff arrangement with the rest of the world is quite difficult to accommodate and implement. The United States, of course, like every country, has thousands and thousands of goods that enter under various tariff rates from over 100 countries. So I think what we're going to see is the president really focus in on some of what he considers to be the worst offenders. And unfortunately for some of our allies, like the ones you were just discussing, I think they're right in the crosshairs.
But when it comes to the U.S. weighted average tariff rate, it's 1.5%. The European Union's 1.6%. Japan's 1.35%. Who was this administration really going after?
It's a great question because, of course, you're exactly right. Our average tariff rates are quite low, but the president has been fairly explicit. And frankly, the United States has been explicit for a long time that in the economies that you've mentioned, it's the non-tariff barriers that are really a concern. You know, in the European Union, for example, we have difficulty selling our agricultural goods because of regulatory barriers. In Japan, we have issues selling cars. Despite a 0% tariff rate on automotives, we struggle to sell our cars there because of their regulatory barriers. So you're right to focus on the tariffs. I do think that we will see some tit for tat on tariff rates, even if it's a small amount. But the president has directed his government agencies to calculate the harm of these non-tariff barriers, ostensibly to come up with a corresponding tariff rate.
Katie, if you're an investor on April 2nd, do you see the actual tariffs or you just see basically the tariffs get publicized and what they plan to do?
I think we're going to see a range of actions. If you go back to the first document that outlines the president's goal here, the America First Trade Policy Memo, which he issued on day one of his administration, you will see directions to a wide range of agencies, which have a wide range of tools. I think we will see a number of new investigations. The president has, of course, already launched some with respect to timber, lumber, and copper. I suspect he will be looking at additional strategic sectors. Semiconductors and cars come to mind, as do pharmaceuticals. I suspect he'll use the 301 authority, which is what launched his first trade war with China, to look into some of these more pernicious barriers. And then I think we may see, exactly as you described, new tariffs that respond to the differential tariff rates in certain economies.
Kate, you were in the previous Trump administration. How different is this Trump administration's approach to trade, to tariffs, than when you were in the White House?
You know, what strikes me most is a little bit about what you were talking about previously, which is just it's the speed with which some of these things are coming. The question about the motivation. I mean, as you said, you know, the president has talked about tariffs in response for fentanyl, in response for the border, in response for reciprocity. I mean, they are coming so fast that I think even our trading partners are trying to catch up. They're trying to understand, what will this president respond to? Is it a deal, as we all had anticipated and come to know in the first term? Or is that simply a fool's errand? And I think for our allies in particular, they're really struggling first with coming with olive branches, trying to offer a deal. Second, to try to match the president, which, as we saw, did not work well for Canada. I fear it will not work well for Europe. And then maybe a bit of recognition that this is the new reality and trying to settle in and bear down. It is different in that respect, because it does not seem, at least at the immediate term, the president is interested in a deal right now.
Kate, appreciate your perspective on things. Difficult questions to answer. Where are we going to be in 3 weeks' time? Kate Kalukowicz there, the former White House trade official in the Trump administration in the first term. So, Lisa, I would say speed and sequencing. To Kate's point, it's moved really, really quickly this time around. The sequencing, of course, is different. They've started with trade. Last time they started with taxes. I think there's another big difference as well. This 4-year gap between the first term and the second term, the president has had time to think. Had time to think about what he wants to do. He also understands the levers of government in a way that he didn't before coming into the White House. And he's moving much more quickly because of those things, I think. They all just line up. It all just stacks up perfectly for him to hit the ground running in a way that he has done. And he says that he has a plan, and the entire administration gives us the longer-term trajectory. What Kate was saying there, though, her last point was really telling, which is it doesn't seem like he's interested in making a deal right now, which makes it that much more complicated.
He's in negotiating mode. You have to think, though, 3 pillars of the Trump administration. It's going to be trade, low regulation, tax cuts. How do you do this all when you can't control the timing of at least one of the big ones?
Up next on the programme, we'll catch up with the former New York Fed President Bill Dudley on why he thinks markets are underestimating tariff risks. Do you remember when Lisa ruined Shogun?
Okay. Oh, my God.
I do, because I never watched Shogun.
Really? You've got nothing else to talk about.
Brutal.
Really, there's enough going on in this world.
That was a tough day.
I didn't end up watching because I just thought, what a waste of time.
Lisa basically told you the end.
I think I'm gone now. See you later.
Equity futures on the S&P. You'll be missed. Don't go anywhere. Equity futures on the S&P, negative by about 0.2%. Lisa will be missed because later on this morning, we'll have some economic data, PPI, in about an hour from now. Jobless claims as well in 30 minutes' time. Don't miss this conversation. We'll catch up with the Commerce Secretary, Howard Lutnick, at 8 a.m. Eastern Time. That's 30 minutes away. Don't miss it. We're 2 hours away from the opening bell. Let's get you some morning movers. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. We start with Intel. Finally, a new CEO over there, and the market likes it. Shares are up 11.5%. Lip-Bu will be at the helm, and his strategy is to stick with the current plan of making chips for other companies. Yes, it has been a costly endeavor, and one that even led to the ouster of his predecessor, but he thinks he can execute, and so does the street. BofA upgraded the stock from underperformed to neutral, and a number of other analysts are reacting positively. Next up, we have Adobe shares. Those are moving in the other direction, down 5%, after the company behind Photoshop gave an outlook for the current quarter that failed to excite investors at a time when they're looking for progress from Adobe on monetizing all those investments they've made into generative AI, but it's not happening as soon as they'd like. And last up, we have shares of American Eagle. Those are plunging 9.7% after issuing weaker than expected guidance for the year ahead and signaling that tariffs are going to hit margins. Plus, it's the latest company warning us that the consumer is pulling back. John?
Yahara, it's another one. We've heard from a few. Appreciate it. More from Yahara in the next hour or so. 3 of the names to watch going into the opening bell 2 hours away. On our radar this morning, the US budget deficit hitting a record in February. The biggest contributors to the continued widening, Medicare costs and servicing government debt.
So this is a big problem because they are trying to, one, bring down the deficit and then also make way and room for the $4.5 trillion of extending TCJA and maybe adding on some of these taxes provisions that the president talked about on the campaign trail. And this number just makes it that much harder because guess what? You can't really control the interest. And also, the president says he's not cutting Medicare.
If this market were pricing in the complete package of this White House, of potentially what could amount to more than $5 trillion of tax, of basically deficit increases over the next 10 years at the same time as tariffs, yes, with the tax cuts involved, how would that mix look like in markets? Would it be a benign outlook? Would it give a boost to the consumer? Yes, probably. But how much would it also kick up the long end of the yield curve in a way that I know Scott Bassett wouldn't want to see?
Well, from a market perspective, arguably that was the story of November, December. And then all of a sudden things changed when we started 2025.
And the real question now is if they do make traction in the Senate, in the House, how much does the market start to reprice that or have some of the other developments taken that off the table for now when we're talking about whether or not the government will shut down tomorrow night?
Well, let's get to the shutdown, and I think that's going to be the main story for a lot of people. Before we even talk about taxes, we need to talk about this. Senator Chuck Schumer saying his party will block a GOP bill to avert a government shutdown on Saturday. Schumer urging Republicans to instead accept a Democratic plan to fund the government through April 11th. His view is quite simple. You don't have the votes. If you don't have the votes, you need to negotiate.
Right. So they want to have at least 24 hours, I believe, of this negotiation. What do you get in the end? Potentially, they will be able to have an amendment where they vote on and show politically we wanted something different that the Republicans are trying to push through. But if they hold the line and we go through a shutdown, everyone in Washington, D.C. will get blamed for this, the Democrats and the Republicans.
It's a really difficult moment for the Democrats to know how to finagle it. A lot of people are saying, look, we have to get on board because we don't want to shut down the economy right now, given all of the other potential risks out there. At the same time, it is a difficult moment for them to take a stand when they don't have the leverage.
Either the Democrats cave, or Republicans cave and come to the table, or the Democrats say, look, we're not going to deal with this mess because it's going to be too much blowback on us. And we need to find a more consistent message to go after the administration and the Republicans than just saying we're going to shut down the government.
Our favourite story will continue into the weekend. Can be sure of that. Wanted to fit this in, an important development. The FTC is moving ahead with an antitrust probe of Microsoft that was launched late in the Biden administration. The agency also walking back comments that it's not ready for a September trial examining Amazon's Prime subscription practices. How they regulate things and whether we can go through with a different regulator, with a different regime, I think is the big topic for a lot of people, including the banks for that matter. We thought we'd have all of these mergers and acquisitions, a softer touch, a lighter touch down in Washington. Not seeing much sign of that so far.
You might get a softer touch, except when it comes to technology. And Andrew Ferguson, the new head of the FTC, kind of taking a playbook from Lina Khan. One of his first public remarks since taking the position back in February, he said investigating the tech sector is his highest priority. And guess what? You see that here right in the beginning, 7 weeks in.
I think a lot of advisors at a lot of banks will be watching that story pretty closely. Let's turn back to the trade story, tariffs. The former New York Fed President Bill Dudley saying Trump's tariffs will be worse than markets think, writing, markets seem to think that if the president won't stop the damage, the Fed will. I think they're too complacent. Bill joins us now for more. Bill, welcome to the programme, sir. Great piece. Let's talk about it. Why do you think they're too complacent?
I think the problem is that the tariffs are bad for growth and bad for inflation, which puts the Fed in a bind. Basically, they're missing by more on both sides of their mandate. So I think in the near term, the Fed's going to basically be on hold. waiting for more information. Trump administration is making the matter worse because not only are they putting tariffs in place that are much larger than they did during the first term, they're doing it in a very haphazard, irregular way, which is creating a lot of uncertainty. The decline in merger activity in the 4 months of this year is pretty striking. People expected merger activity to pick up with the Trump administration. It's actually gone down because nobody knows what the rules of the game are going to be in terms of relative prices for inputs, relative prices for exports. So people are very confused and people are just sitting on their hands.
Bill, as John was just saying, you wrote this line, markets seem to think that if the president won't stop the damage, the Federal Reserve will with rate cuts. Where do you think they have the political leverage to not cut rates at a time when they are seeing quite a bit of potential destruction to the U.S. economic outlook?
Well, it all depends on what happens to inflation, how high does it go, and two, does it get into inflation expectations? The inflation expectations are the key issue for the Fed. The second thing they're going to be focusing on, how much does the unemployment rate rise? It's not about job creation. It's about the unemployment rate. One thing that people don't really understand, I think, well, is the fact that we don't need a lot of job creation to keep the unemployment rate here because the growth rate of the labor force has collapsed with the Trump administration. We're deporting workers. The number of people coming over the borders has collapsed. The growth rate of the native-born population is really slow. So top speed for the U.S. economy in terms of keeping the unemployment rate where it is probably 50,000 payroll employment a month. And I think people think that 150, 200,000, if it slows to 50,000, the Fed's going to cut. I think that's wrong.
Bill, I understand the argument that the Fed put isn't exactly there, that the Fed is going to come in and cut rates in response to market turmoil. At the same time, there is an argument that some of the tariff-related inflationary forces are one-time price adjustments that will eventually come down, especially with a weakening economic outlook, and that they can look through that a bit more and place a bigger emphasis on the unemployment rate and other economic indicators. Do you push back against that?
Well, again, it depends on whether it gets into inflation expectations. The first Trump term, the tariff increases were relatively modest. It wasn't an inflation issue because inflation was running below the Fed's 2% objective. This time, the tariff increases are orders of magnitude larger, and it's happening at a time that inflation's been running well above the Fed's 2% objective for 4 years. So inflation expectations are the key. And one troubling indicator in that regard is what the University of Michigan household expectations survey showed last month for 5 to 10 year forward inflation expectations. It rose to 3.5%, the highest level since the 1990s. So if that is corroborated by other inflation expectations indicators, that's going to make it much more difficult for the Fed.
Bill, you're talking about the upcoming economic projections we're going to get from the Fed, and you say inflation will be increased, but the path for the unemployment rate won't change much as labor force growth slows along with hiring. Are you basically saying the Fed and their projections are going to almost pinpoint stagflation?
Well, I think they have to lower their growth estimates, given the uncertainty that the tariffs are causing and the fact that it makes real income for lower income households very much squeezed, and so they're not going to be able to spend very much. They have to raise inflation because the price level of a lot of these imported goods is going to go up pretty significantly. So I think that's sort of in the cards. I think what's going to surprise people is that they're not going to raise their unemployment rate trajectory very much. And I think that people maybe be surprised that they're not going to increase the number of rate cuts that they have in their forecast. Last time they had 2 rate cuts for 2025, and I think they'll keep it right there.
Bill, let's just talk about those forecasts. What is the approach to putting forecasts together in a moment like this? How much of a conversation happens between individual policymakers? Actually,
with regard to the summary of economic projections, everyone sort of does their own. So this is not coordinated. You are allowed towards the end of the Federal Open Market Committee meeting to change your forecast based on what you've heard from others, but people rarely do that. So these things are really put into place before the meeting starts and hardly ever changed.
A lot of people expect the statement of economic projection not to really move that significantly, and if they do, for it to essentially be irrelevant because they don't know anything. Do you disagree? Do you think that it will be indicative of what kinds of scenario analysis individual members are doing and how much they're incorporating policy for their outlook?
I think the reason it matters is the fact that I think people are looking for the Fed to sort of come to the rescue of the economy by cutting rates. And you've seen that in the decline in 10-year Treasury note yields over the last few months. And I think the Fed's going to signal through the summary of economic projections and in Chairman Powell's press conference is that, no, we're sitting on our hands for the time being.
Bill Dudley, with the latest. Great piece on Bloomberg Opinion. That Bloomberg column available on Bloomberg.com and on the Bloomberg terminal. Bill, thank you, sir, as always. The former New York Fed President, Bill Dudley, there on the Federal Reserve, and whether that Fed put is alive and well.
And the answer is probably not as quickly as you think, because the unemployment rate probably won't go up for quite a while. And that's going to be the ultimate tell for them. You asked a question earlier this morning, I believe, to Greg Dacko that I thought was really interesting. Do you think that the Federal Reserve will have the same leeway to be blunt the way that the ECB and the Bank of Canada have been in this dual kind of conflict about slowing growth and higher inflation? I think that'll be interesting to watch.
I am noticing some subtle shifts, though. Since the news conference of November, December time, we shifted from we don't assume, speculate or guess to some people did assume, speculate and guess. And the recent speech actually addressed policy almost head on.
Yeah.
And I wonder if that's just the beginning of doing more of the same next week, and we'll see.
They kind of have to, because if they don't give some acknowledgement of policy that we've already gotten and of market reaction, remember, the markets are one of the main transmission mechanisms of their policy. Can they now say that market turmoil is irrelevant to their outlook and irrelevant to some of their inputs? No, they're going to have to address it on some level, and I think it will be interesting.
That news conference will be must-watch on March 19th. That is next Wednesday. We'll have live coverage of that for you right here on Bloomberg TV. We are looking at futures declining by a couple of tenths of 1% with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The IEA has cut its oil consumption forecast due to a slower pace of deliveries and escalating trade tensions. The agency said that global oil demand is under pressure from escalating trade wars at the same time that an OPEC Plus is reviving output, threatening to deepen a supply surplus. The IEA predicts a surplus of 600,000 barrels a day through this year. OpenAI has asked the Trump administration to shield AI companies from state regulations if they voluntarily share their models with the federal government. The company argued that AI-related bills threaten to undercut the country's technological progress. And in sports, the Champions League quarterfinals are set after Real Madrid beat their Atletico rivals on penalties. They move on to face Arsenal, who took down PSG 9-3 aggregate across 2 matches in total. Elsewhere, Barcelona will face Dortmund and Bayern Munich will take on Inter Milan. The first leg games will begin the second week of April. And that's your brief, John.
April 8th, I believe. Thank you, Danny. Appreciate the update. No one around this table apart from me wants to talk about it, so I won't even bother. Up next on the programme.
Can I just say, this is like stacked. White Lotus and now this.
I didn't put any of these stories anywhere. Maybe there's someone interested in the control room.
Yeah. Oh, yeah.
Some of this.
Big time.
Yeah.
Mm-hmm.
Who likes European football?
Yeah. Spoiler.
Why are you so angry about it? That's what I'm trying to figure out.
Well, you still tried to out me and, you know, make my...
Out you for anything.
Yeah, for spoiling. You
it's
outed
okay.
yourself.
It's all right. Stocks are down. Okay? It's okay. Up next on the programme, US exceptionalism at risk.
U.S. exceptionalism is over in our mind. Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears. It's still a tail risk.
We'll get the view of Citi in just a moment. Dirk Willer joining us in just a second after downgrading US equities in the past week and looking to China. That conversation up next. The economic data is just around the corner, 8:30 Eastern time, so about 43 minutes from now. And going into that, equity futures drifting down towards session lows, just slowly over the last hour or so. We're down by 0.4% on the S&P. On the Nasdaq 100, we're down by 0.6. Under surveillance this morning, US exceptionalism at risk.
U.S. exceptionalism is over in our mind, but this is a decade-long. I mean, look at how much money came into the U.S. So I do think that the exceptionalism story is over. Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears. It's still a tail risk.
So here's the latest this morning. The S&P 500 on track for its 4th consecutive weekly decline as growth concerns put US exceptionalism at risk. Dirk Willer of Citi writing, in the coming months, we expect US growth momentum to undershoot the rest of the world. We therefore downgrade US equities to neutral, upgrade China to overweight. Dirk joins us now for more. Dirk, good morning. Good to see you.
Good morning.
Let's start with the downgrade on the US side. Let's talk about why. Why?
I mean, we overall downgraded equities actually already in February from overweight to neutral. For us, it was just a question, what are the overweights, what are the underweights inside this more neutral stance, right? And I think for the US, the data will remain weak. I mean, it only has started, really. The data momentum usually is weak early in the year for many reasons. It tends to trough at around late April, May. You on top of that have actually poor seasonals for the S&P going into tax payment season. So early April is usually a bad time when there was a lot of capital gains in the previous year. And more importantly, I think a lot of the economic data, especially on the job market side, is only to come. I mean, our economists called the last job report the last good job report, and it wasn't a great job report, right? It had some weakness under the hood, but it was the last decent one because we expect 300,000 plus in terms of Doge numbers. We expect 70K from people who took the buyout in the government, and that will happen in May, maybe stretched into September. The market is forward-looking, but I'm not sure we are out right now forward-looking enough to look through all the weakness that is going to come in the economic data.
Can we just sit on that weakness? What kind of weakness are you expecting? Are you expecting recessionary conditions, just below trend growth? What are you expecting?
It's a slowdown, right? And we are not in the recession camp. Our GDP forecast for the year is just above 1%. And therefore, we are not predicting, for 20% pull down in the S&P, you need a recession, right? We are not expecting that. For us, it's a question, who is the leader coming out of this? And we just don't think it will be the US. Because, a couple of things happened, right? Where we are upgrading European growth, we are upgrading Chinese growth at the same time when US growth is subpar. So it's a relative bet more than saying it's a US recession call.
This is an important point, especially at a time where a lot of people have come on the show and said the weakening was already in place before some of the policy uncertainty. And that's an important issue at a time when potentially other countries are responding with stimulus, and I'm talking about China and Europe. Just how much is this call being driven by what's going on in China and to some extent in Europe, more than what uncertainty or negativity there is in the US?
Yeah. I mean, it's both, right? I mean, the reason, for example, the big German fiscal stimulus, I think you can see it as glass half full, glass half empty. Well, it's probably more glass half full, but if it hadn't come at exactly the same time where the US data is also slowing, people would not have bought as many euros as they did, right? So it came, the German stimulus came at the perfect time for that trade coinciding with a weaker US view. And similar in China. I mean, China has not hit us over the head the same way that Europe did in terms of big fiscal bazooka, but they also have done something under the hood. They're also doing stabilizing measures, and more importantly, President Xi actually wants the equity market to go up, right? So the Xi put is closer to than the Trump put in a sense, and so we are upgrading GDP in China, and it's really interesting. The best performing equity markets this year are the ones with the biggest target on their back for tariffs, right? It's China, it's Europe, even Mexico and Canada tremendously outperformed the S&P. And I think the reason for that is it's the opposite from 2018. In 2018, the US outperformed and China obviously underperformed. And I think the main reason here is that in 2018, the US mostly targeted China. And if you just target one country, then that country underperforms and the US can source the imports from many other places. And so it's just not that bad for the US economy. If you target everyone, it's just more difficult for the US to manage through that. And for the other countries on the margin, maybe slightly easier in relative terms.
To that point, yesterday, loonie was the best performing G10 currency against the dollar, which I thought was really interesting on a day when some of these trade concerns were heating up. Why China? Why not Europe?
It's a good question. And the stories are similar in the sense in that we're upgrading growth numbers in both areas relative to the US, right? So you could say, okay, if it's mostly about that, why don't you go for Europe as well? And Europe has performed really well, and actually our European strategist caught the trade. So it's not that it's a very good question, basically. The reason why we picked China is really that we think eventually the AI story will come back. We think right now it's probably not the time to press it, but in the very big picture, it seems to me the top in the market is really only in when the AI story is over, and we don't think it's over yet. Now, the stock markets with AI assets are, of course, China and the US. Right? And so that's why we gravitated to China.
When it comes to China, though, there's an additional 20% tariffs added on Chinese goods into the United States, and they're not going away right now, and potentially they can get higher. Does that not concern you?
It is concerning, and that is obviously the main pushback to the call, right? Why do you pick something where tariffs could go up? What I would say is, one, we already had 20% tariffs, as you point out, and what happened is interesting. What happened is inflation expectations went up. Some stocks in the US that import a lot from China sold off, and Chinese equities are broadly speaking at the highs. So you can see how the market has taken the tariff so far. Now, clearly that could change going forward, and there is tariff risk. But remember, we have it as part of the neutral equity allocation, where on the other side we are short Japan. My guess is if tariffs come aggressively, Japan would not be spared, and so in the end, it's a bit of a hedge too. But I must say it's amazing how little happened so far given the tariffs we've seen.
That's the equity picture. Can we just finish on bonds? What are you meant to do with the bond allocation at the moment? What do treasuries do in a portfolio for you? What are they there for?
And there we also unwound earlier the US exceptionalism trade. The US exceptionalism trade was really treasuries will underperform because that's where the strong growth is, that's where yields go up a lot, and bonds and so forth outperform, right? We unwound that. We got a bit lucky and did it before the German big sell-off. And so at this stage, the trade we have is we're still underweight Japan, because I think that story will keep playing out, and our overweight at this stage is the UK. So the UK doesn't have the same fiscal issues as the US, as Germany, and is also a bit of a laggard. We like to receive, but we prefer to not receive in the US because the Fed is just hemmed in by the inflation picture. Instead, we want to receive in places that have been lagging in the interest rate cycle. So for us, that is the UK of the bigger markets, but we also received in Mexico, we received in Australia. We love Turkey. So there are a bunch of things where we think they're better receivers, but we're trading it from the receiving side. So we prefer long bonds and short bonds, just not necessarily in the US.
Interesting. Thoughtful stuff there, Dirk. Appreciate it, sir. Thank you. Dirk Willer there of Citi. Just on the bond market, trying to figure out where to be, where not to be, and why.
And a reversal, essentially, of the Trump trade from last year. And that's an interesting one at a time where a lot of people aren't sure how to play. Deficits, tariffs, growth, it's confusing.
We've totally rewritten the post-election playbook in financial markets across all asset classes. Coming up shortly, in the next hour of Bloomberg Surveillance, Tracy McMillan of Wells Fargo, Neela Richardson of ADP, Kayla Cedar of State Street, and a conversation with the Commerce Secretary Howard Lutnick coming right up from New York City. This is Bloomberg.
We've got a deteriorating fiscal situation here, and slower economic growth and tariffs will only make it worse.
We don't know what the pass-through of expected and actual tariffs.
What the market is playing now, in particularly the last week and a half, is increasingly recession fears.
The uncertainty is the more immediate threat, and I think it's more likely that we'll come out of this with just a slowdown.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and here's the price action. Equity futures negative by 0.25% on the S&P 500. On the Nasdaq, we're down by 0.4. On the main event this hour, 30 minutes away, the economic data. Look out for PPI, another read on inflation in America. Look out for jobless claims. How is the hard data? What is the labor market picture right now as we confront the prospect of more trade tariffs? We'll be catching up in just a moment with the Commerce Secretary, Howard Lutnick. Howard Lutnick, just around the corner.
And it comes at a time when we do get these dueling tensions in the market, and a dueling tension that we see in the data coming up, potentially where you could see inflation stickier while you have unemployment, or at least jobless claims ticking back up. That is the expectation. How does Howard Lutnick, the Commerce Secretary, respond to concerns in markets that they say are okay with them. A disturbance, a detox, as long as they get to the ultimate place. At what point does it become a concern?
So he's got to meet the Canadians a little bit later. And the objective of that, according to the Commerce Secretary, is to bring down the temperature on things. Might have to bring down the temperature on things between the United States and Europe as well. The President of the United States posting on social media just moments ago, the European Union, one of the most hostile and abusive taxing and tariffing authorities in the world. That post coming just moments ago.
He's saying that because they have a, quote, nasty 50% tariff on whiskey. He says if this tariff is not removed immediately, the U.S. will shortly place a 200% tariff on all wines, champagne, and alcoholic products coming out of France and other EU-represented countries. The temperature is just going up. You have to think this must be negotiating mode for what he calls the big day, which is April 2nd, but it's uncertain and it's frenetic.
It's lunchtime in Paris, France, and I think the president just turned to his assistants and said, 1-800 Donald Trump, please. The president's on line one.
So this, to me, is a real question about what the ultimate goal is. Is this the negotiating period ahead of April 2nd where they try to get things in stone and kind of get better leverage before that? Kate Kalukowicz, who was on earlier, who was part of the Trump administration 1.0, said that this is different because it is unclear what the goals are and what deal this president wants to strike. That is ongoing when you get truths like this.
This is for sure a maximalist approach when it comes to President of the United States and tariffs. And the issue the market is having and digesting is this is only one part of the entire Trump agenda. Deregulation, not really completely priced in yet, and we don't have the extension of the tax cuts yet, or more tax cuts added on top of that.
So honestly, at this point, what I'm looking for is how much does the market start to say the uncertainty in and of itself is going to become a feature and not a bug? And do we get some resolution on April 2nd, or does this just prolong that uncertainty as we continue with negotiations?
Some important economic data coming up as well at 8:30 Eastern Time. We need to talk about PPI after seeing CPI a little bit earlier in the week. This tees up the Federal Reserve's meeting next week. And as we've talked about extensively, they've got to put out some forecasts on March 19th. It's going to be so difficult to put out those forecasts and then walk into a news conference, Chairman Powell, face down reporters, question after question about policy and what it means for the outlook.
You know, Bill Dudley put it really well, and formerly of the New York Fed. I thought his comment on why it is important to watch the statement of economic projections was telling. It gives you a sense of their reaction function, of the idea of if they expect the idea of inflation coming up and you get some sort of slowdown in growth, do they, on the margins, expect to cut rates, or do they hold firm and try to counter inflation to a greater degree?
This is the concern for higher tariffs for a lot of people. It's both, it could be inflationary, even if it's just one-time price hike, which Scott Besson has talked a lot about as recently as the Economic Club of New York, but also hurting of growth, meaning Dudley's talking about the fact that you could see a dot plot that kind of insinuates we might have stagflation coming to America.
And this is something that central banks around the world have been grappling with. We heard that from the ECB, from Christine Lagarde. Yesterday, we heard from the Bank of Canada Governor Tiff Macklem, where he did lower rates by 25 basis points, the bank did, but indicated it might be the last and it might be kind of tricky going forward, saying the trade battle between the U.S. and Canada is a new crisis. And that right now there is pervasive uncertainty and the path forward might be tricky as they face off with the potential for inflation ticking up and growth ticking down.
Let's bring in Tracy McMillan into the conversation. She joins us from Wells Fargo. Tracy, welcome to the programme. Lots of important economic data later this morning, but just set the stage from your perspective. What this trade story means for you personally and for the team, and how you're approaching markets with that in mind.
Sure. So obviously, the tariff comments and the tariff policy on again, off again is impacting the sentiment of consumers. So we're looking at it from that perspective. At this point, this is not setting up like a typical recessionary period because it's being preceded by the weaker sentiment from consumers and not being preceded by weakness in fundamentals. Typically, what we would see is that earnings projections start to fall. We may see concern that companies are unable to finance their debts. So we see high yield spreads widening out. We're not really seeing that kind of reaction right now. So that tells us that this sell-off right now is mostly predicated on weaker sentiment, that if tariff policy were enacted as in some of the more extreme fashion that we're hearing about, that is what could probably lead to, more concern about economic growth going forward. But we really think that this will be resolved fairly quickly, and we'll move on to the more positive aspects of policy.
Tracy, you came into this year overweight U.S. assets, overweight the dollar, overweight on stocks. I just wonder how long you're willing to wait before you change your view, or you have conviction in going in right now and buying on this dip.
So we do have conviction. In fact, we just recently made an adjustment to our allocations where we pulled back some of our allocation to intermediate term fixed income, and we moved that over to mid-cap stocks. What we're seeing here is capital gains in our fixed income holdings that we want to take advantage of, move that into a segment of the U.S. market that we think could benefit from some of the policy action in the second half of the year. So we think that, once we get past some of the tariff negotiations, that CEO confidence will be revived. That could lead to additional mergers and acquisitions. That could benefit mid-caps. And we also see that mid-caps are almost as high quality as large caps, but often they get lumped in with small caps, which are much lower quality.
Tracy, appreciate your view on the market. Tracy McMillan there of Wells Fargo. Just to bring you an update on the markets right now. Equity futures on the S&P 500 down by 0.4%. No real drama there. In the bond market, bond yields are higher by 2 basis points, 433. Just want to note a little bit of economic data later, 8:30 Eastern Time, 22 minutes from now. You'll get US PPI and you'll get jobless claims as well. If you are just joining us, welcome to the programme. Let's turn back to global trade. Canada striking back against President Donald Trump's metals tariffs, slapping 25% levies on over $20 billion of American goods. Canadian officials coming to the bargaining table today. You'll hear from the Finance Minister, Dominic LeBlanc, and the Ontario Premier, Doug Ford, set to meet with the Commerce Secretary, Howard Lutnick. And I'm pleased to say that Commerce Secretary Howard Lutnick joins us now from Washington, D.C. Mr. Secretary, welcome back to the programme, sir. Always appreciate your time. If we could just take a step back and set the table, what are the stakes for today's meeting between you and Canadian officials?
Well, I think the stakes today, if you take a look at it from the big picture, is the United States said we need to have steel and aluminum domestically in America. In national security, you need metals to make bullets. You need metals to make munitions. You need metals to make everything. And Donald Trump is very focused on, let's make sure the key ingredients that are necessary to defend America are made here in America. And these other countries, they just don't pay attention. I mean, how many times do I have to say national security is important? And if you do like the EU and you respond by putting a tariff on Kentucky bourbon, which used to piss off Mitch McConnell, which doesn't really matter anymore, you got to wonder, really, do I have to deal with this stuff? But alas, we do.
Mr. Secretary, let's get to Europe in a moment. Let's just stay on Canada, and then we'll work our way to the EU if we can. For the Canadians, as you know, they've put tariffs on around $21 billion of US goods. Will that change your approach to today's meeting?
Well, I mean, take a look at that again. Let's take a step back. National security, we put a tariff on steel and aluminum to make sure the dumping countries of the world stop and we can build up our steel and aluminum in America. And what does Canada do? They put a tariff on sports equipment. I mean, really, this is just, it's tone deaf. Listen to the president. National security matters when he calls out things like semiconductors. He calls out pharmaceuticals. He calls out autos. These are things that matter to us as a country. And if you're going to respond to us with sports equipment, you're just not listening to President Trump.
Secretary Lutnick, how much are the conversations today actually about bringing up the negotiations when it comes to USMCA?
Well, USMCA, we set aside USMCA. So the United States made a deal with both Mexico and Canada that said if you have enough U.S. content in certain products or it's actually made domestically, they can trade between our countries tax-free. That remains intact. What is outside of that is both things that don't have that American content that are imported from other countries. So that has a tariff on it. And now the president has said, look, there are certain topics I need to have us make in America. And steel and aluminum is key. I mean, we all understand that. So why not allow the greatest country in the world, who completely feeds Canada? Canada exists, completely feeds off of the amazing economy of the United States of America. Let us build up our steel and aluminum so that we can protect ourselves. And by the way, we protect Canada. I think Canada's got 60 planes. Oh yeah, they're really going to protect themselves. They're the lowest investor in NATO. They totally rely on us, and yet they think they need to respond to steel and aluminum tariffs. I mean, everybody is so used to picking off America, so used to it that they can't even stop. Donald Trump is here to say we need to be treated fairly, and we need to be treated fairly now.
Do you think this approach, if you articulate this to the Canadians today, will help bring down the temperature?
I do. I think once you actually breathe and think steel and aluminum, America needs steel and aluminum. I mean, if you respond like the British didn't respond, the Mexicans didn't respond, you have some countries that actually thoughtfully examine how they do business with us. And then you have people like the Canadians who are in elections, so you have no idea. You think it's about a trade war. This is their way of getting election votes. And the EU, the EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here, and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect, and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it together. We're going to describe our trading policy. We're going to describe our balance. But remember, semiconductors, we need to have them in America. Pharmaceuticals, we need to have in America. Cars, we need to have in America. And steel and aluminum, come on. America, and lumber as well.
And
These
wine
are
and champagne.
important things for our national security.
And the wine and champagne, sir. Don't forget the wine and champagne.
Come on, that's just that. If you make him unhappy, he responds unhappy. But come on, let's get back to the core basics here, which is a trading policy that says America has allowed the world to lean on us, to take from us, to grow off of us, and now it's time for a little balance. We've got a $2 trillion budget deficit. We want to bring certain jobs home. Let the president do the right thing for America. He will respond after we're done organizing things to make sure the world grows. But today, just remember, he's the president of the United States of America. He's not the president of the world. He's going to take care of American workers, and it is time.
Mr. Secretary, I just want to make sure that the audience is in on our little joke there, because they might have missed the post by the president a couple of minutes ago. So I'm going to share it with them and then come back to you in just a second. So the president of the United States put this out on Truth Social moments ago, said the European Union, one of the most hostile and abusive taxing and tariffing authorities in the world, which has formed for the sole purpose of taking advantage of the United States, has just put a nasty 50% tariff on whiskey. If this tariff is not removed immediately, the United States will shortly place a 200% tariff on all wines, champagnes and alcoholic products coming out of France and other EU-represented countries. So, Mr. Secretary, just to bring you in, I imagine you are aware of what the president said based on our conversation just now. Have you given the Europeans a warning on this? Have you given them a time limit to back away? Are you taking the same approach you did with the Canadians just a few days ago?
Well, I think the president has made it crystal clear that he finds this tit-for-tat really abusive and aggravating, right? His objective is steel and aluminum tariffs. Let him build his steel and aluminum business in America, because that's important. And then, they say, okay, we're going to tax whiskey. And look, I find all this back and forth really off the topic. The key topic is rebalancing American trade. We're going to spend lots of time together, but the president was totally annoyed that the Europeans did this. And so you're going to hear back from someone who emotionally cares about America. He cares about America, and he wants to take care of Americans. And why are Europeans picking on Kentucky bourbon
Secretary
or
Lutnick,
Harley-Davidson motorcycles?
Are you saying this is an emotional response?
It's disrespectful.
Are you saying this
I'm
is emotional
saying it's a
response, or will we
disrespectful
see 200% tariffs on wine, champagne, and alcoholic products before April 2nd, when the president says is the big one, and we're going to get the reciprocal rollout?
Well, the joy of my job is that Donald Trump makes the decisions, right? And the people around him, we talk to him and we advise him. April 2nd is when we do reciprocal tariffs. And he's called out these products. He wants these countries to respect him. And all this showed you is that Europe and Canada do not respect Donald Trump and do not respect America's ability to build its steel and aluminum industry, which is vital for national security, whereas you watched Mexico and you watched the UK be pragmatic and thoughtful, and the way we're going to deal with them is going to be better. So these are just black and white things. Why would you put against steel and aluminum, would you say Harley Davidson motorcycles and Kentucky bourbon? It's just illogical. I think the president is saying, look, I am going to respond always bigger and always stronger. We will talk together. You know, he wrote that tweet this morning. We will talk together. If that's what he wants to do, we will do that. But the answer is April 2nd, a thoughtful approach to reciprocity and national security of those products he's called out. We're going to increase our domestic production of those and have a reciprocal model. And hopefully when I talk to the Europeans, they'll realize that they should take these things down, cool these things out, and let's properly negotiate.
Do you have
after
plans
April
to speak to your European counterparts today?
Of course.
Like who? Are you speaking to, say, Ursula von der Leyen, or potentially some heads of companies like Bernard Arnault, who was also at the president's inauguration?
Generally, as the Commerce Secretary, I speak to the trade ministers. That's generally how it goes.
But a lot of companies also, and I know executives, have been calling you, sir. Is that not correct? They're looking for exemptions. Exemptions, carve-outs, fall squarely in the Commerce Department.
So let's talk about exemptions for a moment. Steel and aluminum tariffs went in 2018. And when we came back into power, the Biden administration had granted 490,000 exemptions. Imagine 490,000 exemptions to steel and aluminum tariffs. I mean, I don't know that our department could actually collate 490,000 Christmas cards, let alone 490,000 steel and aluminum tariffs. I mean, come on, it's ridiculous. So yesterday, what we did is we just got rid of all the exemptions. That's all we did. The steel and aluminum tariffs were already on. We just said, look, let's just build back our steel and aluminum industry in America to protect America. It's so logical. It's so important. Yeah. And then all we get, you get some countries who understand and some countries who just go right back to old school. And, you know, the president's going to deal with them with strength and with power. And he's remembered that they like to respond with just go after their wine and maybe they'll pay attention and listen. But the fact is, April 2nd, we're going to go with reciprocity, thoughtful, global process.
Secretary Lutnick, it's going to take a while to actually get those tariffs in place after all of the appeals process, et cetera, after April 2nd. And in the meantime, as all of these discussions around tariffs continue, a lot of businesses are just halting investments. You're seeing consumer sentiment decline. You're seeing their spending activity decrease. Can you give them a sense of when they'll have certainty?
The opposite actually is coming true. You saw Apple, $500 billion. You saw SoftBank, $200 billion. Eli Lilly, $40 billion. I'm meeting a company today who sent me a note saying they want to invest $65 billion in America. The scale by which American companies are committed to invest in America and global companies.
Secretary Lutnick, excuse me, what I'm talking about,
huge,
let me explain to you what I'm talking about.
Investments, and those are coming. Well, let me finish. These are huge investments coming to America. Over $1.7 trillion committed in Donald Trump's first 50 days. Anyone who thinks people are uncertain doesn't understand what Donald Trump is saying. He's saying, bring your production to America and you will avoid all the tariffs. Come build in the greatest economy in the world, and you will avoid tariffs.
That's maybe long term, but what we're seeing in the short term.
News when you want it with Bloomberg News Now. I'm Amy Morris. U.S. consumer sentiment fell to a more than 2-year low, with the preliminary March sentiment index dropping to 57.9. University of Michigan Director of Consumer Surveys Joanne Shu says it is clear consumers are worried about policy changes.
Particularly these tariffs that are changing on a daily basis, kind of policy going in circles. Consumers are really worried this is going to pass through to the prices that they see, and they're concerned this is going to be something that's going to affect not just the short term, but the long run as well.
Consumers expect prices to rise at an annual rate of 3.9% over the next 5 to 10 years and 4.9% over the next year, with long-term inflation expectations jumping by the most since 1993. Consumers' expectations of their finances dropped to the lowest level on record, with 48% of survey respondents mentioning tariffs as a concern, citing uncertainty around policy and economic factors. U.S. stocks are rebounding, calming some investor nerves after a sell-off that drove the S&P 500 down 10% from its all-time high. We do check markets for you all day long here at Bloomberg. The S&P 500 is up 1.1%, NASDAQ up 1.4%, the Dow up 0.7%. The 10-year Treasury yield at 4.3% and the 2-year yield at 3.99%. Now, gold prices have surpassed $3,000 an ounce for the very first time, driven by central bank buying, economic fragility, and President Trump's trade policies. COMEX gold right now is up 0.1%, or $5, now trading at $29.96 per ounce. NATO Secretary General Mark Rutte says relations with Russia should be normalized once the fighting ends in Ukraine. His biggest task is to keep the U.S. engaged in NATO amid Trump's common refrain that members are taking advantage of the U.S. by not spending enough on defense.
We have seen 800 billion from the Europeans. We have seen this half-term package from the Germans, but also the Brits, the Swedes, the Czechs, the Belgians, so many others ramping up. And this is because they sense that with Trump in the White House, this is necessary, but also, of course, because we all realize in Europe and here in the US that Russia and China pose a threat, and that we have to rearm ourselves because they are doing this at an incredible pace.
NATO Secretary General Mark Rutte on Bloomberg Television. President Trump appealed to Russian President Vladimir Putin to spare the lives of thousands of Ukrainian troops, saying that they were in a very bad position and avoiding a massacre. Trump made the appeal as the U.S. is looking to persuade Russia to agree to a 30-day ceasefire with Ukraine. Now, President Putin asked American envoy Steve Witkoff to convey messages to President Trump during their late-night talks in Moscow. A decision on a phone call between Trump and Putin will be made once Witkoff has passed on the information from the talks. Senate Minority Leader Chuck Schumer says he does plan to vote for a House Republican funding bill to avert a federal government shutdown. This after a closed-door meeting of Democrats where Senator Kirsten Gillibrand yelled so loudly, reporters said they could hear her through the walls. Oregon Senator Jeff Merkley says he's hearing from his constituents who are unhappy with the way President Trump is running the country.
This is chaos, and it feels like it's touching them in every possible way. They're feeling Trumpflation from rising grocery prices. They're feeling about their businesses uncertain about what they're going to be sell or what retaliatory tariffs there might be.
Merkley says he will not vote for the House bill. The Senate is set to grill Dr. Oz today over his nomination to head Medicare and Medicaid services. So you can brace for some especially aggressive questioning, including over legal maneuvers that Mehmet Oz used to pay no Social Security nor Medicare taxes in 2023 and negligible amounts in 2022. The 64-year-old TV celebrity is likely to be approved by the Republican majority at today's confirmation hearing. The FAA says it's permanently banning all non-essential helicopter operations near Reagan National Airport, just outside Washington, D.C. It is also closing a route used by a U.S. Army helicopter before it crashed into an American Airlines regional jet, killing everyone on board both aircraft. That's news when you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
on Monday and have the news media say, oh, look what you did on Tuesday. I mean, come on, that's so silly. So the real way the world works is, for sure, the fourth quarter is Donald Trump's quarter, and the third quarter, his policies start to really embed in America. So that's the right way to look at it. First and second quarter are Biden's sort of left behind difficulty, and then you see Donald Trump dig us out, build us up, and by the fourth quarter, you're going to see growth rates because you got all these companies committing to build in America, get their shovels in the ground because we get regulations out of the way, start to produce those jobs, start to bring back trade craft. You know, electricians who build giant factories, HVAC specialists who cool those, and then mechanics who fix robots. You've got tradecraft coming back to America. It's going to be amazing. We're going to have the greatest training program ever because we need to train our great workers for the AI revolution and the tech revolution that is coming, that Donald Trump is bringing to construction and development in America. And we need to train our people, and they're going to have great jobs.
So going forward, do you just look through all of this weakness? You've talked about how, and we've heard a sort of detox period, et cetera. Do you look past all of the data in the first and the second quarters as simply backward looking and look forward to what deals are getting done?
My job is to look forward to what deals are getting done. I'm going to bring in, because Donald Trump has created the policies for me, to bring in enormous investment to the country, $1.7 trillion so far committed. And we're going to put out a website and literally show these companies construction and manufacturing in America quarter by quarter to show this kind of growth. Remember, each trillion of this kind of committed construction is worth 1 point of GDP. So at $2 trillion, which we definitely will have for sure, that's a 0.5 point of GDP for all 4 of his years. So as that grows, you're going to see that growth come into our GDP numbers. Obviously not today. Someone says, I'm going to build $65 billion in America. When can they get in the past, it would take 1.5 years to get the permits to build. Under Donald Trump, it's going to take less than 6 months. They're going to be in the ground this year, and the fourth quarter, you're going to see this power. So, yes, do I have to say the first quarter is surely Biden, the second quarter is Biden, but starting the third quarter, you start to feel some Donald Trump, and the fourth quarter, you will feel the power of Donald Trump's economy.
Secretary Lutnick, I'm sure you've seen this report in Politico. It says that White House officials, Trump outside allies are, quote, growing increasingly frustrated with you, sir, privately complaining about the close proximity.
You got to stop the fake news. Please,
hold on.
God,
no, I want to give you the chance,
news.
sir, to respond to this.
Stop the fake news. I don't want to respond. When you read fake news, okay, I spoke to the president last night. He said, why do these people write this fake news? It's just nonsense. Imagine Jameson Greer, who's our USTR, who works with me. And obviously, if you remember when the president nominated me, he nominated me to say, go select the USTR and work closely with him. Anybody who says this kind of stuff, these articles talk about the Council of Economic Advisors. They're not even populated yet. The nonsense that we have to read while people just are trying to be troublemakers where it's entirely fake news. I don't need to respond. Okay, I really don't need to respond. I speak to the president all the time. Our economic team is one. We are together as one. We get along incredibly well. We speak to each other all the time, including yesterday for an enormous amount of time, every day, today again. It's got to stop. I mean, look, these lousy, media outlets, they try to create something so that you'll talk about it. Think about it. They got you to talk about them. I don't even want to say their name. They don't deserve to be read because it's nonsense.
Out of respect for you, sir, we just wanted to give you the opportunity to respond, and in your own way, I think you have. Mr. Secretary, thanks for being gracious with your time. You've been very generous. Appreciate it. We've got to get to some Biden data. Commerce Secretary Howard Lutnick there. Let's get to that economic data. I'm joking. PPI and jobless claims out just moments ago. Mike McKee has the information for us. Good morning, Mike.
Morning, John. I'm not sure this is Biden data because yesterday the CPI came out lower than expected and the administration called it Trump data. Today, lower than expected. So let's see what they say about this. PPI comes in just flat for the month of February. The expectation was it would be up 0.3%. It was up 0.6% the month before. So a significant slowing in producer price inflation. The core is down 0.1%, and the core ex trade is up just 0.2%. So on a year-over-year basis, headline 3.2%. For year over year, and the core 3.4%, ex-trade 3.3%. These are all signs of significant progress on the wholesale level. Jobless claims, 220,000. That's down from 222 last week, and it does show there hasn't been much change in the labor market. Continuing claims, 1,870,000, down from 897,000. Federal claims for the last week, 1,580, which is a decline from last week's number. But we're going to start changing the data point that we care about and look at continued claims for federal workers. That'll give us a count, 8,215. That's an increase of 803 from the previous week. So progress being made. One other point for the PPI. A lot of the PPI is lower, but interestingly enough, steel prices, aluminum prices, both went up in the last month, perhaps in anticipation of the tariffs. And then the things that go into PCE, like airline fares were flat last month, same as the opposite of what happened with CPI. And so that should be good news for PCE, portfolio management, up by 0.5%. That will feed into PCE on a negative side.
Mike McKee, thank you, sir. So for the second straight day, we've had a softer than expected inflation read. Yesterday was CPI. This morning is PPI. Just want to draw your attention to the bond market. Just take a look at this. You'd expect yields to be dropping. They're not. Again, they're higher on a 10-year by about 2 basis points to 433. I don't think these moves are large. I don't think they're big. But I think the direction is interesting and suggests that maybe the market is focused on something else. And that something else might be the threat of further tariffs. This came from the president just about 30 minutes ago. The United States will place a 200% tariff on all wine, champagnes and alcoholic products from France and other EU countries. This was in a Truth Post social post just moments ago. The president saying he will place the tariff if the EU does not remove its 50% tariff on whiskey. I think that's the issue right now this market's got, Lisa. Just how relevant is the economic data going into the Federal Reserve next week when we've got the threat of policy changes that could completely change what this data looks like right now?
You're picking up on exactly the right thing, which is that backward-looking inflation data has less relevance than, say, the labor market cracking, which might give the Fed the excuse to cut rates. What you're seeing right now is disinflation. Yay. Otherwise, that might give a pass to the Fed. But what you're seeing is a labor market that's holding in there better than people expected. So instead of focusing on the disinflation, people are looking to the tariffs and saying, forward-looking, they're going to have a very difficult scenario on their hands. Front-end yields up. And that, I think, is notable.
With us around the table, Neela Richardson of ADP. Neela, good to see you. Good morning.
Great to be here.
Let's talk about this data. How relevant is it for the Federal Reserve, for anyone setting policy right now?
It's relevant because it gives us a baseline. And that baseline is strong. You see inflation moderating. You see the jobs market holding pace, unemployment low. So overall, the U.S. economy, despite the uncertainty and the malaise and haze of uncertainty, the U.S. economy is still solid. What we have to learn now how to do in this transition period is drive through the fog. Can we still grow? Can we still maintain? Can inflation still moderate? And importantly, can firms still hire when under foggy conditions instead of clear ones?
In the fog, people are looking for some sort of little lights to get a sense of what direction we're going in. And one of those lights was the guidance from some of the big airlines talking about travel, particularly from businesses cutting back. How much do you see that as an indicator of companies taking the first steps to trim costs before taking that extra step of cutting jobs?
Right. Well, we've already seen it in the data at ADP when we put out our national employment report. There is a hiring hesitancy, and that is completely in line with not knowing what the economic climate is. So you think about airlines and airline prices and business travel and whether the consumer, which has been trending softer and weaker as well, will show up at the airport. So while there's a lot of well-deserved attention on tariffs, let's not lose sight of the consumer whose spending has slowed in this interim, and they're anchored on higher prices, not necessarily lower inflation, which could mean that their spending patterns also slow simultaneously with this increase in uncertainty.
We were speaking earlier today with former New York Fed President Bill Dudley, who said this market seems to think that there's going to be some sort of Fed relief valve. He doesn't see it because he doesn't think the unemployment rate's going to really creep up all that much. And that is sort of the key indicator for this Federal Reserve to cut rates. It seems like initial jobless claims weren't out of the ordinary, 220 versus actually expected 225,000. Do you agree with Bill Dudley?
Yes, I actually think that you might see unemployment rates creep down and before they trend up again. If you look at the data, what it suggests is a certain stasis, and we've talked about this, a certain stability in the labor market, especially looking at ADP data, we see a stability in small firms. There's not a lot of turnover there. There's not a lot of separations. There's not a lot of layoffs. And importantly, there's not a lot of hiring. On the large firm side, higher turnover, which is consistent with an unemployment rate that is either holding steady or going down, as there's still some opportunities with these larger firms. So overall, the labor market picture is holding up. So there's not a lot of wiggle room for the Fed, because that holding up could turn into labor market tightness pretty quickly.
Why is this number 220,000? And I ask this because a lot of us were expecting to see the results of some of the Doge cuts in these data, and we don't seem to be seeing a material tick up. If anything, the jobless claims went down.
These are early innings, and the response has not been completely incorporated into hiring decisions across the board. Also, this isn't a macro indicator. Really, the heat comes from the sector analysis, the frying grain data. So when you look at the data in terms of education, healthcare, you see a lot of hesitancy. In fact, a real slowdown in that sector in response to new decisions on federal grants to universities, hospitals, and social assistance. So these effects are going to ripple through the economy in different ways at different times. So a headline number, it's not going to tell you the whole story. It's just going to tell you a piece of it. And that piece is still important to the markets, that the labor market still looks solid.
Nila, appreciate it. The good news, the baseline's still pretty decent. Nita Richardson there of ADP. Thank you, Nita. Thank you very much. Joining us now is Kayla Cedar of State Street. Kayla, welcome to the programme. This came from Torsten Slock of Apollo. I'd actually love your thoughts on it. So he said this is the wait-and-see economy, went on to say that in a wait-and-see economy, it eventually leads to a slowdown in the hard data. Do you think it's premature to extrapolate the weakness we're seeing in the survey data into the hard data anytime soon?
Well, first, thank you so much for having me. And yeah, I do think it's a little premature, especially because when we do see some of the hard data, it still looks strong. And some of that more high frequency hard data still looks strong. So, you know, the claims data we got today looks okay. When we look at some of the consumer credit lending data, credit card lending is still very strong. So from that perspective, you know, that tells me it's hard to bet against the U.S. consumer right now, even though uncertainty is higher than it was before.
Kayla, do you think that this market has overpriced some of the weakness that we've seen in the soft data and extrapolated it into a pretty big economy that is pretty solid? Or do you think that right now the market's picking up on something that could come to pass in, say, 6 months' time?
You know, I think from here, when it comes to expectations for the Fed and Fed cuts, 3 cuts right now, you know, looks like that looks to me like the market is pricing in more uncertainty. However, to get more than that priced in is going to be really hard. I think you need to see more of that weakness in the hard data that we haven't seen just yet.
Which is the reason why right now the bond market's move is so interesting. On the heels of this data that came out just 13 minutes ago we're looking at bond yields creeping higher even on the front end, even though we did see that disinflation continue with PPI coming in softer than expected. It seems like the bond market, as John was saying, is looking at something else and expecting the Fed to be on hold for a longer period of time. Do you think that is the correct response? Do you think that bonds don't offer the same kind of ballast as they have in the past?
I still think cash is the better decision right now for a couple of reasons. One is that the front end of the yield curve, so thinking bills versus 2 years, that's still inverted. And, you know, as previous speakers mentioned, the Fed isn't in a position to cut just yet. And I think as well, when we look at where we see the market increasing rate cut expectations, it's not, it's not for next week. It's not for the May meeting either. And so that keeps cash pretty attractive right now.
Bond yields higher across the curve at the moment on the 10-year, up by 2 basis points at 4.33. Katie, we've got to leave it there. Katie seated there of State Street on the bond market. Following economic data, the kind of economic data that if you're the Federal Reserve, this is what you want to see. Softer on CPI, softer on PPI, going into the Federal Reserve meeting next week. Make it easy breezy. Inflation's trending in the right direction. We can maybe reduce interest rates over the next 12 months or so. They can't do any of that. They can't do any of that because they don't know what policy is going to be down in Washington, D.C.
And in some ways, they could probably say policy's been a pretty good place, at least if you take a look at the jobless claims. But again, this is backward looking. Everyone is saying that. And when you look at the high frequency data, this is the reason why. And I keep going back to this. Stuart Kaiser said that the University of Michigan sentiment survey tomorrow is oddly important. It might be the most important data point of the week because we'll get inflation expectations and sentiment, and that seems to be in the driver's seat.
The policy is frenetic at the moment. Just 45 minutes ago, the President of the United States is talking about a 200% tariff on EU wine, champagne, and other alcoholic beverages unless they strip away their 50% on whiskey. And Secretary Lutnick comes on this program and says, we're done with this tit for tat. But you look at what allies are saying, and they're saying, but you started it. We would like to have a negotiation, but you come out with truths saying we're going to go to 50% on steel just on Canada, 200% just on Europe.
There was a piece of that interview that jumped out for me, and he alluded to this. He didn't say it explicitly, but the idea of dealing with China was different. Because we asked the question, if you put tariffs up on China, is there any evidence at all that China are reducing theirs in response to that, if that's the desired outcome? And at the moment, over the last several years, we've seen no such outcome whatsoever from the Chinese Communist Party. Almost alluded to the idea that it was easier to bully democracies that are accountable to their own electorate because they have to respond, they have to take the temperature down because they know the economic consequences won't be good.
There's been a different approach, not just with China and the leadership there, but also with Russia and some of the autocracies that are not guided by the same types of democratic principles have had a quieter time of it, which is sort of interesting in terms of negotiating tactics. But ultimately, there might be different outcomes, too, that are desired.
Also, China did not live up to Trump 1.0 phase one trade deal. And I imagine that is in the back of their mind. So they're not willing to negotiate at this moment yet with China, though there are reports that potentially there's a meeting underway that could happen in the spring, early summer. Did you notice Secretary Lutnick did on this instance not want to get ahead of the president?
Yes, a shift, a change. I will take note of that. Equity futures right now in the S&P negative by 1/3%. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Just the details of what President Donald Trump said on those tariffs. He's threatening to enact a 200% tariff on European wine, champagne, and other alcoholic beverages. The president writing in a Truth Social post that he will move forward with the duties if the EU doesn't repeal a tax on U.S. whiskey. The Federal Trade Commission, meanwhile, is moving ahead with an antitrust probe of Microsoft that was open to the final days of the Biden administration. Bloomberg has learned that the FTC is scrutinizing Microsoft's decision to slash funding on its own AI projects after striking a deal with OpenAI, which could be perceived as hurting competition. 2 NASA astronauts stuck in space will have to wait a little bit longer to get home. A launch pad problem prompted SpaceX to delay a flight to the International Space Station, and the crew needs to get to the International Space Station before Butch Wilmore and Suni Williams can head home after 9 months in orbit. And that's your brief, John.
Danny, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead and give you a sneak peek of next week as well. From New York City, this is Bloomberg. The opening bell about 40 minutes away. Equity futures going into that declining just a touch. We're down by 0.25% on the S&P. On the Nasdaq 100, lower by 0.4%. The trading diary through the next week or so looks like this. At 12:20 Eastern Time, President Trump meeting with the NATO Secretary General on Friday. UMich consumer sentiment, another important read on inflation expectations. Then at midnight, a U.S. government shutdown deadline. Sneak peek of next week, retail sales on Monday. Wednesday, a Fed rate decision. and an important Chairman Powell news conference. Also important, of course, is what is happening with the relationship between the United States and a range of allies, including the EU. Take a listen to what the Commerce Secretary Howard Lutnick said just moments ago about the European Union.
The EU has just so many years treated us so harshly. They just can't stop. Look, their tariffs are way up here and our tariffs are down here. How about relax? Let us balance it. We are your largest, most important trading partner. Treat us with respect and let's get a little balance. And Donald Trump is out there saying balance, balance, balance. April 2nd, he's going to describe his balance. We're going to do it together.
Let's bring in Tyler Kendall from the nation's capital for more down in Washington, D.C. Tyler, the president saying more than balance this morning. Pretty strong message for the Europeans about an hour ago.
Right, John, that post on Truth Social, President Trump threatening up to 200% tariffs on alcoholic goods. It was interesting to hear Howard Lutnick on this program saying that President Trump was, quote, aggravated by the response that he saw from the EU and that this White House wants to see partners like Canada and the EU start to negotiate a little differently here, like they've seen from Mexico and the UK, for example. You'll recall when the UK Prime Minister Keir Starmer was here at the White House last month, President Trump was pretty open that he much prefers to negotiate with London over Brussels. I was also struck by in that interview that he gave us some indications on when this White House is going to start to transfer from what they have been calling Biden data to Trump data, telling us to look ahead to the fourth quarter.
When it comes to today's meetings, Tyler, it's going to be all about Canada. And Howard Lutnick in that conversation said a lot of what's being driven in terms of Canada and what he would maybe say they're posturing comes from domestic political considerations. If that's how they're going into this meeting, that kind of mindset, what do you think we're going to get out of it?
That is the biggest question here, perhaps, and important to note that at that meeting also will be Ontario's premier, who Howard Lutnick has already negotiated with at least once this week to get them to drop that 25% electricity tax in order to have this meeting today. What this White House really wants, it remains to be seen. This interview from Howard Lutnick really pushing that they are trying to rebalance trade, make this all about those reciprocal tariffs. But we know going into today, this White House has put a lot of factors on the table, from border to national security to also how they'd like to see tariffs used as a revenue raiser.
Hey, Tyler, appreciate the breakdown. Great summary of things right now. Busy day ahead for everyone down in Washington, D.C. Bloomberg's Tyler Kendall there. Lisa, we did get one answer, one very clear answer. Biden data versus Trump data. Right? We figured this out? We've got a calendar now?
We've got a calendar. Trump data is third quarter, maybe, but definitely fourth quarter. Okay. Biden data is first quarter and second quarter. So what we're looking at right now is Biden data. And what the Biden data shows right now is initial jobless claims that came in lower than expected and disinflation in the actual PPI, although maybe with the bond market stiffing out, revisions to the upside on the prior PPI reading. So still an inflationary undertone here that has some people's attention.
One thing that they're taking full credit for, maybe Trump capital investment, say Howard Lutnick brought it up. Apple's $500 billion. Actually, that started previously years ago, and a lot of that happened under the Biden administration, but obviously he's not going to point to that. I'm struck this morning by the president coming out with 200% tariff on EU wine, not because we haven't seen a chaotic, frenetic rollout, but also because you can imagine his friend, who he likes to consider his friend, Bernard Arnault, the shares of LVMH this morning are now taking a hit because of this. What kind of carve-outs potentially can we see with this administration? Because Howard Lutnick's basically saying there are none.
We're opening up a major debate without realising it. Can you substitute French wine for Napa Valley wine? I say.
Okay, really?
I'm old world. I'm an old world girl, so no.
First of all, they all have different tastes. You taste the land. It's enjoyable to taste different land.
Nice.
It's like traveling through a bottle.
Opus one's pretty good.
Yeah, I know.
You know, it's like,
I'm shocked you brought that up.
I remember once.
Good wine.
Do they subsidize you?
I remember once for dinner, Obama did Virginia champagne. I'm not sure it landed.
I've been down there. I've seen all those barrels.
Oh, I know you have.
Yeah, no.
Yeah, every time.
That's good stuff. All right. Coming up tomorrow, Chris Verona of Strategas, Jessica Taylor of the Cook Political Report, Maya McGuinness of the Committee for a Responsible Federal Budget, and the NATO Secretary General Mark Rutte. Looking forward to doing all of that and more as we make our way into the weekend. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. New mom Belinda Bencic continued her dream return to the WTA Tour with a thrilling three-set victory over Coco Gauff to reach the quarterfinals. The victory follows her triumph in Abu Dhabi last month and was her first top 3 win since beating Jessica Pegula in Charleston 2 years ago.
That's why
we live and invest in a time of extraordinary volatility and very quick changes when it comes to news flow, policy direction. How are you navigating this?
Morning. Nice to be back. So yes, a very volatile environment. We expect this to continue for the foreseeable future. I think you basically have U.S. and then you have pretty much everywhere else. And in the U.S., what you see under the surface is a relatively large rotation from growth momentum into value and quality. And you can do that through specific sector or factor funds, or you can move into places like Europe and to some extent China on a global perspective. So when it comes to U.S. specifically, there are things that are working. Fixed income, for example, looks pretty good. Systematic funds, liquid alternatives, these kind of things which are unconstrained and or market neutral, because I think the summary is essentially investing in core index type of exposures, beta exposures, is not really going to work in this environment. So you need to diversify, you need to get some fixed income exposure, and you need to move into some more active type of exposures for the U.S. And then obviously there's everything else globally that we can talk about.
And I know one of your sort of strategies for the US is to broaden out themes and to navigate that volatility. But is it more compelling just to take a look at some of the other non-US opportunities, given the performance divergence we've seen with China, with certainly Europe?
Yes, definitely. I mean, at the very basic level, most of our investors are benchmarked to a global equity benchmark. So, you do have around 2/3 of that exposure is in the U.S. So taking a huge underweight there is obviously a risk. But there is a broadening out happening in terms of performance and earnings growth. Equal weight type of exposure has been working quite well. That's something we were pushing since the start of the year. Financials have done relatively well. Again, that's something that we've been pushing from the start of the year. And the growth to value rotation, as I mentioned. Outside of that, Europe has been a little bit of a surprise, but there is a divergence going on between what we're expecting from the Fed and what we're expecting from the ECB. And you have the valuation differential, right? So, U.S. outperformers, there's been some profit being taken there, particularly in the tech space. Europe has been relatively cheap, and Europe is a value market. So generally, when we start to see those rotations, investors will move into Europe. So in February, we actually saw the highest inflows into European exposure ETFs since 2021. So relatively big moves there. How long that rotation will last, I think, depends on how well the U.S. economy does and how earnings growth comes through there. And then you have places like China and Japan. China specifically, as I'm sure most of your viewers know, has been a relatively narrow but pretty significant rally to the upside for some of these technology names. China is really where the money is in motion at the moment. And I think the next question is basically, do we start to see a pickup in earnings? Do we start to see a pickup in consumption? 5% GDP target is relatively optimistic. And do investors start to move more into some of the onshore names?
So for China, it's interesting because, for China, we've sort of been waiting for the big global funds to come into play with this rally as well, right? It sounds like it still depends on a broader macroeconomic environment picking up, policy support picking up, rather than it just being a very idiosyncratic, AI, DeepSeek, private tech-driven type of story?
Yes, exactly. I mean, if you look at the rally post the relative surprise in terms of PBOC announcement at the end of September, that was basically domestic type of stocks moving, which is something we don't tend to really see at the start of a China rally, because investors tend to move into the ADRs tech space where there's a little bit more liquidity and it's more accessible to overseas investors. That rally didn't last very long, and we saw a lot of that inflows moving back out. The tech rally has been a little bit more of a surprise, and that's happened in a very narrow part of the market. And so we have seen interest in things like Hang Seng Tech Index. MSCI China is a little bit broader, but not so much interest into the domestic onshore names. And in order for that interest to move back into domestic onshore names, it is primarily an onshore liquidity growth type of story, which the green shoots are there, I think, but it's going to take a little while for that earnings growth to come through, to see a pickup in consumption, a downturn in terms of youth unemployment. So I think that might possibly be the next move for the China market.
Hong Kong tycoon Li Ka-shing's CK Hutchinson is in the spotlight after its deal to sell a controlling stake in Panama Ports to BlackRock. It's become the subject of a scathing piece in the pro-Beijing newspaper Ta Kung Pao, which was then reposted by China's top office on Hong Kong issues. The commentary itself accuses CK Hutchinson of spineless groveling, that's a quote, and, quote, selling out all Chinese people, warning it to, and again, a quote, think carefully about what position and side they should be on. It also points out that China's shipping and trade could become subject to U.S. control. China's Hong Kong and Macau Affairs Office shared the article in full on its website, fueling speculation that it also reflects the central government's own sentiment. Bloomberg opinion columnist Shuli Ren is with us. Shuli, your reaction to this?
I think it really was a scathing commentary, if you read through it. And I think I can see why China is kind of pissed off, because it's no secret that CK has been wanting to sell its port business over the years. And all of a sudden, there's a push factor coming from Trump. And I can see that the government is not too happy about that.
So you've also written, I know across your work you've written extensively about Li Ka-shing, but recently about the reputation that he has as a sort of so-called Superman.
Yes.
You take a slightly different view. Why is that?
Well, he is nicknamed Superman in Hong Kong, and people do look at his, M&A merger and acquisition moves to see what his true views are about China and the rest of the world. But in terms of shareholder returns, the Li family has not treated Hong Kong's shareholders well at all. If you look at the CK Hutchinson, their holding company's shares, Hong Kong, right? over the last 10 years, this stock is basically in the doghouse, right? Like 10 years ago, it was traded at a 1x book. Now it's 0.3 times. The Li family basically didn't really get the Hong Kong residents enjoy their business acumen and prosperity.
So that being the case, what can the Li family do to make amends with Hong Kong people, improve their reputation?
I think it's probably the 96-year-old's last chance to make amends, right? And the one thing they could do is to improve shareholder returns. They got the $19 billion from the port deal. And to be honest, the Chinese government, there's not much Chinese government can do about it. It's pretty much a done deal, right? And what are they going to do with that $19 billion? $5 billion will probably be used to repay debt. And the rest, they can issue shareholder buybacks or special dividends. I mean, if you look at the other Hong Kong listed companies, Alibaba, Tencent, when their share prices were not doing well, they were trying to reward shareholders with buybacks. And the Li family has not done so at all.
Youth unemployment is an issue in all labor markets. That's why it's one of the major pillars of the conference. One of the difficult things in dealing with labor market that if you change anything, it takes years for us to be reflected. That's the right thing to do, to look at the future and prepare from now. If you have the best practices, the right data, well, you will be able to overcome any difficulties or challenges. I'm hopeful about the future of the labor market.
That reversal of fortunes, we're talking about U.S. stocks shedding about, what, $5 trillion in value. We have the NASDAQ down 5% and what, Dow 900 points low. I mean, how are you making sense of what we're seeing in the markets right now?
Well, I'm not joining the panic. The S&P 500 is down 8.6% from its February 19th peak. So it wasn't that far back that it actually hit a record high. And if you look at the 11 sectors of the S&P 500, only one of them, that's consumer discretionary, is actually in correction territory, which is pretty impressive considering that the Magnificent Seven are down 16% from the February 19th stock market high. So I think the market's actually held up remarkably well in the face of the major correction in the Magnificent Seven. And so I'm not giving up on American exceptionalism. I think what's happening is a lot of the technological innovations that have driven the Magnificent Seven are now actually benefiting the productivity of the S&P 493.
If U.S. exceptionalism is on pause, how long is this pause, you think?
I don't think it's going to be very long. I think right now we had some very overvalued Magnificent Seven stocks. They were selling at a forward PE of 30 a few weeks ago, and now they're down to 26, maybe 25. So we've had a significant correction in the valuation multiple, but these are still great companies. You know, a lot of them are cloud companies. There's still a tremendous demand for cloud, and that's only going to increase with artificial intelligence. So this idea that they're spending all this money on data centers and it's not necessary, I think that flies in the face of the fact that they've got tremendous demand from customers to do more computing on the cloud and more storage on the cloud.
The thing is, Ed, despite your optimism that, you know, U.S. exceptionalism is possibly on pause, there's data out there suggesting that the U.S. economy is weakening. That can be seen from the latest data. And of course, when you take a look at U.S. policy uncertainty, that is at the highest level in 25 years. So surely that may have an impact on sentiment.
Well, there's a really high noise to signal ratio in the economic data, just the way there is in the political realm these days. But for example, we all are familiar with the Atlanta Fed's tracking model for GDP, and that now shows a decline of about 2.5%. And that was after showing an increase of about 2.5% only a few days ago, actually. A lot of that had to do with this bizarre surge in imports during January, and everybody thought that was companies front-running tariffs. some of that was what was happening, but they were also front-running tariffs on gold bars. I mean, there was a huge imports of gold bars during January, and that's not something that's going to be sustainable, or I think that's going to be reversed in February and March. Also, we had the coldest January since 1988. And as a result of that, retail sales declined sharply, as did overall consumer spending. And I think that's going to be reversed in February and March, and we'll see consumer spending make a nice comeback. And the same thing goes for employment. Employment growth did slow in January and February, but I think it's going to make a big comeback in March and April.
It does seem like investors are cutting exposure to U.S. stocks. Is this a buying opportunity if you're looking at a longer-term time frame, if your risk appetite is higher than most people? What are you doing right now?
Well, look, in my opinion, the jury's still out on whether these stimulus programs that the Chinese government has put together to boost consumption, and whether the German program to improve German industry, I think the jury really is out on whether these things are going to be successful. I mean, I think we know that given the American attitude towards defending Europe, that a lot of spending is going to go on defense, and I guess that can be stimulative, but it's not really going to make Europe suddenly an economic powerhouse. Europe really lacks a capital market that is as vibrant as the American capital market, that's constantly providing financing for new ventures, for new technologies. And China has a rapidly aging demographic profile, and I don't think they're going to be able to stimulate their consumers. So I think, yeah, the stock markets in Germany and China have had a nice run here, but I think they're going to kind of fizzle out once these realities come into better focus. And I think, meanwhile, the U.S. economy is going to turn out to be remarkably resilient in the face of what we're seeing as a lot of chaos and confusion coming out of Trump 2.0. But I think the economy handled the tightening of monetary policy in the U.S. remarkably well over the past 3 years, and I think that's going to continue to be the case. So I think there's tremendous value here in the Magnificent Seven and a lot of technology names, semiconductor names. I think those names are going to turn out to be good values. I think this is a buying opportunity and not a reason to panic out of U.S. stocks or to greatly change asset allocation away from the U.S. Towards either China, India, or Germany or France.
So, Ed, is Citi wrong? Citi downgraded the U.S., upgraded China to overweight.
Nobody's wrong in this business. Everybody has an opinion. That's all there is to it. You know, I mean, at the end of the day, the market tells you whether you're right or wrong. So nobody knows right now who's right, who's wrong. I guess we can come back in 6 months or 12 months or whatever time period. But look, China's been a frustrating market for a long, long time. It's been a tremendous underperformer for a long, long time. And I don't see that there's anything radically changing in that regard. And, you know, the Europeans just really totally botched up the transition, transition from fossil fuels to clean energy. The clean energy doesn't work. It's not reliable. They are going to be extremely dependent on natural gas from the United States. And they also have a geriatric population. And on top of all that, there's a lot of social tension between immigrants that just aren't really melting into the societies over there. So I'm not that impressed by what's going on over there. And you know, sure, they're going to spend more money, but I don't know that it's going to work.
The
This is the Asia Trade. I'm Paul Allen in Sydney, where the markets have just opened.
And I'm Heidi Stroud-Watts. The top stories this hour. Asian stocks are set to slide as the S&P 500 falls into its first correction in almost 2 years amid a 3-week rout. Treasuries climb amid growing concerns over Donald Trump's widening trade war.
And President Trump now threatening to impose 200% tariffs on European wine and champagne after the EU's plan to tax American whiskey.
And an exclusive interview with AIA's group CFO after the firm announced a new share buyback of up to $1.6 billion. We'll take a look. This is a picture when it comes to US futures after what was a milestone session, if you can call it that. It fell 1.4% for the S&P 500 on the day, bringing that 3-week rout to a level that, of course, we see meeting the technical threshold for a correction. We're down more than 6% so far this year. That's a wipeout of about $5 trillion in market cap since the peak in February. And, of course, so much of this has been ongoing concern over the volatility driven by President Trump's trade policies and some of the other domestic economic policies and the impact on economic growth and on the inflation outlook as well. At the moment, we're seeing S&P futures picking up a little bit from that downside, about 0.5%. Nasdaq 100 futures also higher by about 0.6% there as well. But overall, it's we've seen 16 trading sessions to tumble by this magnitude from that February 19th high. This is the 7th fastest correction in records going back to 1929, and it's interesting in terms of the sort of political policy volatility that we've been talking about. 3 out of the 7 fastest drawdowns of this magnitude have actually happened under President Trump in 2018, 2022, and now in 2025. Take a look at oil as well, which is interesting because we have been watching, of course, just that downside when it comes to concerns over the demand outlook for not just the US, but of course China as well, but a lot of the trade issues hitting oil at the moment. But we are seeing oil a little bit of upside trading in New York, 0.4%. We did see some volatility in that session as well, with the IEA saying that the trade war does pose risks to the global demand picture. They're expecting that supply will exceed demand by some 600 barrels a year, and that's really contributing to that bearish outlook there.
Yeah, that the drill baby drill narrative around oil as well is starting to get something of a reality check. I mean, we have heard from the wildcatter billionaire Harold Ham. He's a major donor to President Trump, by the way. He disagrees with the Energy Secretary Chris Wright's claim that U.S. companies can increase production at $50 a barrel. Shale drilling is getting more expensive. The assets that remain are declining in quality, and Ham says, look, at $50 a barrel, U.S. drillers cannot drill baby drill. It is just not economically viable. So there's a number of factors at play here in terms of what's happening in the crude market. But that stock market action today, I mean, superlatives abound. I think the sell down now is something like $5 trillion in value, wiped from the index. The gauge of mega cap tech down 2.5% today, something like 22% for the Mag 7 down since the peak as well. So really, really heavy selling. But the former U.S. Treasury Secretary, Stephen Mnuchin, he was Trump's Treasury Secretary, says, look, nothing to see here. It's all perfectly normal.
Yeah, it'll be very interesting as we see, of course, this Friday session in Asia looking like it's going to replicate some of those losses. And in fact, we've got a number of Asian markets that are already near or in correction territory. And of course, the latest missive, if you will, that has been threatening markets has been this threat from President Trump to impose a 200% tariff on European alcohol. That's after the EU's plan to tax American whiskey exports. The bloc's top diplomat says they don't want a trade war, but will not hesitate to defend their interests.
We are not interested in trade wars. There are no winners in trade wars. Who is laughing on the side or looking at the side is China, who is really benefiting from, U.S. having a trade war with Europe. But it is also clear that if these tariffs are put on us, then we are also defending our interests.
For more, Bloomberg's White House and politics reporter Kate Sullivan joins us now from Washington. So these tariffs, counter-tariffs, reciprocal tariffs are really starting to spiral now.
Yes, I think these latest threats from Trump really show just how fast things can escalate and how quick countries are to retaliate in the current climate that we're in amid this trade war. So as you mentioned, Trump now says he's going to impose a 200% tariff on wine and champagne and other alcoholic beverages from Europe. And he says the only reason he's doing that is because of the EU's plans to put a 50% tax on imports of U.S.-produced whiskey. So you're seeing alcohol really becoming a friction point here in this trade war. And in Trump's announcement on social media, he also continued to take shots at the EU, saying it was one of the most hostile and abusive taxing and tariffing authorities in the world, really escalating this kind of rhetoric we've heard from him about the European Union. But there's, of course, so much back and forth here because that whiskey tax that he's referencing that the EU is imposing was put in place because it was a retaliatory tariff because of Trump's steel and aluminum tariffs that he announced this week. He's placing a 25% tariff on all steel and aluminum imports. So, where we're at right now is if that whiskey tariff stays, we're looking at these new tariffs all hitting on April 1st, which is, of course, just one day before the large-scale, wide-ranging reciprocal tariffs that Trump has planned.
Yeah, this cycle of tariff reprisals was just so predictable. But is President Trump showing any signs of backing off from any of these trade war threats?
At the moment, we are not seeing any signs of that. Trump has been very steadfast in defending these tariffs and has completely dismissed the market volatility, says that investors are going to see gains and that domestic producers are going to benefit. We actually heard him today in the Oval Office say, I'm not going to bend at all. That is a direct quote from him. And he said, we've been ripped off for years and we're not going to be anymore. So, we heard him in the Oval defending it today. We heard him defending them to CEOs at a roundtable this week. But it's been such a roller coaster, as you know, these past few weeks with the tariffs because of his unpredictable on-again, off-again approach. So it's very hard to say at the moment which tariffs are ultimately going to stick. But one thing that hasn't changed is Trump's defense of them.
There's a lot of other stuff going on, right, ranging from geopolitical conversations around the Ukraine ceasefire, but also the domestic debt ceiling debate. Did we get any update on that?
It sounds as if we have had some difficulties with Kate Sullivan there. That was Bloomberg White House and politics reporter Kate Sullivan. Let's get a little bit more on market impact. Our executive editor for Asia Markets, Paul Dobson, joins us now from Singapore. So, Paul, huge selling today again that we've seen for US markets. S&P now in correction, as we mentioned. But where are the dip buyers in all of this? Is there any evidence that any investors are using this to load up?
Interesting to bring that up, Paul. Good morning. So it does seem that there is a crowd or a cohort of retail investors that are still putting money into the market, trying to capitalize on the recent downdraft. But they're not getting very far because the prices keep going down. So we're seeing more of the higher risk ETFs, for example, or the other speculative corners of the market really getting crushed. So that's making it very difficult for them to hang on to those speculative efforts to sort of find where that dip is and load back up again. I think what we've seen more generally with the very large investors is a very big downsizing of risk tolerance over the last 10 days, which has seen, them cutting back positions right across the board, all the way from the very largest pod shops down to and the rest of the world. And I think that, that speaks to this idea that it becomes a little bit self-perpetuating as, prices fall and people scale back. So volatility rises, so people's risk tolerance comes off again, and it causes a little bit more retrenchment. So at the moment, that can become a little bit self-fulfilling. I would say on the flip side of that, though, these are not hugely dramatic, terrible, terrifying drops right at the moment. Monday was a pretty brutal day, but since then, it's been sort of a little bit more of a gradual decline, and that does talk to this idea that, it's not a complete flush out, and there are people trying to find where that bottom is. But at the moment, that sales sort of force and momentum is overpowering it.
Looks like in the meantime, the bid for bonds has no other choice but to continue.
Yeah, but again, not huge moves higher in treasuries either. You know, I think it was about a 4 basis point decline in treasuries overnight. Where the market seems to be looking for that haven is still gold. A lot of positivity there. Record highs hit this week again. The bond market, I think, you know, part of the concern is that the Federal Reserve is not giving us a strong clue that it's going to step in and help anytime soon. In fact, you know, before they went into a quiet period, most of what we heard from them is this idea that at the moment they think interest rates are calibrated just about right for the economy and that they don't need to rush and they don't want to step in right away. And they may have in the back of their mind, you know, that this back and forth on the tariffs is so uncertain that they will look through that a little bit and we'll wait and see for a little bit more where that goes. So without Fed cuts, you don't have that real compulsion to push interest rates a lot lower or to buy into treasuries as your haven. It seems like people looking elsewhere really to find other opportunities maybe in the market as well, in Europe, in China, where we've seen some strength recently, rather than pouring it all into the US Treasury market.
Executive Editor for Asia Markets, Paul Dobson there. Well, coming up on the Asia Trade, AIA Group CFO Garth Jones will be joining us exclusively to talk about the company's latest earnings. Empower Partners also sharing their plans on how to boost female representation in Japan's venture funding space. Plus, we get investment strategy with BlackRock. They're expecting continued market volatility over the next few months. This is Bloomberg. Well, AIA will start a $1.6 billion share buyback after reporting a 17% growth in new business value last year that missed estimates. The firm's group CFO, Garth Jones, is now exclusively. And Garth, talk us through some of the sort of strengths and bright spots, but also weaknesses that you saw in that result and how the broader environment, both, of course, regionally and globally, might be playing into that.
Yeah, we saw an excellent set of results by any measure in 2024. We saw double-digit growth in our key metrics for new business growth, for earnings, and for cash generation. Our value of new business, our key growth measure, grew by 18%. And importantly, we had double-digit growth across all our market segments. It's a broad-based growth. Our operating profit after tax was up 12% per share, and our underlying free surplus generation also grew by double digits. So with that, we've seen an increase in the final dividend of 10% per share, and as the headline says, a $1.6 billion additional share buyback. I think that reflects the strong momentum in the business. We've seen growth across the portfolio. We've seen recruitment be very strong in the agency force. Recruitment was up by 18% in 2024. And with that, we see the strong momentum building into 2025. So we remain confident in the outlook. And we're very well placed to capitalize on all the opportunities available to us.
Can you tell us about how the China part of the business is going, how margin expansion is looking? Last year was pretty good, and what sort of expansion and strategic plans do you see for China?
Yeah, we're obviously very excited about our China business, which goes from strength to strength. We have a differentiated business in China, which is focused on the wealthiest parts of the geography, the biggest cities in China, and also the wealthiest segments, the more affluent customers. That makes them more resilient through economic cycles. Our business is also very well diversified. More than half our earnings come from insurance and fee-based sources. And our business is focused both on protection and long-term savings. So what we've seen is growth in the agency force again. The agency grew. Recruitment has been strong. We've seen growth in the number of new customers. And the business is going from strength to strength over time. Importantly, we've also seen growth in our geography. We started off with our original 5 geographies, which continue to grow, and we've deepened our presence there. We had 5 new geographies from 2019. They've been growing very well. They grew at 27%. The business overall grew by 20%, so you can see they're growing even faster than the rest of the portfolio there. And our new businesses in the provinces we've just been awarded. We were awarded 4 new provinces in 2024, and we're just starting operations there. So you can see there's tremendous headroom for growth in China. We remain extremely excited about the prospects there.
You're also projecting strong growth in Hong Kong. What's driving demand in that market?
Yeah, our business in Hong Kong grew by 23% to a record high. We've seen growth in the mainland Chinese visitor segment. That grew by 22%, and there's robust demand there. We also saw growth in the domestic segment. That was up by 24%. And we've seen an increasing proportion of that business from new migrants to Hong Kong, from mainland China particularly, but from other areas, as Hong Kong develops a further talent pool. So with that, we see tremendous growth in the business. We also see growth, as I say, in recruitment. Recruitment was up 18%. And we've seen strong growth in our business through our partners, also through Citibank and Bank of East Asia. So that business is extremely well placed, and it's the biggest contributor to the new business in 2024. We can see that business continuing to have a lot of headroom for growth into the future.
Just returning to the dividend, as you say, up by 10%, nearly $1.31 Hong Kong, and a buyback of $1.6 billion. How long do you anticipate this policy of returning money to shareholders continuing? And is there any internal discussion about deploying capital elsewhere, perhaps some M&A?
We set out our capital management policy, our enhanced capital management policy last year. That aims to return 75% of our net free surplus generation to shareholders. And we also say we'd look at our balance sheet regularly to look at whether we have excess capital that we can also return to shareholders. And from that, you see the increase in the dividend. You said 10% final dividend increase and the $1.6 billion additional buyback. We've returned now $18.2 billion to shareholders over the last 3 years, $4 billion in respect of 2024. So we continue to see how we're not only delivering returns on the business through growing the business, but also being more efficient in the way we deploy capital. And with that, you see an increase in the return on equity, and you see strong returns to shareholders. We continue to look at ways in which we can deploy capital around the region. We're very focused on Asia. And we'll continue to deploy capital in the best way possible, both through organic growth. You've seen, again, tremendous organic growth in the business and strong momentum. And there will be occasionally some inorganic activity that we add to it as well that will add further growth to the portfolio.
What's the strategic outlook and plan when it comes to private market opportunities?
Well, what we see is that there are opportunities for investment in private equity, private credit, and so on, as well as in public markets. The vast majority of our portfolio is in fixed income investments to match our long-term liabilities. But we see that we can add additional returns to our policyholders, particularly our participating policyholders, who share in the gains that we make over a longer period of time and can invest in a broader range of assets. Those returns look very attractive over a long period, and clearly we will continue to invest in those and provide the best returns we can for our policyholders.
Garth, a lot of talk in markets at the moment about the role of AI. I'm just wondering what you're doing there to put the AI in the AIA.
Well, we believe that AI will transform our industry, and with that we will see better outcomes for our customers, for our agents, and for our shareholders. We've already deployed a lot of AI already, actually, in our business. One thing that's important to note is that we invested heavily in technology over the last few years, and with that we've not only got the infrastructure, but we've also got our data in the right form so that we can leverage AI to its fullest extent. We've already have around 50 use cases, and they're already producing substantial benefits to us. A good example is our call centers, where the AI summarizes the call center conversation. And with that, we've seen our response rates reduced by about a half. So we can see better service to policyholders, a more efficient business, and, as I say, better returns to shareholders.
All right, Garth Jones, AIA Group CFO, thank you so much for joining us today. We've got more ahead on the Asia trade. This is Bloomberg.
बच गया। दूसरे बैंक के एटीएम यूज करने के चार्जेस लगेंगे। Zero charges for using any other bank ATM with IDFC First Bank savings account.
बच गया।
Tariffs are bad for growth and bad for inflation, which puts the Fed in a bind. Basically, they're missing by more on both sides of their mandate. So I think in the near term, the Fed's going to basically be on hold, waiting for more information. Trump administration is making the matter worse because not only are they putting tariffs in place that are much larger than they did during the first term, they're doing it in a very haphazard, irregular way, which is creating a lot of uncertainty.
Our Bloomberg opinion columnist Bill Dudley there talking about the impact and risk of Trump's tariffs on markets, of which are pretty clear with that equity market correction for the S&P 500. But take a look at how we're viewing the FX side of things. And it was interesting. We had some oscillations in the dollar, but broadly the Bloomberg dollar index was stronger in the overnight session. A lot of those trade tariff risks remaining in focus. It did, though, pair some of those gains after one report showing that US wholesale inflation stagnated in February. In Asia, we did see that outperformance in the yen. The euro, though, no longer being seen as overbought.
Well, the EU's top diplomat Kaja Kallas says the European Union is ready to defend its interests. She spoke with Bloomberg after President Trump threatened 200% tariffs on the bloc's alcoholic products following the EU's.
Okay, guys, crude oil कुछ खास मूव किया नहीं, नेचुरल गैस भी साइडवे चला गया। यूएस गवर्नमेंट शटडाउन नहीं होगा। डेमोक्रेट्स पार्टी के जो मेन लीडर हैं दे आल्सो सपोर्ट रिपब्लिकन पार्टी टू वोट इन फेवर टू नॉट शट डाउन द यूएस गवर्नमेंट, तो ऐसा होने वाला नहीं है। ठीक है, तो ये कंफर्म नहीं है। बाकी का गाइस मिलते हैं कल वीकली एनालिसिस के साथ। कल होली भी है जिन लोगों ने नहीं बनाई, सो होली बनाना। फिर मिलेंगे मंडे को। एंजॉय द वीकेंड। Bye, take care and good night to all of you.
Steps, the legal acts that are done, and then we are also, ready to react.
A stupid question or a basic one, but are you confident you know what the U.S. wants when it comes to this trade war? As you watch all of these salvos and escalations, do you know what you could do or might do to appease the President of the United States and end the war that started a few weeks ago?
Well, of course, you have to ask the President of the United States what is their goal regarding this. But what they have been or what they have been saying out is that there is a trade deficit between our countries. It is, of course, not that big, and we can address this in a different way. But it is how it is. Like I say, we keep a cool head, and of course we are, ready to act and defend our interests when we need to.
Those are European Commission's Vice President and High Representative for Foreign Affairs and Security Policy, Kaja Kallas there. More ahead on the Asia trade. This is Bloomberg.
Let's take a look at how some key commodities are trading at the moment. We do have iron ore prices ticking up ever so slightly, 102.50 at the moment for futures traded out of Singapore. The copper price holding up as well. Interesting moves for the oil price as well. We're seeing some modest gains for New York crude, although Brent has slipped back below $70 per barrel. The International Energy Agency is also trimming its outlook for consumption growth due to, you guessed it, the trade war.
Also geopolitics at play as well, Paul. At the moment, Russian President Vladimir Putin saying he wants to discuss the proposed Ukraine ceasefire with US President Donald Trump. However, he warns that any truce should lead to a long-term resolution of the war. For more, let's bring in Bloomberg's Michael Heath. And we've been saying how the ball is in Putin's court at the moment. It was interesting. We were just listening to our conversation with the foreign policy chief for the EU, Kaja Kallas, and she's a known Russia hawk. And she's saying, look, none of these ceasefires will last, right? right? There's a lot of scepticism there.
Yeah, and look, I think even what Vladimir Putin said, I mean, there's just a real sense of obfuscation almost about it. This comment that it needs to lead to real peace. Well, that's what the whole purpose of the ceasefire is, so that they can negotiate that. So look, you get the sense that he's playing for time because while the ball is in Russia's court here internationally, and he doesn't want to be caught out as the one who's standing in the way of peace. His forces seem to be making up a bit of ground, and they would dearly like to expel Ukraine from the Russian territory that it has managed to capture, which it wanted to use as a bargaining chip in any peace negotiations. He'd really like to have that removed from Ukraine's grasp before there is serious negotiation. So, look, we'll have to see. I mean, President Zelensky of Ukraine sort of ridiculed what Putin was saying, and basically that Putin had started all this and really doesn't want peace, because he's just interested in killing Ukrainians, which is sort of extreme, but you can understand where he's coming from. I mean, the general sense among people who are suspicious of Russia is that he'll drag this out as long as possible.
And of course, Putin does have a history of violating ceasefire agreements. Can there be a credible deal without at least European troops present in Ukraine?
Yeah, absolutely not, Paul. I mean, what we've seen is Russia basically is surrounded by ceasefires or frozen conflicts, this sort of stuff, whether it's in Georgia, whether it's in the Moldova, these other areas. It does. And the reason it doesn't want NATO or European peacekeepers is that that would constrain its options here. We know that it's run down a lot of its Soviet-era arsenal and that sort of thing. So the opportunity to have a bit of a ceasefire and restock and have another go at this probably is playing in the back of their minds. And that's why Ukraine and Europe in general will insist on NATO forces being involved on the ground there, mainly because Putin has a line, and it's fairly clear from his 25 years in power, he doesn't touch anything to do with NATO because of Article 5, that they'll all respond. Whatever President Trump says, the rule is that everyone has to run in to defend somebody. So if NATO troops are attacked, it really would raise questions about whether Russia is, in conflict with NATO there. Putin has said he wants Chinese forces, etc., who would be much more probably sympathetic or he'd say even-handed, but probably more sympathetic to the Russian case. So that's going to be a really, really interesting one. I mean, it's a very, very difficult agreement to actually get sorted out because there's just such conflicting situations here on both sides.
And of course, there's always an economic stake, right? Even Putin hinting at the possibility of economic energy cooperation. We know that the Europeans are seeing that interest in Gazprom. At the same time, we're seeing a tightening of energy payments sanctions by the US on Russia. Yeah, well, so what's happened is a Treasury... It's a waiver that basically allows Russian banks to access the financial system to process energy payments from Russia, and that waiver is sort of there to allow countries that sort of need these transactions to happen. It's almost like it sort of has slipped through the cracks in a way. It's not like the US has sort of imposed new ones. They just haven't allowed that. They haven't extended the waiver. So that may well happen. It's unclear. But as to Gazprom, that's very interesting. And Gazprom has long been seen as sort of a private arm of Russian foreign policy. I mean, it's this vast hydrocarbon company, and there's a lot of money involved in that. And Europe, you'd imagine, would be very, very... I mean, what the war showed Europe is that it can't rely on Gazprom, it can't rely on Russia here. So it'd be interesting to see what the US is looking at there, because the US obviously produces a lot of hydrocarbons itself these days. So how that unfolds will be very, very curious.
Well, there's a G7 foreign ministers meeting happening in Quebec at the moment. I imagine the mood is somewhat uneasy. What are the odds of achieving consensus on anything?
Yeah, look, pretty close to zero is from our reporting at least, Paul. And one of the things is that obviously the other countries in the G7 want to be harder on Russia, and we saw this, earlier in February when it was the third anniversary of the invasion. The US was vetoing in the UN condemnation of Russia. And the same thing seems to be happening again in the G7. The charitable explanation is that the US is looking not to provoke Russia when it's in such sensitive negotiations, trying to get this ceasefire up. Perhaps the less charitable one is that President Donald Trump is not very happy with any American allies at the moment, is not particularly interested in international institutions, and a couple of sources have told Bloomberg that it looks like the US is just there to just to make sure there is no consensus. Now, Marco Rubio, the Secretary of State, is one of the more conventional members of the Trump cabinet. And probably he would very much like to have an agreement, but it seems like we won't get anything out of that.
Thanks, Michael. Heat there with the latest there. Well, authorities in South Korea have ramped up security measures around the Constitutional Court ahead of a ruling on whether to permanently dismiss President Yoon Suk-yeol. Our economy and government reporter Soo Kyung-choi joins us in Seoul. And what's sort of the latest in terms of when we're expecting that ruling, what we might be expecting, and clearly a high degree of tension and expectation that we could see a repeat of protests on both sides?
The court was widely expected to deliver a ruling sometime this week, but it looks pretty clear at this point that the ruling will be pushed back until at least next week. The court announces the ruling date just days in advance, so we don't know exactly when Yoon's fate will be decided. What we do know is that it's taking more time than the past impeachment cases where the justices deliver a ruling within 2 weeks since their final hearing. If 6 or more judges agree to uphold the impeachment, Yoon will be immediately removed from office. If judges decide to reject the impeachment, Yoon will get his presidential powers back and return to office.
But what could potentially be next? Could Yoon appeal if he is unsuccessful?
The ruling is final and takes effect immediately, so if he's booted out from the office, he won't have a chance to appeal. And a presidential election will be taking place within 60 days. Either way, South Korea will likely have to remain in position to deal with tariff threats coming from Donald Trump, at least for the coming months. And analysts say a likely worst case scenario is if the court dismisses the impeachment, at least for the market, prolonging the political chaos and putting Yoon, who's deeply unpopular leader in office, to lead the country. Now, if a snap election is held, Lee Jae-myung, the opposition leader, is the front runner, and there is clearly no front runner from the Yoon's conservative camp at this moment.
I do wonder what public sentiment is at right now, particularly at a time when we're seeing vulnerability in the economy, the impact of this political drama on the fiscal side, and the ongoing threat of Trump tariffs.
We are actually seeing a sharply divided South Korea right now. We've been seeing street rallies taking place every week since Yoon's impeachment in December, both for and against Yoon. And police are actually ramping up security. They have decided to close schools near the Constitutional Court on the verdict date. They're encouraging companies to allow employees to work from home on the day of the ruling. So we are indeed seeing these risks very high and entering a very critical moment for South Korea right now, with tensions running very high.
Right, economy and government reporter Soo Kyung-choi there. Let's get to some other stories that we're following. The US Senate Democratic leader Chuck Schumer is dropping his threat to block a Republican spending bill. The move opens the way to avoid a US government shutdown on Saturday. Democrats and Republicans have been engaged in a standoff over Democratic insistence that a spending package include some restraints on Elon Musk's federal cost-cutting crusade. Portugal will hold an early election on May the 18th after the government was ousted in a confidence vote. The collapse may delay some key decisions, including infrastructure investment and defence spending. And this will be the country's third election in just 3 years. Prime Minister Luis Montenegro is expected to seek re-election. Former Philippine President Rodrigo Duterte is set to appear before the International Criminal Court later on Friday. Duterte is facing charges for alleged crimes against humanity during his deadly war on drugs. His arrest marks a significant milestone for the ICC and a major political shift in the Philippines, where his daughter is vice president and the Duterte clan enjoys strong support in the country's south.
We'll take a look at how we're trading just 40 minutes into this Friday session here in Australia. A little bit of upside, just sort of pulling away from the cusp, still really on the cusp of that technical correction for the ASX 200 there, given that close of half a percent lower in the previous session. Really could tip closer into that territory if we see a change in sentiment. This has been the first gain that we've seen in 4 sessions for the benchmark, but still we've been sitting at the lowest level since about August 8th. At the moment, we're seeing pretty bifurcated market. Materials seeing gains of about 1.5%, some strength in utilities and real estate there as well, but a lag when it comes to consumer stocks as well as energy, given the uncertainty over the global oil demand and supply outlook there. We also had some words of caution from Australian regulators, really warning about the possibility for a further disorderly environment when it comes to trading. They see the risk of disorderly market corrections given the geopolitical tensions, the international environment being highly uncertain, and policy uncertainty being magnified, according to the Council of Financial Regulators there. The Aussie dollar sitting pretty unchanged at the moment, 62.86. We had some fluctuations in the trading the dollar, ultimately a little bit stronger, but we did see some of those gains being erased after a softer PPI reading for February in the US. More ahead on the Asia trade. This is Bloomberg. A new fund in Japan is challenging gender inequality, and Power Partners just launched their W Power Fund, which is dedicated to supporting women, entrepreneurs and startups that offer products and services that promote female empowerment. For more, Power Partners co-founder and general partner Kathy Mitsui joins us now. Kathy, really great to have you back on Bloomberg TV, and we know that your background is so heavily focused on really pushing forward the campaign of women's empowerment and womenomics in Japan, right? Can you give us an idea of how the landscape is at the moment, given the changes that we continue to see in the broader economy?
Absolutely, and thanks for having me back. If you look at what's kind of changed since I first broached the topic of womenomics back in 1999 when I was still at Goldman Sachs, we've seen a phenomenal increase in the percentage of women in this country working outside the home. It used to be Japan had the lowest female labor participation rate in the developed world, and now it is over 70%, exceeding both the United States and Europe. So that's phenomenal. So there's a record number of women working outside the home in Japan. Having said that, if you look at the composition or what type of jobs these women are working in, more than half are still working in part-time roles as opposed to full-time ones. Hence, if you look at where we still need to do a lot of work here in Japan, is there's still a dearth of women in leadership or decision-making positions. So, for example, the percentage of women on executive corporate boards or in the parliament is still pales in comparison to the rest of the developed world. So still a work in progress. However, we have definitely made some progress over the last quarter century.
A lot of sort of question marks over what's going on when it comes to the anti-DEI push in the US, the unwinding of a lot of those policies, even at, big banks, including ones that you've worked at. And I do wonder, how do you see this playing out for Japan? Do you see that impact as having overflow, or do you see that as an opportunity to be able to take on some of the investor interest from those who are still dedicated to looking at, equity-driven investment opportunities?
Look, at the end of the day, Japan faces a hard, cold reality, which is its labor force or workforce population is going to shrink by over 1/3 by the year 2050. Japan is not in a position, in other words, to relax, to step back from its push to increase the inclusion of all people in its country. So I believe that this is actually a fantastic opportunity for Japan to double down on diversity. And our fund, W Power, that you just highlighted at the beginning, we are Japan's first VC fund dedicated to female founders and businesses that are empowering women. And the reason we did this is if you look at the landscape, female founders in this country only receive 2% of all venture funding, despite the fact that women account for 34% of all founders. More interesting is we actually did some analysis and looked at the average valuations of different stages of funding rounds, male founders versus female founders across the board, without exception. Female-founded companies' valuations were lower than that of their male counterparts. Having said that, on exit, the primary exit route in Japan is IPO, as you know. If you look at average IPO valuations relative to the cumulative amount of funds raised, females' valuations of their companies were actually 1.5 times higher than that of their male counterparts. In other words, you can get in at a discount, you can exit at a premium, and so for us, this is a tremendous arbitrage opportunity. We're not doing this for charity or for human rights or all of that. We're doing this because we are financially driven investors, and this is an untapped opportunity that we believe is extremely attractive.
Kathy, is that one of the reasons you're launching the fund now? And can you tell us about some of the projects that you've been putting money into?
Sure. So we actually have our main flagship fund called Empower Fund, which we launched about 4 years ago. It's a $150 million US fund. We have 20 portfolio companies, mainly here in Japan, but also some outside of Japan. And we do not have in this flagship fund any kind of gender lens when we're looking for companies, but it just so happens that 40% of our portfolio in the flagship fund is also female or minority-founded companies. It's coincidental. It's not, a deliberate or choice that we're making to seek out minority founders. We believe we're picking the best companies we can possibly find, and that is the outcome. So for us, if you look at the themes that we're looking at, females are running businesses that are deep tech, life science focused. We're also looking at companies where women are running B2B software businesses that are growing very, very rapidly. We have a company that's providing a reskilling platform for millennial women, which is a huge need, as you can imagine, in this country. So it's a very wide gamut of businesses that these women are running. But it's like, it just so happens that they're women. It's not that they're running women-related businesses.
Mm-hmm. Well, you're also getting support from partners like Mitsubishi UFJ Bank, the Japanese government as well. And in terms of the government, is there any more support you'd like to see to give more backing to female entrepreneurs in Japan?
Yes, and I have to say, Tokyo Metropolitan Government, who is one of our backers of W Power Fund, has been a tremendous leader in this arena. But we would like to see more, not just public support, but frankly, private support, because at the end of the day, to move this needle of 2%, we need everybody's involvement and participation. So we need more acceleration programs. We need more networking opportunities for women. And we frankly need just simply more capital. We also need more diversification on our side of the table, which is the venture capital or investor side of the table. And we're making efforts in that space. There's a wonderful organization called Tokyo Women in VC, which I support, and they're trying to increase the number of female decision makers in the venture capital industry here. So there are multiple prongs to attack this problem, but I'm very, very confident, given that opportunity set that I've just described, the opportunity for, really achieving significant financial returns in this market are tremendous.
All right, Kathy Matsui, co-founder and general partner at Empower Partners. Thanks so much for joining us. We have more ahead on the Asia Trade. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Do have some breaking news just crossing the Bloomberg. Samsung SDR to sell 2 trillion won of new shares there. We will see that market reaction when trading comes online in Korea in just about 7 minutes' time. They'll be selling 11.8 million new shares according to a regulatory filing. The proceeds for this sale will be used for M&As and capex, with the expected new share price of 169,200 won per share. The current number of shares outstanding is 68.76 million. So one to watch as we get into the start of trading in Korea, Paul.
Well, this weekend, the new Formula One season gets underway in Melbourne with the traditional opener, the Australian Grand Prix. This is not an easy sport for new teams to break into, but there's one Australian tech CEO trying to do just that from a remote mountain base in New Zealand.
The scenery is stunning, and so are the cars that shatter the piece. There's no neighbours to complain about the noise here at Mount Lyford. This is where the CEO of ASX-listed Dicker Data set up Roden Cars, a very expensive passion project.
I wouldn't say building cars is necessarily the most profitable business in the world, even if you can be successful.
In 2005, Dicker bought a 1,300-acre farm here and, over time, built a test track and a garage with all the gadgets, including a 3D titanium printer and electrical engineering equipment. The F-Zero hypercar is one of the results. A 4-litre V10 engine, a top speed of 360 kilometres per hour, and a no-rules design philosophy. It looks like something Batman would own.
Well, on the F-Zero, we designed the whole car ourselves, basically. I designed the car completely from scratch. So there's, other than, electrical components and, brake systems and a few other bits and pieces, virtually everything on the car we made here.
Another of Roden's cars is the FZ, which looks more similar to a Formula One car. It was hoped Roden would be on the grid for this year's Formula One season, the first team ever from the Southern Hemisphere, turbocharging production and innovation at Roden's base. But the bid was unsuccessful, a failure that Dicker blames on Formula One politics.
They're not really interested in sporting teams, they're interested in big corporates that can use the sporting side of it as a marketing function. And that's not really sport.
Dicker is refusing to give up on his F1 dream. He admits it's unlikely, but then again, the entire Roden story so far has been unlikely. Paul Allen, Bloomberg.
Take a look at how we're trading, with Australia extending some of those gains, albeit modest ones, but still keeping away just from the technical correction territory that it has been sort of wavering on the edge of. And of course, we saw that happen when it comes to the S&P 500 overnight. Nikkei futures looking mildly in the green there, and S&P futures a little bit more positive. This is Bloomberg.